स्टार्ट किया है.
So good morning, everyone. Welcome you all on day 2 of the National Conference on Company Law and Corporate Governance. Yesterday, we learned so many things from our learned and very experienced speakers and panelists. And today also, we are starting with another interesting panel discussion on evolving expectation of independent director. See, nowadays the compliance penalties, legal costs, personal liability, and reputational impact. These are the faced by the independent director. And these were very uncommon in the past, but nowadays we are hearing about it. And the role of independent directors are riskier than even before. So what are the things which can help to the independent directors in evaluating and managing this risk aspect? So in very early stage. So this is a talk for today's panel discussion, and we are going to hear from our panelists. And I recognize the presence of our chairman, WRC, CA Murtaza Kachwala, sir, our panelists, CA Kamlesh Vikamsey, a past president of ICAI, Bhavna Doshi, madam, she is joining us within some time, past Central Council member, CA Nagesh, Pinge, sir, CA Farokh, Subedar, sir, and CA Khushroo Panthaky, who is going to grill the panel on the subject as a moderator. Also recognize the presence of Regional Council member Ankit Rathi, Piyush Chandak, and Virak Shah also. But before start the session, I'll request to our chairman, WRC, CA Murtaza Kachwala, sir, please address for a few.
Thank you, Shweta. A very warm good morning to everyone. And at the outset, let me thank CA Kamlesh Vikamsey, sir, CA Bhavna Doshi, CA Farokh Subedar, CA Nagesh Pinge, and CA Khushroo Panthaky for accepting our invitation and joining us today and agreeing to share their valuable knowledge with all the participants today morning. So thanks to all of you. Let me also thank Ankit Rathi, chairman of the committee, for such a beautiful program, Piyush, treasurer, Shweta, secretary, and even Viraj, our coordinator for today. I'm sure all the participants will agree, yesterday's day was really power-packed. We started with the corporate governance landscape and Mr. Kale covering it in the morning. And we ended the day with Raj Mulik talking about the ESG and the sustainability reporting which is required to be done, and so many things he showed about. And when he was covering certain aspects of it, like to cover and report on things which do not come from a trial balance is going to be something new. And we are embarking to a new journey as such. And in between, we also had the fraud, forensic, and then again, we covered the Companies Act and all of those. And again, a requirement from the regulators on a regular basis. So coming to this day 2, we start with the stalwarts here. And I'm sure they're going to talk about various expectations from us also as a chartered accountant. What should we, what should not we, and maybe what are the opportunities for us as consultants, as chartered accountant, how can we add value to the organization? So that is one. We again end with a panel towards the end of the day where we talk about the opportunities in terms of if the board, if the independent directors and the board expect companies to report or submit a report on related party every quarter or compliances on every quarter, then where do the CEO, CFO go to? They come to us, of course, as a consultant, chartered accountant, we go and do the work. So there are so many opportunities. And again, we help them in designing the internal financial control, in doing the testing. So there are so many such things. And during the day in between, we have Sudhir, Soni covering on SQC1 and audit reporting. And we also have Chandrika and Nilesh, Vikamsey sir covering on the NFRA, which is also again giving us sleepless nights. So we'll try to clear some myth around there. And then SEBI LODR related party by Paresh, Clerk. So looking forward to an exciting day. Happy learning to everyone. I welcome everyone again to this second day. And really, thank you very much. And over to you, Shweta. Thank you.
Thank you. Thank you, Chairman, sir. So before handing over charge to our moderator, let me first introduce and have to say something about our moderator, CA Khushroo Panthaky, sir. He is a FCA with 37 years of experience in accounting, auditing, and financial services, and currently as a senior audit partner with Walker Chandoik and Company LLP. He has an extensive experience both locally and internationally in auditing and advising large corporations and multinationals. He has completed a diploma in insurance from Darden Business School in Virginia. He graduated from Sydenham College of Commerce and is a bachelor at General Law. He is an eminent speaker in many workshops, seminars, and conferences locally and internationally, and has presented technical papers in India, Singapore, Hong Kong, UK, and USA on varied subjects and topics of technical interest. He is a visiting faculty and Select Training and Management Institute in India and addresses on various subjects on accounting, audit, law, financial management, corporate governance, and other technical subjects. He is very active in our own ICAI Institute and contributed in various committees at ICAI. So he is also a member of 3 CII national committees, namely the Committee of CFO, the Committee on Financial Reporting, and the Committee of Insurance and Pension. From the Harvard Business School, he has completed advanced program on managing and transforming professional services firm. He is a part of independent advisory board of studies constituted for MBA law by the Narsi Monji Institute of Management Institute, and is also a part of the advisory panel constituted by Lloyd's Business School, Mansur. So also a trustee in certain community trust and is involved in select CSR activities. So with this brief introduction, I welcome you all at WIRC and handing over charge to our moderator. Over to you, Khushroo sir.
Thank you, Shweta, and thank you very much, WIRC Chairman sir, and everybody out there in the office bearers. Indeed, a privilege and a pleasure to be here this morning. Sincere welcome to all the panelists over here. So let me begin with introduction of the panelists. I'm sure, I think they do not need any introduction, but I have a duty to do so. Let me start with CA Kamlesh Vikamsey. Of course, Kamlesh Bhai, as you all know, is a past president of the Institute of Chartered Accountants of India. He is a very renowned speaker, a global member of many committees and boards. He also represents on the audit committee of UN. He is a senior partner with KKC and Associates, earlier known as Kimji Kuvarji and Associates. Kamlesh Bhai, of course, is a very known professional, and it's a privilege to have him today as a panelist on this particular panel discussion. Bhavna Doshi, of course, is a partner with Bhavna Doshi and Associates, which specializes in the fields of taxation and corporate restructuring, providing advisory services. And I mean, she has been in the profession for more than 35 years now. She serves as an independent director on the boards of several listed companies. She was elected to the council of ICAI for 4 terms of 3 years each, so almost 12 years in the ICAI. She has served as a member of the Government Accounting Standards Advisory Board, which was set up by the CAG of India. She was a member of the Compliance Committee of International Federation of Accountants, headquartered in New York. Bhavna Ben also was the president of the IMC, the Indian Merchants Chamber, and is actively associated with its activities. She's, of course, a regular faculty at the programs organized by professional institutes and business chambers, and also delivers many, many lectures abroad. Welcome, Bhavna Ben, to this particular panel discussion. The next panelist is CA Farokh Subedar. As you all would be aware, Mr. Subedar joined Tata Sons, the parent company of the Tata Group, and rose from an accountant in 1985 to retire in 2017 as the COO of Tata Sons and the company secretary. He qualified as a CA in 1978 in the first attempt and completed CS as well. He continues to be associated with the Tata Group as a non-executive director presently and is the vice chairman of Tata Investment Corporation. He is on the board of Tata Capital Company, the asset management company, the Tata Industries, and the Tata Realty and Infrastructure in its capacity as a non-executive director. He is a past president of the Bombay Chamber of Commerce and Industry, and he is currently appointed by the Reserve Bank of India on the advisory board for SRE group of companies. Welcome, sir, to this particular panel discussion. Our last panelist is CA Nagesh Pinge. As you all would be knowing Nagesh well, I think Nagesh is an expert in ethics, corporate governance, risk management, internal audit. He's definitely one of the most appropriate members for this panel. He's a CA and law graduate from India. He has also completed the executive education program from the Stephen M. Ross School of Business of University of Michigan, US. He has a career spanning more than 40 years and has worked with many organizations, including Tata Motors, JSW Steel, etc. He is currently an independent director on many companies such as Goa Carbon, Arvind Fashions, MCX Clearing Corporation, Aditya Birla Sun Life Insurance, and Utkarsh Small Finance Bank. We welcome you, Nagesh, to this particular panel discussion. So once again, a warm welcome to all of you. And it's a privilege to moderate, or rather I would call it facilitate, this particular session on corporate governance with specific emphasis on independent directors, the expectations of the independent directors, and I believe even expectations from the independent directors. So friends, this particular topic is a very important topic, and it's very close to my heart, because today the entire operationalization of companies, the entire manner in which the businesses are run, they should be run in the right manner, in a very ethical manner, and in a very appropriate manner. The platform of governance, the platform of good governance, definitely gives a fillip and a boost to the corporates to do things in the right perspective. Now, over many years, we have learned about corporate governance. Internationally, governance has been held as a top priority for corporates. Kumar Mangalam Birla Committee in 2001 actually rolled out good governance norms, formal governance norms, etc. And over a period of time, the Kotak Committee, the SEBI, and many other regulators kept rolling out good governance norms. Ultimately, I think two things are extremely important where governance is concerned. One is, of course, to enhance the shareholders' value, because all the stakeholders definitely expect that the valuation of the business, the ethical standards of the company, and the platform on which the company operates should be of the highest order. And therefore, enhancing shareholders' value is one objective of corporate governance, and definitely the long-term value creation. Because over a period of time, the businesses have to be sustainable. There are different kinds of businesses prevailing in our country and anywhere in the world. Today, we have got many conglomerates, Indian conglomerates, which have a setup internationally as well. There was a time when there were so many multinational companies operating in India, as a branch in India, or as a subsidiary in India. Today, we are proud to say that there are large Indian conglomerates which have a place of business overseas as well. And therefore, the businesses have to be run effectively, efficiently, and most importantly, in the right manner. And therefore, this particular calls for good governance. Now, who are responsible for the governance? Yes, it is the entire board who is responsible for the governance. But again, the composition of the board comprises of executive directors, the non-executive directors who need not be independent, and of course, and finally, we have non-executive independent directors as well. And therefore, our focus of discussion today would be on the independent directors. The esteemed panel over here, which comprises of 4 individuals, have significant experience of being on the boards of companies in the capacity of independent directors. And of course, Mr. Subedar in his capacity as now as a non-executive director on some of the companies. So the objective is to get some kind of a knowledge and the feedback from them in terms of how these corporates are running good governance norms. In an organization, there are many things to do. And therefore, the responsibilities on the directors are onerous. If you look at some of the changes which SEBI has got recently in its particular new regulatory rollout, is that there's so much to be done at the corporate level, at the board level, that the directors have to really pull up their socks and start asking difficult questions, interesting questions, and relevant questions to the other members. On one side, you have got the promoters, who basically have a stakeholding in the company, could be 30%, 40%, 50%, anything. On the other side, you have got other stakeholders, which include public as well. And when they look at the company, the analysts, the government, the stakeholders, the public, they expect the independent directors to be their representatives and to ensure that they are charged with governance, and they would really promote good governance. So whether it is the risk and regulatory framework, whether it is a risk management framework, whether it is a functioning of the various committees of the board, whether it is a whistleblowing mechanism, whether it is appointment of internal auditors, statutory auditors, dealing with these auditors, and ultimately being very bold and being very candid and asking difficult questions to those who may not be doing things in the right manner, challenging the financial results, etc., are the significant responsibilities imposed on the independent directors. Over a period of time, we have also heard that the independent directors have similar and same responsibilities like that of executive directors. Now, the fact that they come specifically for meetings. They have only an oversight and are not involved in the day-to-day operations of the company. Is it proper? Is it justifying that they are equally responsible? I think these are the things that we'll definitely take into consideration today in the panel discussions. But most importantly, I have always requested the panelists to be candid, to be very transparent, so that the audience over here, which comprises of professional chartered accountants, comprises of independent directors and individuals who could be on the other side, who could be on the corporate side as well, will get the feel of the significance and the importance of the roles and responsibilities of independent directors, the kind of headwinds that they would face. God forbid if the companies actually go bad, and if at all there is any kind of a tarnishing of the image of the company, it also impacts their own specific image as well. So with this address, I would like to open up the panel discussions. And my first question goes to Kamlesh Bhai. Kamlesh Bhai, of course, you have been in the audit profession, and of course, you have seen the other side, being on the corporates as an independent director on the boards of those corporates, etc. How have you experienced good governance and have promoted good governance, given the fact that, yes, on one side, promoters have to do the business. They have to run the business. The businesses have to be sustainable. And as an independent director, you definitely want to promote the business in the right manner. But on the other side, there is an onerous responsibility on you as an independent director. And therefore, you have to balance this particular walk, which is a tightrope walk, and you will have to sort of, balance it in such a way that you carry out your duties efficiently, but at the same time, ask those questions in your capacity as an independent director, but at the same time, help businesses grow. What's been your experience on that?
So good morning, Khushroo, and good morning to everyone. At the outset, I thank the WIRC for inviting me today in this very important panel discussion on independent directors. Khushroo, I mean, you articulated the role of the independent directors very well. But along with that, I think you should also, look at roles of others as well, the management, the executives, the promoters, the other stakeholders, the auditors, both internal and external. And each one has a responsibility. When I'm talking of, say, responsibilities of, or rather the obligations on the independent directors, one should look at things in a very holistic manner and not single out only the role of the independent director. Independent director is one of the functionaries in this entire spectrum of various functionaries in any corporate, for that matter. So that should be very clearly understood. And coming to the question which you have raised and my own experience, and I would like to share experiences rather than giving a theoretical talk, because there's no point in talking theoretically. It's better that we share our own experiences as to how things have evolved from the days when there was no independent directors. And I, of course, joined the boards of companies much before this entire concept of independent directors came, and have been serving on the board since 1992. Those were good old days where there were no clarity as to what would be the role of the A director on the board. I will not call independent director, but A director on the board. And today, where there's a lot of prescription in the Companies Act, in the SEBI LODR, and in various regulations, even the Reserve Bank for that matter, if you're sitting on the board of a bank or an NBFC, they also have their own specifications as to what an independent director must do, what an audit committee must do, what the board must do, etc. So looking at the entire gamut of things, you also articulated, Khushroo, that one must ask difficult questions. Yes, by all means, but I mean, asking difficult questions and first of all, understanding the business is most important in your role as an independent director. Let me give you some examples. Supposing you sit on the board of, say, a bank, there are different kind of things which you would look at. Suppose you sit on the board of, say, a private, promoter-driven company. There would be different, consideration which you would look at. Supposing you sit on the board of a company which is professionally run, is owned by stakeholders, professionally run, there are different things you will see. What is, the compensation policy to the CEOs and the managing directors and COOs and these KMPs? These are the things. So I mean, there's no straight-jacketed formula as to what you would look at. And I would again apply the concept of materiality, which we have learned as auditors, as to what is the thing you would see. I mean, given the fact that if you sit on the bank, a board of a very large bank, maybe the related party transactions are very far and few, and they are not material. So would you lay a lot of emphasis on those, or would you lay more emphasis on, say, asset management, the liability management, which is so critical in the case of a bank? So I would not give a straight-jacketed answer to what you're saying. Yes, the independent directors must be skeptical. And of course, one more thing which I must add is that you're not a gatekeeper. I don't see independent directors as a gatekeeper or a chokidar or a, whatever. That chokidar word is now become very famous. So I would not call the independent directors a chokidar. Yes, by all means, the independent directors must look at the interest of the minority shareholders and the other stakeholders other than the promoters, because promoters are there to look at their own interest in the boards. But having said that, I think it is extremely important that the independent directors must learn the business and must add value to the business. There is so much you can do other than, what is statutorily required of you to do. For example, financial reporting, internal controls, risk management, all those things. It's so important that, you bring perspective to the board, to let the board think out of the box and, look at things which are emerging, the risks which are emerging. And therefore, I would put it this way, that the role of the independent director is a very holistic role. One cannot straitjacket this role to every entity you're on, but it depends on the situation in which you are there. There are some companies which are well governed. I mean, you may be a little relaxed as far as your diligence is concerned. And there are many companies who have very good auditors, for example. There, your guards as far as the financial reporting is concerned may be a bit low, but on the other side may be a little stronger. So it all depends on the facts and circumstances of each case and how things are before you when you're sitting on the board of independent directors. But one thing I completely agree with you is that the roles and responsibilities of the independent directors has widened a lot, and so has for the other stakeholders as well. I mean, for example, the other players like auditors, internal auditors, the team of risk management and others, everybody has, increased a lot. There are a lot of prescription now in the company law, in the regulations, which you see. And it's basically codifying what was already being done in the past as well. So I would not say that before the Companies Act was, defined the role of independent directors, that the directors had no role to play as far as, we had fiduciary responsibility to the board and to the stakeholders as well. So with this, I'll stop and hand over the proceedings back to you, Khushroo.
Thank you, Kamlesh bhai. That was a good perspective. I think I like that statement which you said that, of course, that role is not that of a chowkidar who actually sort of, guards the company. It is definitely a much wider role and a role of an oversight and a role of questioning as well. So I would just extend this particular question to Bhavna Ben, a very similar question. That Bhavna Ben, I know that you sit on companies which are manufacturing companies, you sit on the board of a bank, etc. And I'm sure that, and I know for sure that you go beyond the normal attending of the meetings every quarter in your role as an independent director. So maybe for the information of our audience, what is the typical role of an oversight of an independent director? How deep they need to get into the businesses of the company? What is the kind of extent and degree of oversight? What is the kind of interactions with the management? Or is it just sort of, being there on the board on a quarterly basis and sort of, questioning them in the board meetings? Over to you, ma'am. Ma'am, you're muted, sorry.
Yeah. So good morning to all the participants and my colleagues on the panel. Thank you, Khushroo, and thank you, Murtuza and Shweta and all the office bearers of the WIRC who are here today joining us. A very interesting subject, of course, and the questions that you're posing, Khushroo. So on this point, as Kamlesh Bhai was saying, the role of an independent director, or for that matter, I would say any person who's sitting as a director on the board, whether as a non-executive director or otherwise, is to really ensure that they provide the oversight. So they give direction, they help in decision making, but they don't get into the day-to-day management. Now, for that, it's extremely important that you understand the business that the company or the entity is in. And for that, you need to spend little more time beyond what you do at the meetings, whether board meeting or committee meetings, to understand the nature of business and the issues which are coming up. So I have taken that opportunity from time to time to have conversations with the promoters, with the CEOs, with the CFOs, and the other people who are critical or KMPs for the organization. And that gives you little more insights into the business and their thinking, so that when you are sitting on the board and when you are asking the questions, you ask most relevant questions, and that helps them also in taking decisions. See, one of the questions which often comes up, and it did come up in one of the cases, where the CEO said that my team is asking that, is the board running the business or are you running the business? Because the board had started asking a lot of questions and they felt that they are asking so many questions, it's like they are running the business, which is not so. So when you ask the questions also, those questions must be relevant from the perspective of providing oversight. The day-to-day business is the role of the management, but at the same time, you can't say completely leave it out, because when internal auditor is making presentation at the board meeting, internal auditor will have some points. Now, when you ask for more details, obviously it feels as if you are getting into the management, but you are not. What you are doing is that why there is a particular observation and what needs to be done so that the business of the company does not suffer going forward. And there are so many instances which come up when, as independent director, you need to really take a call as to what sort of answers or responses will you accept and where you'll go beyond that.
Thank you, ma'am. I think you laid a very good perspective that it is definitely beyond what the role encompasses or what the role is perceived. And yes, that is something that I have seen that these days, many independent directors meet up with the management, meet up with the process owners on a very regular basis to gain a good understanding of the business. And this is what Kamlesh bhai alluded to have a very good understanding of the business and then safeguarding the assets of the company and the interests of the stakeholders as well. Shifting gears, I come to Mr. Subedar. Mr. Subedar, you've been in a part of a very large, reputed global conglomerate Indian group over a long period of time. And I have interacted with you. I have been an audit partner on some of the companies where you have been on the board. And I have seen a role that you have played, although you had been an executive director and now coming as a non-executive director. I think the questions, the kind of inquisitiveness and the kind of oversight that you have is almost of an independent director, challenging the management whenever required to or raising the right questions. Do you really see a difference between the role of an executive director and an independent director? And specifically, I think the second question, of course, I now come into a very important point of discussion, of course, is the related party transactions. How important and how well they need to be looked into in terms of its framework, in terms of its operational effectiveness, and ultimately to ensure arm's length. So a couple of questions for you in the same question, Mr. Subedar. So you're on mute.
Good morning, Khushroo. Thank you. Many thanks to the Institute for inviting me here on this lovely Saturday morning. I was hoping to put in a statement, even if I was not asked that particular question. Many years back, in a board, I have made this statement. We had two partners in that particular board. There were no minority shareholders. That as a director, we owe our allegiance to the board we sit on. And the company is the first issue which you have to look at. Yes, I did represent a promoter. It's not that one will not take the interests of the promoter, one understands it. But I think in anything in life, and this is something which I have picked up over my many years in the Tatas, when you do something, look at it from the other party's interests also. Yes, you have to protect your interests, but look at all parties' interests. And that actually brings you to independent directors, promoter directors, management. You have to see that you are working in tandem. It is the interest of the company which has to progress, and that is your basic purpose. As Kamlesh also said that, even I've been a director before independent directors were formalized. I think we all wore that hat in one way or the other. We don't want to get into every day a confrontational situation. And whether you are promoter director, independent director, you want a happy relationship within the company. But as you also mentioned, Khushroo, you have to be ready to raise your voice. I mean, I don't think one should take a view that I am a relatively new director or I'm not in management and they will know right what they have said. So that is where your antenna needs to be up all the time, which is what even Bhavna alluded to. I would also mention that in boards, especially when we came from a conglomerate where not everybody had domain experience of the business which we are in. Because you get into various businesses, unlike a promoter who is in one particular business, and therefore one should populate a board with people with domain experience. People from our fraternity would generally tend to be well knowledgeable on accounts, on company law, on taxation, governance related to purely SEBI regulations. But many times where we fail out is that we don't really understand the business. I mean, let's say it's a manufacturing company manufacturing whatever product, or it's a real estate company into construction. It would be always nice for the board to be well comprised, wherein you get in some people with specific domain experience. So people like us would engage with them, try to understand, what should be the output ratios, what should be the level of consumption. Yes, we can do it ourselves also by reading up, etc. But that is where a good mix of between the independent directors, somebody from an area like finance, somebody from an area of manufacturing. So that's the kind of part. I mean, when a promoter also puts up a proposal, I'm sure today with all the regulations in place, he himself has waited to some extent whether it is right for the company, whether the transaction is fair to all the shareholders. He will definitely look at his interests, but the interest has to be subsumed into the interests of the company. It's only then that you can get ahead. As I mentioned, all directors should open their mouths and speak. They should not feel intimidated. And another thought which is going through my mind is that I think you need to decide which companies to join. You need to do enough of research, not a bit of research, sufficient research, and not jump to the first company which offers you a directorship. You need to understand the kind of the manner in which the promoters run these companies. If you're comfortable with it, then only get it, because you don't want a slanging match every day with the board. Coming to related party, yes, this is very, very important. It's a difficult one. Our duty is to see that it is arm's length and in the ordinary course of business. Ordinary course of business generally is easier to lay down unless it is an absolutely rank transaction which doesn't fit into your business, which you will raise. The arm's length is something where we as chartered accountants have a significant amount of experience with our experience in transfer pricing from an income tax perspective, and a lot of common sense which goes into these things. You have to ask people what are the benchmarks you have used. is the benchmark credible? Is it something that you will actually, even if you ask for a quotation, will somebody give you a quotation because you know that they will realize that you have a business within your own group and the job is going to go to them. So why should we even bother to quote? These are the kind of things which you need to look at. Is the comparative quotation given of a size and rank similar to the entity which is your related party? Do they have both the entities have similar experience, similar qualifications? Lot of subjective elements go into it, which you should be insisting on management to provide to you. And sometimes there may be times when you may want to take external guidance also, but you cannot allow that external guidance. You can't 100% say that because X CA firm or some external entity vetted this transaction, therefore I shut my eyes and to it and I blindly accept it. Finally, I think the onus is on you, whether you as independent director, as an audit committee member, you will be that gatepost past which this transaction has to pass. It's a very critical thing, and this is where the entire doubt about governance will arise if there are transactions on related parties which are being done purely in the interests of the promoter, because after all, the company is owned by a whole group of shareholders, and it is not just shareholders alone. It's the wider body of the stakeholders. That is it right to all the stakeholders? Would it be unfair to employees? I mean, if you are asset stripping the company and leaving it without assets. So one has to look at it from a very wide perspective. And that actually brings me to omnibus approval. While we have this whole concept of omnibus approval, and it is very much needed because you don't want to waste time of the audit committee at looking at telephone bills and petty insurance payments, depending on, I'm coming from a background which I worked in. And you really want to see that the limits which you laid down for the omnibus approval will sift out a large number of transactions, but not ensure that the most transactions by the greatest value will go away. Because I have seen managements reviewing or presenting a review of omnibus transactions at the beginning of the year. And when one asks, why did you increase it? So last year, our transactions exceeded this amount in totality. I said, no, that is not the purpose. If your transactions exceeded the amount, the purpose of related party is that the audit committee should be going through it to the few most critical transactions, and that will be by value. You eliminate numbers and ensure that the value comes to you. You look at it, you see that the relevant arm's length comparables are given to you, and on the basis of that, you will accept it. And it's not that because it is with a related party, you will throw it away. There are many other subjective criteria which we also look at. Because it is a related party, if there is a problem, I can pick up the phone and talk to the CEO. There will be a better level of dedication or work which this company will do for yourself because it is a group company. All those factors also need to be kept at the back of your mind. If even assuming it is a few basis points higher price you are paying, you will have to combine all these things and look at it without allowing a sort of an undue advantage to be going away from the company to some other group. I think that would be my answer.
No, thank you for that detailed perspective. I think a couple of learnings you mentioned about the composition of the directors in the board, and you are absolutely right that if at all they come from different walks of life, and something through their enriched experience, if the corporates gain, and accordingly there are diversified individuals, they really help to build up good governance. So that was one good point that you made, and the other point is of course on the related party. I just wanted to spend a couple of minutes, or maybe I would request each panelist now to just spend 1.5 minutes only on this related party transactions, given that people are very interested to know, because today as statutory auditors, as consultants, as individuals who certify related party transactions for the board, it's very important to know about the responsibilities that they have in different capacities. So far it relates to the framework, so far it relates to the companies. How do they ensure that the related party list is exhaustive? How do they ensure that the related party transactions are at arm's length? How do they ensure that they have been properly approved? Maybe if you could share experiences of yours, I think that would be very helpful. Kamlesh, if you could like to start this.
I think Mr. Farokh Subedar has very properly articulated as to what and how what lens you apply to a related party transaction when you're looking at that from a board perspective and as a director perspective. I mean, I have nothing further to add to what you said. Is that based on the materiality, again, let me repeat what I said in my initial comment, is that based on the materiality, you spend time on that particular item. Suppose the item is not material at all, it's no point in wasting time and energy of the management and others to look at the related party transaction in a very, very broad manner. But if you have a specialized kind of a related party transaction where there's no other third party, then you'll spend definitely more time looking at what is the costing and at what transfer pricing the item is being purchased, services are being received by the organization. So you would put a different lens to yourself when you're looking at those transactions. So there's no straight-jacketed answer again for this particular thing, but one has to look at the perspective and the facts and circumstances of each case and decide on how to go about. Thank you.
Nagesh, let me request you to speak about this, but specifically, I think one important question that comes up in every seminar is that can the auditors or can the consultants who certify related party transactions rely upon the list and presume the exhaustiveness of these parties, or they have to go really beyond to identify related parties as a part of their audit scope or certification scope? Nagesh, you're on mute.
Thanks, Khushroo, for the question. And thank you, WIRC. Thanks, Murtuza and Shweta, for inviting me to the panel. I think, Khushroo, I think Mr. Subedar and Kamlesh have already articulated that particular point. Really speaking, each and every transactions have to be looked at it. Are we paying fair price for it or not? And that's the conclusion one has to derive. So you accordingly stitch your, your own processes to come with that particular thing. As rightly said by Mr. Subedar, there is these are you have to take omnibus approvals. And then why you have to take omnibus approval? Because these are all routine kind of things as you are looking at it. Those things, once you put it in there, it becomes fair, and you know the process is on and it goes on that account. At any point of time, as rightly said by Kamlesh, if there are no hard precedents, there are no competitive kind of things which are not there on that account, at that point of time, then you have to take help from the service providers, like many firms which are there on that account. At that point of time, you have to establish not only the arm's length thing, but what is the value mechanism that you want to build around. So probably the costing related part will come in, what all you have to take it, and then you have to look at it whether it's fair or not. I think that's the way you have to look at it. So my feeling is, as an independent director, and as rightly put by Mr. Subedar, there is not much of a difference between an independent director and a non-independent director. There is nothing like that on that account. In fact, I am on one of the boards, what I call public interest director. So I think that is the right word, I believe, that we have to use it, because I am accountable for the public at large, all the stakeholders in that. So is the company doing the right thing? Are the promoters being fair when there are related parties which are coming in that particular thing to see that we are paying the fair price? I think this is what the things comes in. So there is no straight-jacketed answers for that thing. And I think there are, of course, big firms, big companies you will find taking help from an external party like service providers to say, you come and tell us on that account. That probably you can do that once when the initial things are starting. But beyond that, I think it is everybody's responsibility. So what? LODR is now insisting that only independent directors have to take on the onus. But I think eventually you have to come to a conclusion whether the processes are correct or not in the organization. If the processes are correct, you have right kind of promoters. And I think then you don't have to worry too much on that account. And in that context, I think some of the, I would say, signs that you have to telltale signs, as I call it in the board, that you have to look at it is, are we totally promoter centric? Are we looking at only quarter to quarter performance? Then it's a bad thing for us. I think if somebody and the entire board is looking at overall long-term perspective, we are seeing what we will be in next 2 years time, 3 years time horizon. I think that is that kind of company don't have to worry too much about related party things. So far the processes are okay. And at the end, we are paying the fair price. And I think that is where your maturity counts as an independent director in that particular perspective. I thought I'll put my perspective in that way.
Sure. Thank you, Nagesh. Bhavna, any final words on related party?
Yeah. all the three of my colleagues have very well articulated. But let me again come back to the question which you raised, that how much reliance do we rely on a third party auditor or somebody who's telling you that, yes, everything is good, or do you go a little beyond that? So I have had situations where the company comes up and says that we have one report from one independent firm which says that all the related party transactions are captured. Then there is another report from another firm which says that all of them are at arm's length. So, then why does one have to work? I would like to at least understand the process that that firm has adopted in identifying which are the parties, whether the process that you as a company are following is appropriate, whether your software properly captures it, and then what is the basis on which they are saying the transactions are at arm's length basis. So merely because somebody tells you that they are at arm's length, I think it's not discharging our duty or our role. We need to look at that. And again, coming back to the omnibus approval. So we do find situations where, as Mr. Subedar was saying, that the management would come and say that we need to increase because last year it was so much, we need to increase so much. Sometimes we have situations where they say we want to increase it so much. So we have to ask that, why so much? Why 4 times? Why 5 times? Even if you have regular transactions, do you expect this level of transactions? Would it be crossing this level? And if that is so, then what about everything else? Because if with one related party, you are expecting transactions of this volume, then what is your overall expectation? So one also has to apply the mind that if overall the business volume is not that much, how can you approve a transaction as an omnibus approval with a related party? So,
well, thank you, ma'am. Actually, I think the important message you gave is that irrespective of any certification or audit done by independent firms, etc., the responsibility still lies with the board, still lies with the independent directors, and therefore to review the framework, to look at the process, to ask questions and to be satisfied, definitely is a prerogative of the independent directors. I think that's a good message that you have conveyed. Shifting gears, Nagesh, given the fact that you have gone through a significant experience of promoting risk management framework in some of the companies in your capacity when you had been an employee and an executive. And now since internal audit is a very, very important tool for comfort as far as the independent directors are concerned, maybe I think I would like you to give some message to the fraternity in terms of what should be the real approach towards internal audit. I'm not saying that the transaction-based approach or the reporting by exception approach is obsolete. It can still work in some companies, as Kamlesh Bhai keeps saying that no size fits all, it cannot be jacketed. But I think the emphasis globally is, and in the corporate governance is on a risk-based internal audit, the risk-based approach to internal audit. How, as a fraternity, can we upscale our own learnings on this? And today, if at all the internal auditors have to really do an effective internal audit in the organization, what would your message be? And what would be your sort of, perspective be on this? It's mute.
Thank you, Khushroo, for this question. Internal audit has been my profession for many, many decades. Now, last 2-3 decades, I've been doing that particular part. So let me put the other way around. I think having worked as chief internal auditor for Tata Motors and group companies, then I moved as a chair of audit committees on many companies. In fact, out of 10, 9 I am already chair on that particular thing, on that account. So as a chairman of the audit committee, you have to look at the entire, I would say it is like more like, what I call, it's like Zubin Mehta's that Philharmonic Orchestra. You have many players who come for the audit committee. There are people who's a chief compliance officer who comes in. There is a chief risk officer who attends the audit committee. There is a chief internal auditor who comes in. There is a chief, the statutory auditor comes in. Chief information officer is also present for quite a few of those particular parts. then you have statutory auditor, then secretary auditor also once in a quarter you comes, I mean, at least half a year kind of thing comes in. So all these players together come out with what I call the synchronized kind of assurance music to the audit committee on that account. So I think you have to look at it from that perspective. And out of that, two important points or two important players are the risk management group and the internal audit group on that account. So I think they have to play along with others to give you a total assurance on that particular thing. And I think what is really critical, and that is what internal auditors have to understand is, on the other side, there are people who understand the business. At the same time, they also want to see that that particular business is run efficiently and smoothly without much of a noise. So I think first thing, foremost important thing is, I've seen some internal auditors who are aggressive to say they love to create noise in the audit committee. And I think that's something which should be stopped, because for the simple reason, shocks nobody likes in the audit committee. So I think whatever that you have, you need to address it out of the audit committee affairs and then settle those particular matters very amicably to come to the conclusion whether they are in the interest of the company or not. Of course, if there are any typical, I would say, differences opinions, I think you need to get smarter to say we will agree to disagree and we will put it up to the audit committee for their views on that account. So this is one first advice I will give it to the internal auditor and also to the chief risk officer, saying that whatever your cobwebs are, whatever your thought processes are there, whatever your suspects or challenges are there, address it with the people and then come to the audit committee, because audit committee people are not running the day-to-day business. So this is first one. Second one, which is very critical, is when somebody is coming to the audit committee, I think you must know that are you using the right kind of enablers? Are you using the right kind of data? And I think I am of the opinion now that with whatever that is happening in our IT spectrum, looking at entire 100% transactions is possible. And anybody now who tells me that I will look at sample size, I would say he's a person belonging to the past era. So I think now time has come for all of us to look at the entire audit universe, entire transactions, and come out with deviations. And those deviations, when you are looking at it, that itself is like a sample kind of things on that account. So this is the second one. Third one, which is very critical from an internal audit or even risk management perspective, is they should know, are they using the latest kind of enablers? What kind of software they are using? I think that is the confidence that they have to give it to the audit committee. Because if somebody comes to say, I have 5 observations, do you mean to say, are you exhaustive in your observations, or there are something 10 which have left unattended because you have probably not looked at it? So I think you should be very clear about that particular thing. And now time has come for us, and I think we have seen it in the last 2-3 years. We have come with these COVID related challenges, people could not go. So off-site surveillance, on-site surveillance, how you really look at it on that account is very critical. And I think for people now, the modular way of looking at audit, what we call agile auditing, is becoming an integrated part of the thing. So you have to create your audit plan in such a way that you are looking at entire universe, you create right kind of modules. And those modules should be capable of shifting from one quarter to another, depending on the seriousness, importance of that, which is very critical from that perspective. Additionally, and this is something for an internal auditor, which is very critical. I have seen so many people telling me in a very nice fashion to say, yeah, I am a concurrent auditor of this bank. I am a concurrent auditor of that bank. The point is they are doing 1 or 2 small branches of that particular thing. I would like to know, do they really know how their work is being used, which is at a senior level, what kind of thing they are looking at it? So even if you are a small player in that, how that internal audit reflects in the audit committee, I think that total chain, it is necessary for you to understand. So by virtue of that, you will be able to understand how important is your work, and you will be able to do value add in that particular thing on that account. And there are some typical kind of good practices for audit and for risk, which we do. Wherever I go, there is something called pre-audit committee meetings. This is where that is like your zone. the chair of audit committee and some of the audit committee members attend these meetings where the others are not there. That is the time you can tell your challenges. You can say what are your efforts, what kind of tools you are using. That is your time with them. That is important because that also gives confidence to the audit committee members to know that internal auditors are doing their job correctly or not. So this is a very important point. Second one is, once a year now, it is mandatory for all to look at one-on-one audit committee with the chief internal auditor. Audit committee has to meet on a one-on-one basis. And this is where if you have any challenges, you must come out with the right kind of thing, because these things do count a lot. Because if you have communicated something to the audit committee, this is the time to look at it on that account. Third one, which is very critical and which I don't know how many of yearly people are insisting on, when you have an internal audit team, which is an integrated part of your organization and it is not outsourced, it is nice to have what we call, like, in our CA firms, we have a peer review. We should have what we call quality audits. Quality audits in the sense or internal audit or audit of internal audit process. And there are some typical standards which are available with IIA, and even our institute is, I think, planning to go ahead with it, where we must come out with a methodology. How are they looking at it? How are they creating? How are they collecting the data? How are they reviewing it? What kind of checklist they use? How are they presenting it? What kind of processes they have for internal audit? And these are all important quality related matters. Once in 3 years or once in 4 years kind of thing, we must go ahead with, so that it gives the confidence to the audit committee to say things are happening. Audit committee, internal auditors are doing their job on that account. So this agile auditing and of course the risk-based audit, which is very critical, because there is no point to do whatever that is a low risk kind of areas every year, so that the frequency with which we do, what kind of checklist you use, all these things you have to keep on freshening, refreshing, which is very, very critical from that perspective. So I think, I don't know how much really time you will get with internal auditors, but I mean in the audit committee. But I always believe it is also like going to the temple. When you go, when it is very, very crowded, you will not even get 1 or 2 minutes in that typical inside of your temple. But if you are lucky, you can even get 10 minutes or 15 minutes of time, or even for 1 hour or 1.5 hours of time. So internal auditors should always be ready with what I call the detailed reports as well as short reports, depending on the chair of audit committee and how they look at it on that account. So there is no one size fits all thing, but most of these ingredient things are very critical to be looked at it from that perspective.
Thank you, Nagesh. I think that was very interesting. I think you almost delivered a lecture on internal audit, and I think 3-4 messages are very good. Risk-based approach, adopting tools and technologies, and definitely I think having no fear in reporting, with continuous interaction with the audit committee chair and with the management. And of course, I think one important. Yes, sir.
Khushroo, if I may come in for a second,
Yes,
just speaking from Nagesh's point.
Yeah.
One of the practical issues which one faces is we have always 4 internal audit committee meetings, because quarterly accounts.
Yeah.
And the quarterly accounts generally take up a lot of time. And then within that, there is a clutter of various items in the agenda, internal audit reports, omnibus transactions which have to be reported, and various other reporting. And therefore, there is very little time left for looking at the internal audit reports. And therefore, one of the suggestions which I've insisted upon is, please, in between your quarters, have dedicated meetings of the audit committee only for internal audit reports, at least 2 meetings in a year. And that is the point which I think Nagesh was raising. The internal auditor should have sufficient time to present his reports, and not that everyone is looking at this clock, because after half an hour later the board meeting is supposed to start, so we have to conclude our audit committee meeting.
Correct.
Absolutely, sir. Of course, completely aware, and I appreciate your point. So I think you're right, and I think one more heads up for everybody is that the internal auditor has to report to the audit committee chair. Still, there are many organizations where there is, of course, sort of indirect reporting into the CFO or anybody. I think there can be a line of reporting, nothing is wrong, but ultimate reporting is to the audit committee chair, which is again a part of good governance framework as well. Shifting gears, coming to the statutory auditors, I also wear that particular hat of statutory audit, of a statutory auditor. But of course, here I'm moderator. So I think my question over here would be, I think specifically to Kamlesh Bhai, who has seen both the sides, the auditor side and the corporate side as well, that the role of a statutory auditor is very, very important. As you rightly said, that significant reliance on the statutory auditor for true and fair view to give the comfort to the board for giving reasonable assurance. But then there are two aspects over here. There are independent directors, with due respect, who have limited understanding on financial reporting, internal control, scope of an audit, etc., who have unreasonable expectations from a statutory auditor, whereby they expect an absolute assurance. And definitely, with due respect, also, there can be statutory auditors who may not be in the best position to perform their duties diligently. And therefore, an oversight by the independent directors, by the audit committee chair is extremely important when it comes to interactions with the statutory auditor. A statutory auditor may also face his own challenges in terms of limited time, technology and tools not being deployed in the best possible manner. And therefore, these interactions with the audit committee and the audit committee chair, one-to-one sessions, again, are very important. Maybe Kamlesh Bhai, you may want to share your experience as the audit committee chair globally in some organizations and in India while dealing with the statutory auditors.
Khushroo, I mean, this is a very good question. And the first thing which I do when I join a board as an independent director is to develop a line of communication with the statutory auditors. I look at them as an extremely important, office, the statutory auditor's office, from the simple reason that they deep dive into the, business of the organization, and therefore, getting an external perspective for me as a director sitting on the board is extremely important. So number one, develop a good line of communication between the internal auditor or the chair or whoever you are, chair of audit or member of the board, with the external auditor. That's extremely important. Make them comfortable, give them respect, because I have seen many a times the chair of audit committee or the independent directors on the board do not even give respect to the external auditors, which to my mind is completely wrong. They have a very important office, they perform a very important function, and ultimately you have to give them, proper space and proper confidence that the board relies on them. And as a director, we rely on them. So that's very important. And what advantage we get with this communication channel is that there's an open dialogue and discussion. Many a times the statutory auditors also face some difficulties with the organization, which they are not able to spell out statutorily in, say, an audit committee or a board meeting. So all that I tell the external auditors that I'm always available when I sit on the board, number one. If I'm the chair of the audit committee, you have complete freedom to call me at any point of time and to discuss whatever difficulties we have. So that what happens is that as an audit committee or independent director on the board, I too get a proper perspective of what's happening, and you get to know who are the players and what's happening in the organization as well. I'm talking from a very positive point of view, not from a negative point of view. And so therefore it is very, very important that coming to the work of the statutory auditors, you must definitely rely on the work of the statutory auditor. Number one, you're supposed to see the performance of the statutory auditors as well. So once you make inquiries of the statutory auditors and the questions you ask to the statutory auditors, you get a perspective of what kind of value or what kind of work is being done by the statutory auditors. That confidence you get. At times, it could sway the other way also. So I'm again not talking negatively, and this I'm not talking from my Indian perspective, but from my international perspective. I sit on the audit committee. It's called Independent Management Advisory Committee of ITU, International Telecommunication Union, where the auditors went on and on and on, and they did not issue the audit report for a very long time. So I, as a chair of the IMAC, I had to tell them very clearly that, look, whilst you may take your own time and you're independent, and mind you, they are supreme audit institutions. They are not private sector audit firms. I'm talking of supreme audit institutions. So the perspective which I had to give them was that, look, financial reporting is very, very critical. One has to, come out with the financial reporting very quickly. And that the fact that they kept on lengthening the, issuing of the audit report is not good for anybody. not good for them, not good for the organization as well. That's one. Secondly, there was a lot of suspicion on which they kept on, working, which also is not good. No, I mean, I had to bring to their notice the auditing standards that if you're going to qualify a report or if you're going to give a qualified report, please lay down evidence. That what's the reason why you're saying that the qualification, there could be an impact on the financial numbers if that qualification is read along with your opinion which you're giving. So these are the kind of perspectives which one had to give. Coming back to say the Indian side as well, I mean, many a times the management is very hostile to the auditor. And this I'm talking from the point of view I have faced this as an independent director. At that time, it is very important that the independent director or chair of the audit committee gives full backing to the statutory auditors to do their work. And this, I don't want to name any organization, but I've faced this. And therefore, one has to really work with the statutory auditors and to tell them that, and even tell the management also, and get it minuted also if required. In the audit committee meetings, one can minute it as well, that please give full cooperation and give proper information to the statutory auditors. So this is sum and substance. So I would value the office of statutory auditor, most important players in corporate governance, number one. Number two, as a chartered accountant and as independent director on the board, I rely a lot on the work of the statutory auditors, and I get a lot of feedback also from them, a lot of ideas also from them, from the statutory auditors. So I will put it at that and hand over back.
Absolutely, thank you. I think very important messages for the fraternity, and I'm sure that they would be inspired with what you said. I think that gives them the courage as well to be bold and to be upfront. I think one typical issue that we face, especially in India, with due respect again, not in every organization, but in maybe 10%, 20% of the organizations, that it's very difficult for the management who may not appreciate the audit as a value add and perceive it as a stamp, as a rubber stamp from a compliance standpoint. So for example, if at all there is a restriction imposed from the management that you are going to be cutting down the charges and the cost of every vendor, an auditor is perceived to be a vendor. And therefore, if at all your fee was 100 rupees last year, we would like to bring it down to 80 because we can't afford. Now there are two firms. One firm is, of course, one firm would walk away, say, sorry, my costs are rising and I cannot do anything. The other firm may be at mercy of the management or whatever. But given the fact that there are so much of responsibilities imposed on the auditor, so much of liabilities and obligations, revised reporting requirements, you have enhanced Schedule 3 requirements, you have a new CARO, technology and tools in the audit, experts being involved in the audit, the cost of the audit is going to raise significantly. Sometimes I have seen that, as you rightly said, independent directors play a significant role in convincing the management that they deserve an increase in the audit fee. And sometimes, with due respect, the independent directors are quiet and say, "Arey yaar, ye to saab dekh lenge, Lala ji dekh lenge, humko nahi pata." That's the kind of an answer we get from the independent directors also. Maybe Kamlesh bhai, you or other panelists can sort of share what should be the process then for the statutory auditor and how should we take it forward and what kind of support they can get from the independent directors.
I think, Khushroo, if I can first, and I'll be very brief. Mr. Subedar, you want to go?
No, go on. Please go on.
Just give me a couple of minutes. I mean, I wear both the hats, as Khushroo has very rightly pointed out, and I completely understand the Office of Statutory Auditors and what are the kind of work which they do, what's the kind of cost involved, and what's the kind of responsibilities. And therefore, I'm very sympathetic to the Statutory Auditor's office in any organization. And as far as the audit fees, etc., are concerned, I am completely agree with you, Khushroo, that they cannot be straitjacketed with other vendors, which generally happens. But one has to really look at it in a very holistic manner. And given the cost considerations which the statutory auditors would lay down, go to the management and tell them to agree to the fees. And I have done so in many organizations in the past. Thanks. So Subedar, over to you.
Yeah, I just wanted to make an observation. I think around, when was it, 2014 or 13, when we had to change the auditors post the new act, I was quite surprised that one was asking for quotations and you had L1 and L2 in auditors. But it's just a side observation I wanted to make. Yes, I think one has to understand their cost structure. This is the last kind of cost-cutting measure which management should be looking at.
Thank you, sir. Bhavna and Nagesh, maybe your perspective, 1 minute perspective on this.
I think I don't want to take too much of time, but I want to just put it something on record and not as a matter of thing. I've seen the same firm for the similar kind of turnover of the companies. They charge totally different kind of fees, and there is no visibility of any kind on that account. I'm talking about the same industry, same statutory auditor, almost the same kind of sales and figures on that account, and same kind of spread on the thing. And you see a difference of even, I would say, something like 50% differences are there on that account. For which, then you get puzzled by that, but kind of things on to understand, am I as a chair of audit committee doing my job or not? For which I don't have an answer, but I thought I will just put that thing on the place. So that becomes number of times a reason for somebody to look at. I'm not saying L1, L2. We say get the best people who are shortlisted and then probably hammer one against another, which is not a bad deal. I know Kamlesh and Khushroo may not like that, but I'm now discussing about two able firms within which I am choosing. So I think there is nothing wrong, I feel, as a chair of audit committee. I thought I just place my view on that account. There's nothing right or wrong.
It's good to have a diversified view, and it's good to agree to disagree as well. So, which is great. Fine. Bhavna, maybe 1 minute of your perspective.
No, I agree with whatever has been said by Kamlesh and Mr. Subedar. But I really don't believe that we should be really negotiating with a statutory auditor for the fees, though sometimes some directors do feel that when we have two possible quotations, why not go for the lower one? And my question to the management always is, and to the other colleagues, that let's look at the quality first. Let's evaluate on that first. And thereafter we'll come to the fee aspect. But let's first assess and see whether they are at the same level. What are they bringing on table? So, agree.
Absolutely. Thank you so much. I think because we are running short of time and there could be a few questions coming up, I didn't want to miss out on a very important consideration, and that is, of course, cybersecurity and fraud reporting. So maybe I think Mr. Subedar, given the fact that you have been a part of the group over a long period of time where frauds is very distant that you would hear about, but maybe I think that particular group also had ensured that there is a effective fraud reporting framework in place and a good process in place. Maybe you would want to share some of your thoughts in terms of, what would be the responsibilities and the roles of an independent director to promote a good fraud reporting framework and to have a very effective oversight on that.
I think during my Tata days, I recall discussing with our finance director, and what is the one thing which would give the CFO the greatest nightmare, and that is frauds. Because we all of us who've been 30, 40 years in organizations have run finance and accounts departments with a few people, not necessarily the brightest, but who you could implicitly trust, etc. Now departments have become larger, IT is taken over. The youngsters obviously understand it much better than some of us gray-haired people, and fraud is, I think, a very huge nightmare. I mean, you see people who come across and win over your confidence, and all of a sudden you realize that the kind of fraud which has been done, and there are no easy answers to it. I mean, I cannot pontificate on how you will not ensure fraud, of course, of the various checks and balances and ensuring that none of them are lifted, because when you finally analyze the fraud, the answer is rather simple. I mean, how could you have missed that out? It's something which we learned in our first year of auditing, and Spicer Pegler told us what that is. But I mean, I really don't know. But I mean, this is a very, very major issue.
Yes, sir. Nagesh, a minute to you, given that we have other things to discuss.
I think there are only 6 points that I want to talk about, and that I call it as an anti-fraud agenda that, at a board level, we must keep in mind, especially for the chair of audit committee. One of them is organization has code of conduct and ethics kind of framework in place or not. Number 2 is, do you have a whistleblower policy in place or not? Because most of the things come through tips and these kind of things on that account. Sure. Third one is, organization has anti-fraud training including for third-party sensitization. Your vendors and also, your another value chain also is covered or not, that is important. Internal audits must do what I call snap audits or surprise audits. And then, of course, IFC, this financial control related part, there is always a fraud reporting. That also you have to take it seriously. And last but not least is employee job rotation is something which has to be encouraged. And I think these are some of the things, if at the board level or at the audit committee level, if it gets raised, I think a right kind of anti-fraud agenda will get set, is what my opinion
Absolutely.
is.
Nagesh, I'll give you 1 more minute. I think the topic on cybersecurity is gaining paramount importance. Independent directors and the boards are very, very particular about getting the cybersecurity reviewed, given the kind of international fiascos and quite a few fiascos happening. Other thing, maybe you would want to sort of, give your perspective about how often this particular review has to be done, either internally or by an external agency.
Yeah, I think fortunately for me, out of my 10 companies, 5 are regulated. So most of these regulators are insisting on this IT audits related part, which really helps in pushing the agenda formally and automatically on that account. But I think what happens is the awareness of creating this cybersecurity and IT related thing becomes a challenge in quite a few boards in that particular part. But I guess with this sort of cyber attack that are happening, and people are ending up paying quite a few to release their own systems and all of the things, that awareness is coming in. What is really important is you must have right kind of what I call, processes in place, where I call it, you have the right authentication in place across the organization. Then you have right kind of authorization in place. Who gets what kind of data is very critical on that particular part. And I think we have to also look at whether data espionage is happening or not, because we are sitting on quite a few big firms where you are sitting on huge data of people. Unfortunately, we don't have rules in India at this point of time. They are all bills and they yet to get implemented in the parliament. But if you have something like GDPR kind of European rules, then I am sure a lot of people at our board level will get uncomfortable on that. For instance, our insurance policies, car insurance policies, there are numerous calls you get. They don't even ask you which car you have. They are just asking you whether you have claimed no claim bonus or not. That means your data is already out in circulation. So I think these are some of the points at data level. It has to get discussed at the board level. Sure. Otherwise, we have and properly authenticated by IT audits. Otherwise, that thing will have a lot of challenges in future.
Sure. So thank you very much, panelists, for giving your valuable feedback and perspectives. I think there is one question on the wall which I propose not to take at this point of time, but maybe if at all, Murtuza, if it is possible, is it possible to take questions?
Mr. Subedar has raised his hand now. Khushroo.
Haji, sir.
Mr. Subedar has.
Yes, sir. Yes.
I could lose the opportunity of putting a counter view to what Nagesh just said about having documented code of conducts and other policies. In a slightly lighter vein, I remember I was a part of the core team which created the brand equity agreement for Tata Sons, which is still used to this day in all our companies, which came along with a code of conduct, a documented code of conduct. And in one of our sessions, I remember a young new joinee said very proudly, "Sir, now we have a code of conduct." And I cut down the guy, and maybe I was a bit rude at that point of time. I said, "What do you mean you now have a code of conduct? Now you have a documented code of conduct. This group has followed it for the last 90 years or 100 years, This over-reliance on these documented code of conduct and policies, etc., is sometimes, you create it to, in fact, to get over things,
Absolutely.
There has to be a balance in this thing. Sorry,
of course.
I took the liberty of taking another minute.
No, you made a very valid point, and this is a message I give it to my colleagues, I give it to my juniors generally, that there is so much of framework, there is so much of mechanism, there are so many procedures, methodology, so many ticks in the boxes. But as an auditor or even as an independent director, common sense, as somebody just mentioned at the beginning, just the sheer prevalence of common sense is most important. And A questioning mind with the highest level of skepticism is something that we should never forget, because the world is becoming more and more technical and the world is becoming more and more electronic. So still there is a human element, and I think we need to rely significantly on the human element. So if the Murtaza, if there is any, or maybe Piyush, if there is any question from the audience, we can take maybe one question or two questions, keeping in mind the time factor. If it is not, then I can, sorry?
One question on the chat box, I'll read.
I propose not to take that question.
Acha, okay.
I propose not to take that question. So if there is any question from the audience, then definitely we can take. Else, if not, then maybe I can give half a minute to every speaker to sort of, give a perspective about what is that one thing closer to their heart, which will enable prevalence of more effectiveness in the functioning of the board. What is it, something that they would believe that, will help them to enhance the effectiveness of the board?
Please go ahead. Yeah.
Kamlesh bhai, maybe you would like to go first.
I think looks like Kamlesh bhai has got logged out, I think.
Yeah, no problem. I think Bhavna, from your perspective.
I would like really transparency and the cohesiveness in the board. That will make it the most effective.
Thank you, ma'am. Mr. Subedar?
Yeah, I would agree on cohesiveness, but don't take me for granted.
Okay.
A combination of the two. We have to work as one in unity and unison, but at the same point of time, stand up to when you realize that information is not being shared.
Thank you.
That, this will not be tolerated. That's the message which has to be there.
Nagesh?
Yeah, I think I would like to refer to the book called What Got You Here Won't Get You There. That's by, Marshall Goldsmith. And I think at all times, at all levels, I believe at the board level and at everything, we need to continue to challenge healthily and be transparent and play as a team member. And that is something which is very critical because we are in it together. And that's kind of thing we must have on that particular thing. So a healthy board will keep on, looking at reviewing it, everything on that account, including the strategy and not the existing piece. And that's something which is critical. That's what I would say.
Thank you so much. I think I'll just take half a minute to wind up and then, of course, hand over the baton to Shweta or maybe to Murtaza. Thanks, actually, for giving a very candid perspective. For me, the messaging also would be that the role of independent directors is not just fiduciary, but it's also important to ensure that good governance is retained and higher standards of governance can be promoted, because these things ultimately will create a long-term benefit for the company and will enhance the shareholders' value. And yes, it is a tightrope that we discussed in the beginning itself. And as independent directors, you also have to balance out many, many things, keeping in mind the fact that the businesses also have to be run, despite the fact that there can be a flow of regulations, which will always sort of, prevent the businesses to grow. But even the regulators today want the businesses to grow, but at the same time would want those charged with governance to have a much more tighter oversight in their role as directors and independent directors. So with this, thank you very much, WIRC, Murtaza, and the entire team for giving us the opportunity. And my sincere thanks to the panelists as well. Handing it over to WIRC. Thank you.
Piyush.
Yes, sir. Thank you very much, sir. It is always a feast of knowledge to get an opportunity from the stalwarts like all of you. And I think I am also one of the fortunate person like all our participants to get an opportunity to listen from all of you, sirs. A very well moderated session by Khushroo sir. Thank you for that. And Bhavna Doshi madam, Nagesh Pinge sir, Farokh Subedar sir, and our beloved past president Vikamsey sir, all were very much grateful. We are all grateful for sharing of your knowledge and experience with us. And I thank from the bottom of my heart from WIRC on behalf of WIRC and the participants for accepting our invitation and sharing your knowledge with us. Thank you very much, sir. Thank you very much, ma'am. Thank you.
Thank you. Thank you.
Thank you so much. Thank you.
Thank you. Thank you so much.
Yeah.
Thank you, sir. Thank you.
So moving forward, I recognize the presence of CA Rahul Parekh, RCM, CA Chandrika Sridhar, faculty member, CA Sudhir, faculty, CA Virak, coordinator for the session.
Sudhir, good morning. Welcome.
Good morning. Thank you. Happy to be here.
Good morning.
So as yesterday, today is also perfect day. And as we have experienced from the morning, a deliberation, sincere deliberations from the faculties. Moving forward, we are going to have deliberation on standard on quality management, standard on quality and audit reporting, SQC1 from CA Sudhir sir. And I welcome CA Virak Shah, coordinator for the session, to introduce the faculty. CA Virak, are you there?
पीयूष सर आपको प्रोफाइल भेजा हो सर, उन्होंने ज्वाइन किया है सर.
Okay.
If you can introduce them and let us get started.
मेल पे भेजा है?
यस सर. सर मेल में चेक किया. आ गया सर, विराग सर आ गए.
Okay. Virak is here. Yeah, Virak, I'll request you to introduce the faculty, please.
Yes, sir. It's my proud privilege to introduce our today's second session speaker, Sudhir Soni sir. Sudhir Soni sir is a fellow member of the Institute of Chartered Accountants of India with more than 30 years of experience. Sir is a partner in the assurance practice of SR Bartley and Affiliates Network and was the national assurance leader until 2020. His sir has also served as an audit engagement partner for several listed Indian and multinational companies as well. There is a member of CII National Committee on Financial Reporting and CII National Committee on Corporate Governance. Sir is special invitee at Accounting Standard Board of ICAI. Sir has a great working experience at multiple organizations, initially 1988 to February 1999 at AF Ferguson and Company, 99 to 2002 at Arthur Andersen Associate, and since 2002, sir is with SR Bartley and Affiliates Network. So with this introduction, we welcome you, sir, on behalf of WRC and request you to take the proceeding ahead for our today's session.
Yeah, thanks, Virak, for that introduction, and I'm delighted to be here with all of you today. So the topic is, as you know, SQC1, and let me start by saying what is SQC1 all about. I think it is a standard which sets what is the entity level controls for an audit firm that should be in place. As you read it, whereas much of it is prescribed, you realize that so much of it is intuitive, and even if it wasn't written, it is something that we should be doing. I think we have to acknowledge that auditing is a risky business, and it is important that individuals and firms who are in the practice, this practice should recognize the importance that the financial community places to their attestation. So that is what this standard is all about, is what is that quality control that should be there in place. The AASB has brought out an implementation guidance for SQC1. This provides a set of illustrative policies and checklists that firms can adopt with or without modification. However, we all know that chartered accountant firms are of different sizes, different complexity. They have different types of clients that they serve, and different services that they render. So is it possible to implement a uniform set of quality control policies for all firms? The focus of SQC1 is on audit and related services. So audit and attestation type of services. And the question often arises when you hear, and as I will go through, one will say there are so many requirements. How can a firm, let's say there is a small firm or a mid-sized firm, how can they comply with all these requirements. I think, as I mentioned earlier, that auditing is a risky business, and the determination of what the inputs should be for the purpose of an effective audit is not what is the size of the firm, but what is the requirement to perform a certain attestation engagement. And so, for example, if you have a very large company that would necessarily need, let's say, a certain number of audit efforts in terms of hours or individuals to be involved, and if the firm doesn't have capacity to meet that, then it should review its client acceptance, whether they would be able to do justice to that engagement. I have seen over the last few years, many firms have built capacity through either consolidation in response to developments. One of the most recent examples is the changes that was made by the Reserve Bank of India in terms of the auditor guidelines. And that led to a lot of dispersal of bank audits. And firms have stepped up to that. They have engaged resources with experience. They've combined to see how they are able to discharge those responsibilities. So my point there would be that I think one has to focus on the outcome and not on the input. The quality control depends on what you are attesting and not what you're capable of attesting or your current size is. You have to step up to quality control depending on the nature of attestation you provide, because the markets don't distinguish between one audit opinion and the other. What this standard has done is, in a very structured way, introduced 6 elements which are important for the quality control in a firm. And the 6 elements, we'll go into each of these. They're just very quickly describing them is the leadership responsibilities for quality within the firm, ethical requirements, acceptance and continuance of client relationships, human resources, engagement performance, and monitoring. So those are the 6 elements under which the quality control requirements have been described. As you will all know that these are highly interrelated. It's very difficult to say that they are compartments by themselves. The quality of human resources impacts the compliance with ethical requirements. The acceptance of client procedures impact the level of risk that a firm encounters and what the level of monitoring should be. So these are all very closely interrelated. And very often when issues arise or quality issues arise, it's possibly a combination of these which needs to be addressed. It is important that these policies and procedures are documented. They are written out and are available to all the professionals, client-serving professionals in the firm across the levels. And it is also important that this document of policies and procedures is made available when peer reviews or quality reviews of a firm are undertaken. And so that's one theme which goes across all the elements. And so I'm not going to repeat that through the course of this discussion, which is that all the policies and procedures should be documented. That is one. And the second is that you need to retain evidence of compliance with these policies and procedures, which may be asked at the time of inspection. So I think that runs a common theme across all the elements that is there. So let's examine some aspects of each of these elements. And the first is on the leadership responsibility for quality within the firm. So the leader plays a very important role in setting the tone at the top. I think what is very important is what is the culture of an audit firm, and that is very much defined by leadership behavior. Having been a leader in an often audit function, there are typically 2 objectives that you face, and those are growth and quality. Now, there is often a sense that it is one or the other. That is, You either prioritize growth or you prioritize quality. And growth is important in a firm. Growth helps to meet the compensation aspirations of the professionals working in the firm, and also their expectations for advancement in their career. So growth is important, but it's not that there is choice between growth and or quality. Quality is important for the long-term survival of the organization. If one is only focused on growth, you may have quality incidents. It may actually question the very survival or existence of an organization. And that is why it would be very short-term thinking to place these as alternatives. I think they go hand in hand. And if there is a dilemma between growth and quality, it would possibly be very important for the leader to take the quality-oriented decision, because that is important for your long-term survival. That is also your commitment to public interest. I think we have to recognize why audit exists as a profession. We get our mandate from the law, and the stakeholders rely on the audit for performing the attestation function. And you provide trust and confidence to the markets. And if you let quality slip, then you actually not delivering the confidence that the markets expect of you. And every time that we have major incidents in the market, or where there are possibly audit failures or market failures, this question often arises: that did the auditors serve the public interest? And therefore, it is important that you have the right quality control in place, and set the right tone at the top within the organization in making these decisions around quality. So the way I'm doing this is I'm going to pick up some of the select policies. It's obviously not all the policies out of SQC1, but the way the standard has been drafted is it has 6 elements, and within each of the 6 elements, certain policies have been described. I picked up some of them to illustrate to you and share with you in those what my experience is, and how I feel we've addressed this in real life. So the first of these is that commercial considerations do not override the quality of the work performed. Now, this is somewhere in the same theme of what I have been saying, but in real life, you may face a situation where you have to take a contrary view to that of the company that you audit. And what is very important is that the auditor is able to provide the right degree of challenge and report objectively. I know it is easier said than done, and this can be particularly challenging if the client is a very significant portion of the revenue, or is from a fee perspective is among the larger clients of the firm. The institute already through the code of ethics has restraints on what should be the composition of firms, or how much should be the domination or concentration of a client in the fees of a firm, because that can really impair the independence. But having said that, even if that is not the case and it's not dominant, but if it's large fee paying client, there might be a concern around this. And I think what works best in these situations is if you have a robust system of quality control within the firm, where you're able to consult, you're provided the right constructive challenge, and if the firm comes together and agrees on a certain position, it makes it easier to stand by it than if it were to be an individual who was to take that position. So there needs to be this culture of consultation that is built into the firm, and such situations can be dealt with collectively by the partners in a firm. Another example of this commercial considerations, and this I find as a bit counterintuitive, is that should you do less work on an audit engagement if the fee is lower? See, the fees, as we know, in the country is often decided. One is it's decided before you get into the fee. In India, we typically have a fixed fee arrangement with an audit client. And if let's say that the fee is not sufficient and significant efforts are going into the audit, then there is a temptation to say, oh, we are exceeding budgets and so on, and therefore should we curtail work? And it's counterintuitive, because what it means is that the lesser the client pays you, the more risk you will take by performing less work. So the idea should be not to adjust your work to your fees. If quality considerations require that additional efforts are required to be spent on a client, then that should be done, notwithstanding what the fee is on that client. The second expectation of a leadership's responsibility, and there are two policies which go into this, is to establish the firm's QC system with the right personnel, and that you devote sufficient resources for development of QC policies and procedures. In my experience, the QC partner plays a very important role in the firm. Its position is generally, I would say, next to the managing partner or the leader of the firm. It would be that of the QC partner. He's the one who provides that constructive challenge to the practice, keeps drawing attention of the practice towards quality. In our firm, we call this person a professional practice director. Typically, it must be a person who is amongst the senior most persons, because must be a respected voice within the firm, have the right level of authority and ability to challenge any of the partners in the firm. And this department is typically staffed by, supported, the PPD is supported by technically good professionals in audit, in accounting, Companies Act, and also expertise across the different gaps that one might be certifying under. The professional practice group plays a very important role in developing the firm's response to recent developments that may have taken place. They are the ones who are consulted when there are complex topics being encountered. They also play a very active role in providing inputs on the quality assessment of individuals in the firm. They'll support on compliance with regulatory requirements such as CPE or registration requirements that are imposed from time to time, and also play a very active role in training activities. So the kind of hub of many of the quality control activities is this, what the standard calls a QC partner. Different firms have different designations, but clearly there is a need to identify an individual and provide the individual with appropriate team and support, depending on the size of that practice, to monitor quality control in the practice. The other major role that is played by the leader in a practice is that of performance evaluation, compensation, and advancement, including incentive systems. And so again, this is one of the common areas. There is a dilemma. And let's take the case of, if you take the example of, let's say, a partner who's very successful in commercial considerations of their client, got the right fees, got great efficiency on the engagement, and has negotiated good fees increases, has been able to expand the size of the practice. And the same individual, but has a poor score on, let's say, the monitoring of their engagement, and the quality scores are low. So how do you deal with this dilemma? You know, so the partner, when you do the partner assessment and the leader has to make that call at the end of the year, what is the message that you give? Because here you have an individual with success on a few parameters, maybe the growth aspects of the firm, but has not got an equally good record on the quality aspect. And it is in this sort of a dilemma again, where the leadership has to demonstrate their commitment to quality. And as I mentioned, in a professional services firm, quality is paramount. This must be given greater weightage over commercial considerations, both, as we said, in making decisions, but even in making compensation decisions for partners and advancement decisions on partners. And I've known of instances in firms where partners have not been promoted, or individuals have not been promoted because of quality related issues, because that would have then given the wrong message to the practice to say that it's fine to cut corners, and when you are in a risky business like audit, you don't want to do that. There are many ways in which leaders can communicate the policies and procedures to the practice and how this tone at the top gets communicated. There are very often town hall meetings. There is internal communications that are sent out. There could be leadership messages being sent around quality. Through the performance assessment process, this communication can be done. So no opportunity should be spared to give a quality related message to the practice and emphasize how important that is, because it is this repeated communication that kind of develops the culture within the practice. So I think that is about this first element of leadership responsibility on the for quality within the firm. The second is ethical requirements. Ethical behavior and integrity are a very important element for individuals and firms. And there are a number of, again, the standard puts out 4 or 5 ethical characteristics that should be there around objectivity, independence, integrity, and confidentiality. And I'll take a few examples of some of those threats which are perceived to independence, and some examples of where ethical behavior needs to be demonstrated. So one of, and these are described in the standard again in different ways as self-interest threat, self-review threat, advocacy threat, familiarity threat, and so on. So the first of them, if, for example, is financial interests. What are the nature of financial interests? And this is again, now for all of these, well, I'll deep dive into these. Firms have to establish procedures to see that these interests are identified, they are declared by the concerned individuals, and then appropriate action if required is taken. Also, firms need to provide information. For example, if it's a large firm with many clients, then which are the clients of the firm? That should be easily known to the partners and the individuals in the firm, so that before they enter into financial interest, they are able to check with these databases or lists that they are there. Our firm has a very elaborate IT system which allows you to determine the clients which are there, and the entire tree, family tree of the client is maintained and kept up to date by the engagement team. And when I say the family tree, it's the holding companies, the subsidiaries, the associates, the joint ventures of every client which is there is all kept available, so that team members can check before they enter into any relationships with these sort of with these entities. And the firm's software also allows for people to report their interest through the system. It depends on the size of the firm, but whichever technology or process is appropriate for the size of the firm, that should be kept in place, because this is one issue that you don't want to fail on. The Companies Act, for example, has a very strict rule on if you hold shares in a client company, then there is determined to be a casual vacancy in that case, or you're automatically deemed to have vacated office. And so you cannot take a chance that you have a partner who's investing in an audit client. So the first is financial interest. These are typically investments and loans that you may have with companies. And these are prohibited with audit clients. You cannot have investments or loans from audit clients. Issues do arise on grandfathering, and there are rules around that if those loans were taken earlier and so on. But the Companies Act doesn't have grandfathering, and so you can't have outstanding balances above a certain amount. So for example, if you have a housing loan with a certain bank, and the bank becomes an audit client, then you may probably need to move your housing loan around. I don't think you have a grandfathering clause over there. Similarly, there are transactions you do in the ordinary course of business, but they come to attention, not small transactions, but let's say that you're auditing a real estate company and some of the partners are buying property over there. Now that may not be restricted if it is an ordinary course and arm's length, but the fact that your auditors puts you on an enhanced observation for arm's length, and the second is that of having any outstanding payments beyond due, you can't have those, because that would mean you have compromised independence. The second issue is on independence relating to the scope of services that can be provided. And at times you see, there are times when there is a genuine. So firstly, we do understand that the Companies Act has a restriction on what can be done and what can't be done. So I'm not focusing on what can't be done as per the Companies Act. Those obviously should not be done, like things like bookkeeping and valuation services, internal audit, IT implementation. But even within permissible services, one has to be careful. And very often companies may ask the auditor, because he's the best position to do, is to help them with, let's say, a due diligence or with some process review to make recommendations, which the company will address. At times, companies may propose that you join them as, that the auditor join them in, let's say, an internal, what you call project management team, or they would propose that you join them for a panel. Let's say they are meeting a new CFO and want you to join the panel, or the evaluating an IT solutions provider and say, can you, just sit with me? That may not even be a service. All of these are not permissible, should be avoided. It's not sufficient just to be independent in by the letter of the law, but it should also be by perception. And you can't be seen as being part of management or discharging any management functions, even by perception. Other interesting situation I face sometimes is when an engagement team member is engages in an employment discussion with the client. And I would expect that engagement team member should immediately alert the engagement partner that they are entering into such a conversation, because you can imagine that you're auditing a company and at the same time entering into a discussion for employment. That's a conflict, and may impair your ability to perform that audit. In my experience, the moment I've heard of these, I would withdraw the engagement team member immediately. And if we find that information has come in a delayed manner to you, and the conversation has been on for some time, it would be best to have that work either reviewed or reperformed, depending on the circumstances and what that work involves, to see that you have managed the risk that is there. The other is the risk of long association. And one of the questions that we answer when in my firm I answer these independence questions is, have you been on a vacation with a client person? And again, things like this they're not written, but it's clear implicit that these things may impair your independence or objectivity if you're too close to a client. And I think I believe that as auditors, we often sit in judgment, and the behavior that is expected of auditors is one that is objective, seen as being impartial, and even how you behave in the external world, particularly in client relationships and all that, you have to be seen as being independent. And if you're seen as too close to a client, these things often are perceived, at least, that you're not acting independently. Similar questions come up on gifts and hospitality, and gifts which are normal within accepted social norms in India, those sort of things are fine. But at times you receive gifts which are very expensive, and you feel that would not be appropriate. I think firms have policies around this. We would just return gifts which are expensive and beyond what one would say is normal business practice. The other risk is of intimidation by the client, and that creates a threat to independence also. Very simple cases where, for any reason, if there is a legal case that is likely to be, or a litigation which is either likely to happen or is threatened by the client against the audit firm, that's a very clear case of intimidation. And I think immediate need to review your audit relationship. But sometimes it can be more subtle as well. For example, the client requests you for a change in the engagement team member or the engagement partner. And I've dealt with these situations, and I think one has to be careful. I would not say that the answer is it should be strict no. Sometimes there are issues which are purely on chemistry, and there might be reasons where it may justify it. But at times it might be just because an engagement team member or partner is taking a tough position on the client. And these are not, again, there are no easy answers here, but this must be evaluated and ensured that it is not seen as having been intimidated by a client. And we've seen some global cases actually where the engagement quality or the consultation partner was changed, and this was picked up in the litigation that happened in one of the global cases, and that obviously didn't reflect well on the firm. And the last thing I would like to talk about on ethical requirements is around confidentiality. And I think this is so important. It is very often assumed that professionals within the firm are sensitive to confidentiality, but increased use of technology, the stricter insider trading rules, these all make it very important to see that confidentiality is messaged, monitored very closely. We had an interesting, I think, a case in the public domain of engagement team members using their Gmail accounts to exchange information, and this was queried by the regulator. Eventually, they did determine that it was used only for official purposes. But the risk with using Gmail accounts is that there may not be sufficient security. Maybe family members have access to that. And so we have a policy of very strictly saying all official work must be done using official email addresses. But this is certainly one risk which is there. And so firms need to constantly message this in the training and others to personnel. The third element is acceptance and continuance of client relationships. In my view, this is perhaps one of the most important factors in ability to maintain quality control. If you can, at the doorstep of your firm, see that you have the right clients walk through the door, I think a lot of issues on quality become easier to manage. And generally, we look at two perspectives in determining the client risk, which for a client that comes in, and one is the what I would call the risk of the client, which is integrity and so on, and the second is the commercial factors. And if I just delve a little bit into the risk, so for the purpose of evaluating risk on a client, you look at the client integrity. With a lot of data now available in public domain, one can see what regulatory actions may have been taken against the company, what is the type of litigation that they are involved in. One can review their financial statements to see whether any of the accounting positions they have taken are aggressive. You can do many background checks now from public data. Some indicators are top management attrition, if there are going concern issues or indicators that going concern may be an issue, existing ICFR qualifications, any restrictions imposed by management. I remember one company which we met many years back, and they said, yeah, we will, but we don't prefer you to meet certain personnel of the company. And, those sort of restrictions, I think one needs to be cautious about, and one should expect as auditors unfettered access to management and to all records. The second thing in risk evaluation is your ability to serve, depending on the availability of personnel and competence of people that is there. Again, some industries have specialized requirements. I mentioned earlier about financial services, might be other industries, telecom, others, where you need to have good understanding of the regulation to be able to do a good audit, which is there. And of course, independence, which we just discussed. So all these need to be considered. Now, the other thing also is timing. At times, you may be approached too late in the year for acceptance of an audit. And I find that also sometimes to be worrying, because then you're not able to perform certain procedures at the right time. Or and I've seen companies which approach after the year end where they want to change auditors. And I would be very cautious in accepting at that point of time, both from the reasons why the company is going, and also at the same time for us to be able to do an audit just after the whole year is complete. So it depends again on the size of the organization and so on. And the second aspect of client acceptance, as besides the risk evaluation of the client, is the commercial factors. And one may wonder that is that a good discussion to have in the context of quality. And we believe there is a very strong correlation between commercials and quality as well. And if the fee is unreasonably low, there would be a tendency for the firm to try to see that you like each engagement to be reasonably profitable, and therefore either you find that the engagement team generally doesn't spend the right time, or they don't book the right time on that engagement so that it reflects appropriately in the evaluations and so on. So I think it's very important to see that the commercial considerations are also taken care of, and at least from that it is sufficient and the remuneration is sufficient to discharge a high quality engagement which is there. And the other aspect is discontinuance. You see, it's not always possible to prevent company from walking in through the door. At times, with all the evaluation you do, you may still have an engagement which slips through, and eventually, as you go deeper into it, you feel there are facts that you were not aware of at the time you accepted the audit. There might be those facts which are discovered, and doing a good quality audit, often you should be able to identify more topics or such issues when you get into a company. If they are very serious, of a very serious nature, say the classic response is that should you discontinue the engagement. But I think here again, it's a question of public interest. It's not easy to walk away from a client. We've all seen the high profile nature of certain exits and how the regulators have made it difficult to exit an audit client, and there is a reason for that. So particularly, for example, if you're auditing a listed company, you are appointed by the shareholders of the company, and you cannot part ways by a discussion merely with the board or promoters or the management. And you have an accountability to report to the shareholders. And if you are still not able to issue an audit report, you owe them an explanation in detail as to what are those reasons that you are not able to perform that engagement. I think the society would expect that from you as auditors. Moving on to the fourth element, which is human resources. And what the SQC suggests is that you should have a talent leader within the firm, could be a partner, could be a senior professional who looks at human resources. Among the suggestions are, one is to evaluate what is the need of personnel that is there. So the typical way one works around is as part of your planning process to determine what is the number of clients you have, what is the effort that is required to serve your current clients, what is the likely attrition that you're going to face both in clients and in people, and therefore come up with a kind of a talent plan that you have as to how many people do you need and what is the level of supervision that is required for the people. And so accordingly you determine the levels. So for example, if you, and this is an example, if we say that we are doing a practice of 1 lakh hours and each partner can serve 20 or 25,000 hours, then you probably need 5 partners in that firm. And so you go down and let's say each partner supervises 10 or 15 people, then you need about 75 people. And within those 75, you need some managers, some executives who are qualified, and some interns or articles in the firm. So that sort of a planning is required. You also need to determine your need for specialist resources. As we know that with most companies now, technology plays a very important role, and it's important that the audit team has access to people who can evaluate the IT systems of the company as well. So those are important to determine as part of the plan. And then you go about the process of hiring, and the standard suggests that you should set up certain protocols around hiring and so on. Again, I think these are principles, and each firm naturally has to find its best way of going about that process. The objective being to see that you have the right level of resources that are available to serve a client. Then on human resources, one of the policies states that the firm assigns the responsibility for each engagement to an engagement partner. And I emphasize on the word "an" because NFRA has picked on this in one of the AQRs and said that there should be a clear leader identified for each engagement. And so it should be 1 engagement partner and not 2, whereas that may be debatable. I think the whole objective is that it has to be, there has to be a very clear accountability for the person who finally leads that engagement and takes accountability for the quality and sign off that has been done for that engagement. The other important aspect which the policies describe, and the way the policy is worded, it says personnel participate in general and industry specific CPE and development activities, like today is probably a CPE program. So training, in my view, and again as a leader of the practice, I spent a lot of time with our training function in the practice. The training, we had a dedicated team of 2 or 3 people who managed the training activity. But training was essentially delivered by firm professionals, which I think works best because there are people who understand the firm's culture, understand the knowledge. But at times you may need external experts also, particularly when there are knowledge gaps or the internal teams are too busy to be able to perform training. But I believe a high quality training function actually proves to be a good attraction for talent as well to join a firm. Many of the people joining audit firms are youngsters at the start of their career, and a good training or a good grounding in the profession is certainly something that they value. We looked at training content, which was part of a training plan that we prepared, both soft skills and technical skills. Soft skills is around time management, around communication skills, and technical skills would be around all the technical topics of auditing standards, accounting standards, sometimes specific gap. If someone is doing, for example, a US engagement, then you need to also learn PCOB standards, and the SEC has certain requirements of training that they expect people to have in place. We also consider as a firm the meeting, both meeting participation requirements, which was set out into individuals' goals as an expectation, as also delivery. So for certain senior partners or managers, it was expected they would also participate in delivering training, and both were considered in the context of performance evaluation. One of the mantras I've learned is that what gets measured gets delivered. And so very often some of the things which are very critical need to be linked into performance assessment of people. And it is also good for partners in the firm to both participate in the same training as maybe some of the other people are there. The rub-on effect of having a partner present in the training or a partner delivering the training is very strong, because it is again reflects on the tone at the top of the organization as to how important these activities are. The fifth element I will talk about is engagement performance. That is how you execute the engagements. Whereas the whole, whereas we have a whole bunch of auditing standards around this, the SQC touches on some of the high-level aspects of audit execution. And the first of which is that planning for engagement meets professional, regulatory, and firm requirement. In my view, this is probably sometimes one of the most, it is in my view, one of the most important aspects of what will drive audit quality, but it is also something which is very often not done right. And I think this is one where there needs to be a lot of focus. One of the practices which I found worked best was, first is that you have a team which collects data. So you don't start planning on day one. You spend some time collecting data and information around the engagement, and then you do a planning meeting sometime after you have done that. This planning meeting works well when you have all the engagement team members present. You have done some preliminary groundwork for that, and you debate and brainstorm what are the key risks that are there. You debate the fraud considerations, the risk of management override, how you will use technology in this, what will be the timing of the procedures, and you agree with the budget on what is the kind of time that you will spend on that engagement. And it is very important that the engagement partner and the senior people in the team are involved in this planning process. It should not be a tick the box to say that this is something we need to document, but that is the time when the partner gives mindset. You know, gone are the days when I remember in the long back, when I probably used to do articleship and others, that the partners typically came in at the end of the engagement or a few days before the sign off, and they would provide all their guidance and wisdom at that point, which would be a huge stress for the companies and so on. I think those days are gone. It's now expected that you would have well anticipated what are the risks that are originating out of developments in the company's business, about changes in regulations, based on your knowledge of past engagements. Bring that all upfront so that you can plan an engagement well. The other policy is on, and what I will do is I will speak for only another 5 minutes. I'll complete the elements, and then I'm happy to take questions from you. So on the other thing is on engagement teams should complete the assembly of final engagement files on a timely basis. This is one of the policies that is being prescribed. Again, very important. Someone gave me this line the other day, and they said that what you document is evidence in your favor, and what you don't document is evidence against you. And I think that was a very powerful statement for me. And I know that a lot of emphasis is currently being done on documentation, and it's also sometimes frustrating because we typically like to do all the intellectual work, but we don't like to put all of that down on paper, or we don't have that discipline at times to put it down on paper. As I mentioned, I think it's very important. We are becoming a more and more litigious society, and very often you will need to defend the work that you have done. And it's very important to be able to demonstrate what is the mindset with which you performed that work. And if it shows that sufficient skepticism was applied at the point of time and planning was done, and then I think you can have a strong defense that you performed a good quality audit. And we all know that audit cannot detect every single issue, but did you follow the right steps towards that? And did you make all the right efforts in discussing fraud risks and so on? Again, mechanically, sometimes fraud risk, people identify only one risk as a fraud risk, but that may not be correct, only revenues or something of that sort. So there needs to be a strong challenge within the team as to what are the fraud risks that exist. And on the engagement file, the other observation very often is many people treat the engagement file like, we'll put it all together at the end of the job and we keep pieces of work in different parts of the place and all that. I think increasingly that creates two issues. One is that people who look at the files then wonder whether all the evidence was available to you at the time you signed the opinion, if some of those papers seem to have come in too late, or that was the engagement really done properly, because everything seems to be too bunched around the date of signing. And I think one of the best practices is to document online and as you go along. And that's, I think, something we have to build as a culture within our practices and training that we give to our individuals, is to say, whatever you do, for example, you've done a planning activity, then and there, complete your planning memorandum and sign it off to say, this is what we have decided. And these are live, can be kept as live documents. You can change them later. There's no hard and fast if new developments happen. But to say that we will put all these documents together only at the end does not give that the nature and timing and extent of the procedures was determined appropriately at the right time. So that plays a very important role in external reviews as well. The other important thing in engagement performance is the engagement quality reviewer. The SQC1 expects to have a quality reviewer in place. And this is again a very important function where another partner in the firm, who typically does not have the client face or the relationship, acts as an engagement quality reviewer. And he provides the right degree of challenge on judgments that are there, brings his own experience, his or her own experience to the engagement. And I think what is important is to select which are the engagements which should be subject to an engagement quality review. Typically, all public interest entities are subjected to that, but at times there might be other matters which, for example, if there's been a whistleblower or something else, then also you may decide to introduce an engagement quality reviewer into a particular engagement. Important to select the right individuals, and most critical is to see that the engagement quality reviewer is consulted in time, because very often is consulted at the last minute, which doesn't give sufficient time for the EQR to do justice to the job. And lastly, the last element is on monitoring. And this is, I put in my notes, it's what I call auditing the auditors, to see that did they do everything that they were supposed to do. And again, just like when you audit companies, you can only do samples. The same thing works when you audit the auditors. You need to decide which are the engagements that you will select to perform a quality review of. You should ensure that you cover through a cycle all the partners in the firm who are performing a test function, and also cover engagements where there are possibly, as I mentioned earlier, whistleblowing, or there are allegations of wrongdoing, or where there has been media attention. Maybe some of those engagements also can be covered as part of the monitoring. The deficiencies that are identified in the monitoring should be examined, communicated back to the engagement team. It also becomes a part of their performance assessment process, with, of course, the right judgment to be applied on how it should impact performance assessment. And if there are firm-wide topics, and this happens sometimes where there are some issues which as a firm probably are not handled well or not supported well, then that should be considered by the leadership of the firm to see how that is remediated going forward. And it's this all exercise is called performing a root cause analysis as to what are the deficiencies that are coming across, what are the common themes or deficiencies that internal quality reviews are throwing up, and to see that an improvement plan is put in place. It is important to document all these quality controls that are performed. And one last point I want to make is on not ignoring whistleblower and allegations. I think I mentioned this earlier also, but in my experience, sometimes and you don't always wait for formal. So you may have your own ethics hotline or some manner in which whistleblowing happens, or it may be a casual conversation where someone tells you, this, I think something like this is happening on your client, or you get some third party or external market input. I would advise not to ignore that, is to discuss it within the firm with the engagement partner and to see if an audit response is required. And firms may do well to actually provide even staff and individuals an opportunity to surface such any issues that they feel uncomfortable about, by creating a good speak-up culture to see that these are drawn to the attention of the leadership of the firm if they feel that there are topics which they are concerned about. So with that, I will stop here. I think there are about 10 minutes, and we'll be happy to take any questions. I should have done this at the beginning, but let me now thank WRC Murtaza for inviting me to this session. And as I said, it's been, I'm really happy to be here. Let me check the Q&A.
Really?
So actually, Sudhir, the first question appeared to be for the earlier panel, but I am sure you can also handle that. So if you're okay, I can read that. The company seems to be hesitant times to disclose frauds that they have noticed to auditors and independent directors. How can we deal with such situations? Not related to this topic, but.
Yeah, I think this is now not a matter of choice. And if you see engagement letters, at least I know our engagement letters, we put this very clearly that we expect companies to disclose frauds to them. I believe there is a statutory obligation on the company to disclose the fraud. The question sometimes is on timing, but the best practice is that the company should disclose a fraud to the auditor at the same time that it discloses it to the audit committee. And it is incumbent on them to do that. That's also a representation that they provide to you. And if you believe that company is not doing this, there are such topics, then I think you have to evaluate client continuance, because you are in a high risk situation if a company is hesitant to disclose. It's not a choice that they have, they must disclose.
Thank you for that. I think the second, in case of independence, if the client business is to grant a loan, even in that case, loan has to be repaid if such client becomes a client but has granted loan earlier in the normal course of business.
I would just say out of my own experience, unfortunately, yes. And that is a risk that you run, because you cannot be seen as being a credit risk on a client book, so it has to be you, even with banks, if you become auditors, and I think both the ethical guidelines as well as Companies Act, if I'm not mistaken, sets a 5 lakh rupee limit on how much receivables your firm can have. Actually, that's also not for partners. But I guess you cannot be in this situation. It will be seen as compromising independence. And therefore, at the time of when you are accepting, there is always a time lag between your formal appointment and your communication that you'll be auditors. Companies have to scrub all these situations and find, do you have these relationships which may need to be terminated before you become auditors.
Right. I think for the next one, I think the last one here, does SQC1 formally have any significant role in peer audit also, where in the peer auditor firm may also review and comment SQC1 compliances by peer audit auditing firm?
Let me just, the first one I've understood. Let me see the second one is, does SQC1 formally any significant peer also? Yes, of course. So the peer audit firm will actually expect to see the documentation of the policies and procedures that you have made pursuant to the SQC1 requirements. That is one. And the second is they will expect to also see documentation which shows that you have complied with those policies and procedures. So those last two things which I mentioned around monitoring procedures, engagement procedures, all of that, or even client acceptance, the kind of documentation that you do on client acceptance. So all that is very nicely given in the implementation guide, and the peer reviewer is likely to ask you to see those documents.
There is one more question, I think.
Yeah. I think Kozima has a question. If you can unmute him, he wants to speak. Yeah. Okay, 1 second. I think there's one question. When you do that, Kozima's, for small companies, SQC1 shall also have to be mandatorily applied, or some relaxation is there? I don't know, when you say small companies, are you talking of small firms or small companies? Because the SQC1 applies to firms. And as I mentioned earlier, that you have to customize SQC1. It acknowledges, SQC1 acknowledges that the response may be different for different firms, but as I mentioned to you, that it depends. So if I'm let's say Sudhir Soni as a proprietor and I'm auditing just some private companies, then I will form my quality control procedures to respond to that sort of my client profile, and that should be fine. So there is no relaxation in SQC1, but there is what I would call a possible adaptation of SQC1 to your situation. So for example, if I have only private companies, I may say I don't want to have an EQR there. It's not necessary to have that EQR mechanism in place, and I think that would be perfectly fine.
Fair enough. Thank you, sir. I think Mr. Anandwala had a question, but so Mishraji, can we unmute?
We are trying.
Right.
To Mishraji, he is trying.
Because I think this is a webinar format, so I'm not sure whether.
Yeah, I know.
We can.
I think he's typing the question, so then that's fine.
We have done this one national conference in capital market on 27th and 28th August. Saturday and Sunday.
Hi Sudhir, hi Rahul.
Yes,
hi,
sir.
Shweta.
Welcome. How are you, sir?
Good afternoon, sir. Good afternoon.
Good afternoon, sir.
Hi.
Sir, we are just wrapping up this session, then we'll start with the others.
Yeah, I'll put myself on mute. I was thinking so, but there was some gap in between. I just sort of buttoned to say hi to all of you.
No issue, sir.
Hi, Nilesh.
We're actually waiting for one question.
Well, hi, this is Kozema here. I think I have been able to join because you've given me the permission to do so. Thank you very much. Sudhir, it's a pleasure to hear you always, and nothing more important than SQC. But here the question was that we're talking about SQC when we are actually in July of 22, and December of 22 requires ISQM1 internationally. So where would we be as far as India is concerned, dealing with transnational audits and international audits and those type of activities? Because I think that is the requisition from which you already have, you are aware of, Sudhir. So just wanted to catch up on that first with you.
Yeah, no, that's a great question, Kozima, and you're absolutely right that SQC1 in fact was announced in 2009. So it's kind of been around for many years, and the new ISQM1 will come into play in December of this year. I must admit, I'm not sure on the application date for India, what we are doing as an institute on that. But you're right that for global companies which are being served from India, already ISQM1 will apply from the end of this year. What it does is, if I maybe take a couple of minutes on ISQM1, I think is it increases from 6 elements. They have covered 8 elements, and the ones which they have enhanced are those around the firm's risk assessment process. It expects to have more formal risk assessment process. When I mentioned human resources, they have now expanded human resources. They've now called it only resources And they cover human, technological, and intellectual, which, as we will all agree, that it's very important that how we can use technology better in audits. I think that was, in fact, probably missing also from the whole of SQC1 discussion. But the IT enablement, I think that is now very specifically discussed. And monitoring and remediation, there is a lot of focus on the remediation process that is going to be followed, and how the quality objectives are determined. So I think it's, as I said, Khusam, I think it's a good question. It will need firms to relook at their risk process, relook at how they identify what are the priorities for the leadership of the firm and the quality control processes in the firm, see that the processes address those. And, if I take one of those questions earlier on a small company, so I think each company will have a different risk assessment. So small companies can have, lesser risks or different risks than maybe large firms. So there will be more tailor-made responses towards that. And it also acknowledges the use of networks. So there are some specific requirement around networks of firms also, which is there. So I agree. I think it's time we start focusing on ISQM1. Maybe, Murtuza, next time you can ask me to speak on ISQM1. And I promise you I will learn more about it and come.
But the date's not done from an ICAI perspective, right? We haven't yet come with the date. Am I right, Murtuza, or anybody at the ICAI?
Not yet, yeah. Not yet.
And Sudhir, just one passing one, you did mention about the, case when an appointment of an audit firm happens, and then you happen to be the, have taken loans from that organization, because housing is supposed to be the most important thing that happens, and it can be whether a partner or all the managers down the line, and it can also happen with the bank when you become and there are relations of salary accounts, which all of them have salary accounts, with banking accounts with the firm. I think on those parameters, shouldn't it be okay? Because if we believe that those are at arm's length always, and these are not going to in any way rigor onto the aspect of you being the auditor, because those are normal activities of the bank, how would you take that into consideration?
Yeah, Khusama, that should not be a problem. So if you have a normal salary account, as long as you have what I would call a debit balance with the bank, that's fine, but you can't have a loan from the bank. So basically you shouldn't represent a risk to the bank. But otherwise, if you have a savings account, salary account, and you don't have any dues to the bank, in my view, that should not create an independence issue.
Thanks, Sudhir.
Sure. Thanks.
Thank you, Mr. Anandwala. And so I think we have all the questions have been dealt with. So I would take the privilege to propose a vote of thanks to our faculty, CS Sudhir Soni. Sir, I think you have very in great detail you covered SQC1 and audit reporting, and have also very capably answered all the queries that have been put forward. So we thank you for sparing your valuable time, sir. And please accept our heartiest thanks from WRC at the Thank you very much, sir. Thank you.
Thanks a lot. Thanks to all of you.
It was a great session. Thank you.
Sure. Thank you. Thank you.
Friends, we will be starting with the second session immediately. We now have CA Nilesh Vikamsey, sir, our past president ICAI, who will be chairing this session, and we also have the faculty for today, CA Chandrika Sridhar. So the topic for the session is basically an NFRA rules, and I think that's topic which is assuming more and more importance. It has been NFRA has already been a lot of new. It is already in our minds on the backside and on the top of it right now. These days it's a hot topic, and I think for members these are some very, very important rules and developments which I think we'll know more about it in the coming session. And especially people who are doing listed firms audits, company audits, it would be a very, very informative session. So I would not like to take much of time further. Murtazaji, you would like to give
Rahul, one clarification. Those who are not doing listed companies also let them continue to attend.
Oh, very true, very true.
Very important, yeah.
Yes. Any opening, Murtazaji, any opening remarks from your side, sir?
I will immediately let.
Fine. So then I'll request our coordinator, CA Virag Shah, to kindly formally introduce Nilesh sir and the faculty, Chandrika madam. Please.
Virag, mine should be very brief.
Yes, sir. Yes, sir. Sir,
Most people know me. Yeah.
Everyone is knowing sir, and sir's profile is also running into 4 pages. So I would like to inform about the present activity only, or the present post only. So sir is a senior partner at KKC and Associate LLP since 1985. The firm is from 1936 and more than 80 years of experience in the auditing, taxation, business management, consulting services, due diligence, valuation, inspection, investigation, corporate and personal advisory services. Sir is a member since 85 and sir is still learning. Recently in 2021, sir has done a certificate course on forensic accounting and fraud detection as conducted by Digital Accounting and Assurance Board of ICAI. So it is very inspirational, sir, after become a president and now past president, and still you are learning. So as a young member, it's great for us as well, sir. Sir has done Diploma in Information System Audit in 2003 and Business Consulting Study course of Bombay Chartered Accountants Society jointly with Jamnalal Bajaj Institute of Management in 2000-2001. Sir is a professional and social activity. Sir is a presently member at a co-opted member of the Expert Advisory Committee for the Council to year 2023. 2022 and 23 at the Institute of Chartered Accountants of India, working group to review the role and eligibility of a sponsor of a mutual fund of a Security Exchange Board of India, SEBI, Advisory Committee on Mutual Fund of SEBI, nominated by central government to the Board of Governance of the Arun Jaitley Institute of National Management, erstwhile it is National Institute of Financial Management, NIFM. Sir is also a core group member at BCS, Managing Council member at Chamber of Tax Consultant, West India Council of Indo-American Chamber of Commerce, Advisory Board of Black Soil Group, IC3 Institute of and Mentor My Board. And sir is holding a directorship in more than 10 companies. In the past also, sir has held a directorship in more than 12 companies, and also holding a position in IFAC, which is a global accounting body, and many other profile we can see on LinkedIn and also on sir's website as well. Now I would like to introduce our today's faculty of the session, Chandrika ma'am. Chandrika Sridhar ma'am is a member of Chartered Accountant and has over 20 years of experience providing assurance services to Indian and multinational companies across the country. Ma'am is engaged in large and complex audit, including PCA, OB, quality reviews in the manufacturing, financial service, consumer and construction businesses, and has facilitated various training programs as well. So with this brief introduction, we welcome you, ma'am, and we welcome our chairman for our today's session, CA Nilesh Vikamsey, sir. So over to you, sir and ma'am.
Thank you, Virag bhai. Thank you very much. May I now request Nilesh bhai to kindly provide the opening remarks as the chairman of session, sir.
Yeah, thanks. First of all, let me compliment the WRC led by Murtuza, Rahul Parekh, the Regional Council Member, Secretary Shweta, for organizing this, 2-day national conference on company law and corporate governance. The reason I'm saying I'm complimenting is I just put my own experience. I was an expert in company law before the 2013 Act, when the 1956 Act was there. You name the section 58A on deposits, 197, 297, 370, 372, 372A, all the relevant sections, and by heart, and any client asking me anything, and I used to respond. But that is not the case, not only for me, and I believe most of the chartered accountants. I think we have given up quite a lot of the company law side of our practice to the practicing company secretary, be that as it may, we let them do the compliance. So my word of caution to our friends who are listening and through them to the other members, please be careful before you respond to any query of your client on Companies Act. And I'll tell you the reason. The earlier Company Act was hardly amended few times, from 1956 till 2013. Very, limited, I would say, amendments. But the 2013 Act, I had a last count somewhere in 2021, in June 2021, May, June, I was speaking. I've not done the last 1 year count. It has already been, the Act has been amended 5 times. And the total amendments are 192 amendments across, there are total 470 sections, but 192 of them have been, amended. Maybe some may have been amended more than once, but total 192 amendments. Another problem with this Companies Act is almost 75% of the section, it's a delegated legislation, and 75% is through, I would say, managed or supervised through the rules. The first time when the draft rules came, there was public exposure somewhere in 2014 or so. After that, I think whenever amendment is happening, there's no public exposure. And I just, again, my count somewhere in mid-June 2021, there are 49 set of rules and which have been amended 206 times in the last 3-4 years. So that is the rate and the speed in which, the amendment is happening. So earnest advice to all my colleagues who are listening, please don't respond to any client query offhand, though you may be an expert. By the time you have seen the last amendment few days back, there could be an amendment in the rules, not in the act so much, but I'm saying the rate of change is just unbelievable. So please, be very careful as far as the any advice. Coming to the topic under discussion, initially the topic was NFRA and NOCLAR, and finally I think it has boiled down to only NFRA. Be that as it may, that itself is a very big topic for 1 hour. And we have got Chandrika to speak on that, and I'll just give a macro sort of helicopter view of what's happening there. I think all of us know under Section 132, there are certain powers which have been given to NFRA. I'll not get into it, let Chandrika speak about it. And it's not only applicable to listed companies, NFRA, it's also applicable to large unlisted companies. Again, the benchmarks were given by Chandrika. Till date, the NFRA has done audit quality, review report of almost 6 firms, I would say. 5 of them belong to the ILFS group and 1 to the Jayaprakash and associates. ILFS as ILFS companies, the group companies. And I think that's unfortunate. The starting point of the AQRR is unfortunate. They picked up the ILFS one. I wish they had picked up a normal company which was not there in any scam or so. And I'll tell you the reason why I think it's unfortunate. So that is one thing which they are doing is audit quality review report. Apart from the investigations which they do recommend accounting standards and auditing standards. They oversee the compliance with accounting standards, compliance with auditing standards. Whether it's companies, audit firms, they have got investigation powers. They've got discrete powers for the listed company and the large unlisted companies against CAs and the firms. The NFRA also started doing financial quality review report, which is more pertaining to the companies, not to the firms. And they have done till date about 2 entities. One is a public sector, which is KIOCL, which is the Kudremukh Iron Ore company, and one is Prabhu Steel Limited, recently, maybe a small company. I've not heard much of it. And I'll just speak a little bit, what are the key issues which are there in the quality review, which is relevant to us as start practicing CAs. They've commented on independence. Now, though the law doesn't mention anything, the NFRA says in case your network firm has done any work, you cannot do the audit. And they've said the audit has been bad in law, I think in few of the entities. Though the law doesn't say, law talks of the firm not rendering any under Section 144, the Companies Act. Even the Code of Ethics is more for the firm perspective, not for the larger group entity. But be that as it may, they have gone and come to this conclusion that the network firms also cannot render any service. They are commented very heavily on any other services rendered by the firms to the audit client, whether it is tax, whether it is other things, and they said the independence has been jeopardized. So that is one particular area where they are commented. A lot of work on independence they are commented. Compliance with auditing standards also has been a very major area of, I would say, and these are large companies which they have reviewed, whether it is ILFS, JP. So in those companies, if they say the standards of auditing have not been complied properly, you can understand all large firms doing it. And they've commented on backdated documentation. They've commented in mismatch of attendance sheet for time allotted by partners, managers. Somewhere they mentioned that there cannot be more than one engagement partner. I don't know how NFRA came to that. I got a different view thereon. Somewhere they have said, assuming certain things are not applicable to an auditing, to a client, an auditing standard not applicable. So I, as a professional, take a judgment call and I don't sort of apply it. But they want documentation thereof. One particular para, one particular line, not applicable. Please document and say not applicable, why it is not applicable in your view. So the quantum of documentation which they want is possibly a line by line, para by para documentation is my impression. And those who are doing listed companies, we don't have a choice, listed and large entities. We need to sort of fall in line and try to rise to that expectation. However, I think impractical or however more idealistic it will be, we'll need to sort of get our act together. Another major observation has been that those charged with governance are reporting. Normally, we have got a practice of giving PowerPoint presentations in the audit committee. NFRA said that is not enough. You need to, highlight separately what are your other engagement apart from the PowerPoint presentations you make to the audit committee. What are the other levels of management you're engaged with? Have you sent them separate letters for any issues you have highlighted? So these have been the areas where they have been, commenting on. They commented on the going concern also, as far as I think ILFS is concerned. They commented on the improper use of the analytical procedures as required by SA 20, whether because the ratio analysis has been improper trend analysis, so on and so forth. And they also commented on the audit document rule not compliance with fundamental security requirement of monitoring of logs, authentication, access control protocol. They have not complying with the basic principle IT security, SQC1, SA220. So there's been a sweeping, manner in which I think it is unfortunate that they picked up ILFS. So the difference between a normal audit and the practical issues around that and a problematic audit, where say somebody was involved in some, maybe there are some, I would say, errors or omissions as far as the larger, I'm not getting into the facts part of it, but it has increased the expectation and the benchmark to the nth level. The fact that, and the way they're interpreting standards of auditing, the way they're interpreting the independence requirements, I think we need to be cognizant thereof, and we need to get our act together. A lot of developments happening around independence at UK level. At India, we got the RBI circular last year, where they say a firm which is doing a network of firms which is doing an audit cannot do consulting. So I think there's a way forward to our audits, and the same thing will apply to smaller entities and smaller companies also in times to come. Currently, it may be only relevant for listed companies and I would say large unlisted companies, but the time is not far away to, when this will be applied to smaller companies. With this, I would want to conclude. This was the broad helicopter view which I had, but we all are eager to listen to Chandrika, on more specific, more detailed on the NFRA, the section 132 and the rules thereunder, and what has been our experience. So thanks a lot. Thanks to WRC and to CLCGC Committee for giving me this opportunity to share my views. Thank you. Over to you, Chandrika.
Thank you, madam. Thank you, sir. Thank you very much for your opening remarks. Chandrika, ma'am,
thank you. Yeah. Thank you so much. And at the outset, I'd really like to thank the WIRC and especially Mr. Murtuza and Ms. Shweta Jain for giving me this opportunity. And it's been stellar performances yesterday, and you had the who's who in the CA fraternity yesterday. And similarly, all of this morning and just now, we all heard Mr. Vikamsey as well. And I thought for a second that I really hope that the world part beneath me, I thought I should just get into some hiding or something like that. But nonetheless, I just thought I will do as much as I can. There will be no qualitative assessment on any matters. I'm not going to speak about any of the AQRRs. I'm not going to be speaking about any of the ones that you see insofar as the views on financial statements are concerned. What I'm going to be covering is fundamentally what's it that the NFRA has, what is the expectation, what sits within the rules, and what as a fraternity of auditors that that is an expectation of us in the broad. If you see the broad objective, the only fundamental objective is we are protectors of the capital markets, and therefore we have an obligation. So insofar as that is concerned, without further ado, I'll jump into my presentation straight. So just give me a second, I'll just put that up. Let me know if you can see my deck,
yes.
Please.
Yes, we can see. Please go ahead.
Thank you. So I'll just put my video on out because of network issues. So I'm just going to give you a small brief in terms of the way I look at it. So the first thing is to start off. The National Financial Reporting Authority, and all of us know it famously as NFRA, and was constituted on the 1st of October 2018, and of course by our government. And before I get into the details, just wanted to understand and put on as a perspective insofar as the genesis, a very big step forward in regulating the financial audits of larger companies. So it not only covers listed, it covers a bunch of other companies as well. An independent regulator for the audit profession. And that's something was a very key change that was brought about by the innumerable other changes that came in through the Companies Act 2013. So we all know that the 2013 Act came in at that point in time. Individual sections got kind of notified much later, and NFRA was one. Section 132 came up sometime in 2018. To be precise, 1st of October 2018. And all of us know, and we've been speaking about this for the past 2 days, that audit, of course, is a noble profession. And just like a medical profession is a noble profession fundamentally because we are protectors of the capital market. And end of the day, the only thing that we have is the auditor's report. And the only thing that supports the auditor's report is fundamentally our integrity, our independence, and what sits within the audit documentation, which is our working paper file. And the decision of the government of India to have an independent regulator, and there was an expectation when they set this whole thing up. And the expectation was fundamentally, they thought it would result in improved foreign domestic investments. And that's why I say that we are protectors of the capital markets, enhancement of economic growth, supporting globalization of business by meeting international practices, and assist in further development of the audit profession. So fundamentally, the manner in which the whole thing was overlaid was taking a lot of things that happens in the PCAOB space, taking a lot of things that happens in the SEC space, taking a lot of things that happens in the FRC, which is the Financial Reporting Council of the UK, or even going up to IFIA. So it is taking a lot of those best practices, and that's how the NFRA as well as the rules were kind of finally brought into place. But before I go further into further deconstructing this whole thing, I just thought I should read out, I'm just going to be reading out something that I found very, very profound. And this was something straight coming from the Government of India notification, which goes on to say, the need for establishing NFRA has arisen on account of the need felt across various jurisdictions in the world in the wake of accounting scams to establish independent regulators, independent from those it regulates, for enforcement of auditing standards and ensuring quality of audits, to strengthen the independence of audit firms, quality of audits, and therefore enhance investor and public confidence in financial disclosures of companies. And that's pretty much verbatim of what's available on the in the Government of India notification, which came out way back in October 2018. That's pretty much a genesis before I get into the details. Moving over to the details. So what do we have insofar as NFRA is concerned? A, we have the section in itself, which is your section 132. Then you have 3 notifications which came thereafter. One came in March 2018. One came out in November 2018, and the last one came out in September 2019. The first one in March 2018 pretty much spoke about the manner of appointment and other terms and conditions of service of the chairperson, as well as the members of the authority. I will be kind of saying either NFRA or the authority, both meaning the same. The one in November 2018, and that was a very, very critical one, because this is fundamentally the NFRA rules of 2018 that pretty much covered the scope of companies that it chooses to regulate and bodies corporate, functions of NFRA, duties of NFRA, monitoring and enforcing compliance with accounting standards and auditing standards. So basically it covers both accounting standards and it also covers the auditing standards, overseeing quality of service, powers to investigate disciplinary proceedings. All of these things came out as part of the November 2018 rules. I will be talking about this in detail as we go along. The third one was in September 2019, and that fundamentally was, insofar as the annual returns that audit firms and auditors must submit to NFRA. This basically provided the form number 2. Originally, they had a different due date, but now the due date is 30th of November. It is a very long form and it requires a lot of information for submission to the government. And the take is with this information, it becomes that much more easier for NFRA to be able to determine which ones to oversee, which ones to look at compliance, and which ones to go back and inspect. So that's pretty much what we have. And they have the same powers as vested in a civil court. And that is a very, very important point that I wanted to bring out. And this is under the Code of Civil Procedure of 1908. And if we were to go down one step lower in terms of what this really means, is that insofar as powers vested with NFRA, which is they have the following powers: discovery and production of books, requiring the discovery and production of books and other documents, summoning and enforcing attendance of persons and examining them on oath, inspection of any books, registers, and other documents, and issuing commissions for examination of witnesses or documents. This is actually a very, very large power that is vested with NFRA, and that is something that we must be cognizant of. A couple of matters that I would also like to add here is NFRA, I just told some time ago, has the power to investigate. One important thing that I would like to bring about here, and this is something which is covered in the CA Amendment Act now, which is the ability to go to look at something on a suo motu basis, in addition to something which is referred to it by the central government. And that's another thing that I thought I must lay before all of you, because suo motu is an important one. Suo motu is now aligned with what we have in the CA Amendment Act as well. Moving over to the composition. So the composition of NFRA, if you see, you have the chairperson, who will have to be a person of eminence and having expertise in accountancy, auditing, finance, or law. And this person is appointed by the central government. Then you have 3 full-time members, and then you have 9 part-time members. And these 9 part-time members are representatives from various bodies: Ministry of Corporate Affairs, the CAG, the RBI, SEBI, and ICAI. Now, how does the central government appoint a chairperson and appoint a full-time member? I think that's an interesting angle for us to know, because it's just not as if somebody is just picked out of the blue. There is a process that NFRA follows as well. And they have formed a committee which is known as the Search and Selection Committee. And this committee, again, is a very high-powered one. And this committee basically comprises of the Cabinet Secretary, the Additional Principal Secretary to the Prime Minister, Secretary of the Ministry of Corporate Affairs, and 3 experts of repute. And these experts are again back in the profession of accountancy, auditing, finance, and law. So this is pretty much, the manner in which NFRA identifies the people who has to be either the chairman or the full-time members. Next is, we also, I think, should know what is the term of the chairperson and a full-time member. And the term is stated to be at least 3 years, or till the chairperson attains 65 years of age. And of course, is entitled for 1 more term. Just like as auditors, we are entitled for 2 terms of 5 years each. Similarly, for a part-time member, there's very, very similar rules that is there for part-time members as well. They have a bunch of embargoes. And those embargoes, I'm not going to be laboring on that, but just to give you 2 inputs insofar as embargoes are concerned. The chairperson cannot practice before the authority after retiring or resigning from the position of the chairperson. And during the tenure, cannot participate in any arbitration laws or any of those matters, cannot participate in. So this is something which is broadly insofar as the composition of NFRA. And this is again coming from one of those circulars that came out, which pertain to NFRA appointment rules. Moving over to the scope. This is very, very critical in understanding what's scoped in and what's scoped out. I have 2 slides which covers the scope of NFRA. Over to the first one. The authority, as in the NFRA, has the power to, for a bunch of things: monitor, enforce compliance with accounting standards, with auditing standards. They have the power to oversee quality of service. They have the power to undertake investigation of auditors. And which auditors? Auditors of the class of companies and bodies corporate that is just listed out here. So what is their scope? The scope basically covers all listed companies, irrespective of the nature of the instrument. Those companies listed in India, those companies listed outside India, as in the Indian companies listed outside India. Then you have the unlisted public companies where the paid-up capital not less than 500 crores or annual turnover not less than 1,000 crores or aggregate loans, debentures, deposits not less than 500 crores. And all of these metrics are as of 31st of March of the immediately preceding financial year. It doesn't stop here. It goes on to add on more companies into its, its tentacles are far more broader. It also covers other companies and bodies corporate, which is insurance companies, banking companies, companies which are engaged in generation or supply of electricity. Those companies or body corporates which are governed by any other special act, and company, body corporate or person which central government might refer to in public interest, which means it can be therefore any company. Now, is it just that company, or is it going to be extending its tentacles across the group? So any company which is a subsidiary or associate of a company or a body corporate which is scoped in above, and if that one is material, which means that if the income of the subsidiary or associate exceeds 20% of the consolidated income or 20% of the consolidated net worth, then those also kind of get scoped in. So what really gets scoped out? Private companies which do not fall under any of the above have the ability to be scoped out, except if the central government can refer to it in public interest. So private companies could have PE investors, it could be anything. There could be a public interest which gets expanded consequent to large loans that a private company might have taken. So all of these can also cause it to come within the ambit of NFRA. So therefore, the scope is fairly very wide, and the auditors who audit any of these companies therefore also get scoped in as part of coming under the NFRA's tentacles. So that's something that I thought I must lay it out here. And does this stop here? So what happens? A company can cease to be a listed company. A company can be ceased to be an associate or a subsidiary with those monetary thresholds that I spoke about. So what is the story? Even after a company ceases to be a listed company, there is a continued oversight. And the continued oversight by NFRA, it continues for another period of 3 years. And what is this? It's a company which ceases to be a listed company, or it's paid up capital or turnover or aggregate loans, etc., which falls below the limit which is stated above. So for a period of 3 years, even after they fall off the scoping that we just now saw, NFRA has continued oversight on such entities as well. And that is something which is very important for us to know. So we saw the scope, we saw the continued oversight. Now it's very important for us to understand the functions and duties of NFRA. And pretty much what you see on this slide, it's a fairly busy slide, but NFRA has also been busy with a lot of these things. And therefore, this is something which has been taken from the Act and the rules. I've done a little bit of paraphrasing here and there. But what is it fundamentally? It is protection, and protection of who? Protection in public interest. Protection of the interest of investors, protection of interest of creditors, and others associated with the company or bodies corporate. So pretty much it is protection, protecting the interests of, all of those people and the various stakeholders of a company or of a body corporate. This is the fundamental, going back to protecting all stakeholders' interests. Now, this is the why of NFRA's powers and its duties and its functions. Now, how do they do it? They do it by actually establishing high quality standards of accounting and of course auditing. And what do they do specifically within it? They exercise effective oversight of accounting functions performed by companies. So because it covers both the accounting standards as well as the auditing standards, their tentacles are on both the companies that we just now saw as part of the scoping, and then the auditors and auditors associated with the companies, the class of companies we just saw. For ease of reference, I will call it Rule 3. So for all of those scoping within Rule 3, that's where NFRA will have its play. And these are otherwise fundamental and primary from a NFRA standpoint. Now, all the other things that you see here, which is making a recommendation to the central government for formulation. So if they're going to be actually ensuring compliance with accounting and auditing standards, then there has to be recommendations which it will give to the central government. So that is one of its functions and its duties. And the next thing is, each end of the day, if it were to know what exactly is the entire landscape, it also needs to understand what are the various auditors which is appointed by the companies and bodies corporate. That's how you have a NFRA to That's the form which came up in 2019, which people had to submit. And then how does it do all of this? It has to stay connected with other international and other national organizations. And that's therefore another power, and it's one of its function that it has to actually do. And anything else which will enable for it to perform any of the functions and duties stated above, again, obviously will sit as part of what it's supposed to be doing. Governance, therefore, has a very, very huge role to play. We saw that the chairperson, all of that forms part of the governance, and it very much aligns with the entire construct of this program that we're having with the ICAI. Insofar as end of the day, all of this, if there is going to be oversight over companies through the accounting standards, and I'll talk about it in a little time from now, it goes back and sits squarely as part of fundamental corporate governance of a company, which then resides fundamentally on the chair of the board as well as of the audit committees. And then here is where there is an interplay with the Companies Act, and it so sweetly fits within the entire title of the program, which is the entire program of yesterday and today, which is Companies Act and corporate governance. These two go hand in hand, and NFRA goes hand in hand with that entire landscape. I will now bring your reference to 134.5, which is a section of the Companies Act which clearly defines what is the director's responsibility and requires directors to publish this responsibility as part of its statement. And this is something we'll find in the annual reports. The reason I'm talking about this in this context is before end of the day, if it's going to be compliance with accounting standards, then those go back and sit squarely insofar as the accounting policies that sit within a set of financial statements, which is the policies that the company is required to adopt for compliance with the standards, and those policy choices with the accounting standards provide also to companies. And that is one of the fundamental responsibilities that the directors have as well, along with safeguarding of assets and compliance with various regulations. Moving over insofar as monitoring and compliance with enforcing compliance with accounting standards, out here, this is something very, very similar to what the SEC does and what our own FRRB does as well. From the financial statements, it needs to be very transparent insofar as understanding what has the company done, what is its trajectory, whether what sits within the financial statement is something which aligns with what sits in the forward. And this is where we have it completely syncing with our SA 720 obligations, which is with so far as other information is concerned. So all of this stitches in one, starts connecting the dots, then that's a beautiful story. And that story ultimately goes back into where I started, which is protection of the capital markets. The protection of capital markets is A, our responsibility, and B, rather, let me put it the reverse way. A, the responsibility of companies, and through it, the boards and the audit committees, and B, the responsibility of auditors as well. Now, insofar as this one is concerned, I will just walk you through what the requirement is. Monitoring and enforcing compliance with accounting standards, multiple. What do they do in this space? And as Mr. Vikamsey just mentioned when we started off, there are a couple of reports out there in the public domain which speaks about NFRA's observations when they did the financial statement review. So this is something that NFRA has the right to review financial statements of such companies, body corporate, as it deems fit, which comes within its scoping. It has the right to require the presence of officers. It has the right to publish its findings on non-compliances. And of course, it keeps in mind the public interest when it does this as well. And then when it has reason to believe that any accounting standard has or may have been violated, then there could be a next course of action. The next course of action could either be investigation or it could be enforcement action. And it has its own various divisions through which it does this. I'm now going to be shifting the lens to auditors, and I will be laboring on this space for a little time longer than on the other slides, because this is something which is very, very relevant to us. And I will be actually building on a lot of things that Mr. Sudhir Soni just spoke about some time ago in the previous session, when he spoke about the system of quality control. He also spoke about the auditing standards and the auditors reporting. And we had one of the members asking some questions around ISQM. I will touch about a few of these as part of this session as part of this slide. I will first start about the quality control system before I go on to the working papers. What you see on the slide is the order in which it is there within the rules. But in my mind, it is structured a little differently because fundamentally it would be the edifice for an auditor, irrespective whether it's a sole proprietor, whether it's a small firm, whether it's a big firm, whether it's a network of firms, is fundamentally going to be the base on which everything else is built, is going to be the system of quality control. SQC1, which was fully aligned with ISQC1. ISQC1 has now moved into ISQM. Today you have an ISQM1, which is the quality standards, ISQM2, which is the quality standards in relation to first time introduction. ISQM2 talks about the entire requirements of an engagement quality control reviewer. And along with these two came the third one as part of the suite of standards, which was our ISA 220 revised. So these three are the suite of standards which came from the international forum. And this is something which is yet to be exposed in India, but I'm sure this would come up very, very soon. But up until then, it would be interesting for us to take a look at in terms of ISQM broadly builds on, fundamentally, it has what ISQC has, as an SQC has for us, and it just builds on top of that, and it requires a lot of codification if I were to cut the long story short. However, having said this, I think it's important for us to understand what is it that must sit within us to enable NFRA to evaluate the sufficiency. So for somebody to come and evaluate the sufficiency of the quality control system and the manner of documentation, it becomes therefore important insofar as what is it that sits within us. So let me get into this. I will walk you back to the 6 pillars that Mr. Sudhir Soni spoke about, and that's important to understand. Leadership responsibilities for quality, he spoke about that. Ethical requirements, acceptance and continuance of client relationships and specific engagements, human resources, engagement performance, and monitoring. These are the 6 pillars of SQC. The standard in itself is very detailed, is self-explanatory. Insofar as how all of this should be codified, we have a full implementation guidance which provides checklists, which provides, with respect to each of these 6 pillars, it provides detailed questions that an audit firm or an auditor may want to ask of oneself. It also provides insofar as how the documentation should be maintained. What's very, very important here is if somebody were to come and evaluate sufficiency of the quality control system, it is important for the audit firm also to determine whether the quality control system that it lays down is sufficient. And so how does it do it? I would like to now draw an analogy to what a company does. This is exactly the same as what you will find in a company. As auditors, all of us day in and day out do the ICAI reporting. We look at internal control systems of a company and we go and make an opinion on that. It is exactly the same as that. It's exactly the same as what resides within an audit firm. The individual engagements that we see is equivalent to the financial statements that we sign off on, and the internal controls is akin to the system of quality control that resides within the firm. If that is the analogy and that's the way it operates, to evaluate sufficiency of the quality control system, one needs, just like how you would expect a company to have a process flow diagram, let's assume for revenue as a process, or cost of sales, or or with respect to PP&E, with respect to any of these, or order to cash. It could be any of these processes that a company will have. Similarly, one would expect an auditor, audit firm, network to have process flow diagrams which underlie this, which underpin this. This need not be fancy ones. This is just the thought, whatever is the thought process that we have in mind, putting it on a piece of paper, then that becomes a proper evidence that somebody else can come and evaluate the sufficiency. That's how that entire piece works. Moving on, insofar as the same piece is concerned, testing the design and operating effectiveness, similar to what we would do in a company. That's pretty much the same thing that's expected on the system of quality control. Once all of this is done and all of this is in place for a company, then it is for a firm, it is easy for NFRA to then come and evaluate the sufficiency. That's the only way they will be able to evaluate it. And as auditors, we must facilitate this for them to be able to come back and provide their thoughts, inputs for purposes and best practices, which then people can start building upon. Moving over to the review of work papers, I will again take another 3-4 minutes on this one, is with respect to, I'm going to take you back to auditing standards. We all know that we have a bunch of standards, and those standards are bunched into various categories: general principles and responsibilities, risk assessment, responding to those, audit evidence, using work of other auditors, and then we have our reporting standards, which is conclusions and reporting. All of these are cast in stone. And this is our safe harbor. And in any court of law. Therefore, our work papers, if somebody was to come and review work papers, I'm going to now draw your reference to SA 230, which very, very clearly says in terms of what the expectation is of an auditor, which is preparing documentation to enable a review, preparing documentation to enable, if I were to actually call out from the standard itself, it says the auditor should prepare audit documentation that is sufficient to enable an experienced auditor having no previous connection with the audit to be able to understand nature, timing, and extent of the work, results of audit procedures, and significant matters arising during the audit. This is the only thing that NFRA is also looking at. When it does the review, as an experienced auditor who has no previous connection with the audit, are they able to evaluate and understand what was the nature, timing, and extent of work that was performed by us as auditors? What is the results of the work performed, and what were the significant matters raised? So it's actually that fundamental. So therefore, if we did comply with the standards, our auditing standards also are safe harbor. If we were to demonstrate compliance with that, then we have arrived safe, because that's pretty much what NFRA is looking at as well. Communications relating to the audit, again, I will draw upon what Mr. Vikamsey just now mentioned to us. Communications to the management, communications within ourselves, communication to those charged with governance. These are very, very critical ones, and each of these is well covered within the standards on auditing itself, if one were to see. Therefore, out here, insofar as communications within ourselves, it's across all standards. Communications with the management is again across all standards, but specifically called out in SA 265, a standard that I think oftentimes we kind of miss in the whole scheme of things. Then you have an SA 260, which talks about what is the expectation of the auditing standard insofar as our obligations as auditors to communicate to those charged with governance. So end of the day, our obligations as auditors emanate from the auditing standards, and evidencing all of that as part of our audit working paper files, which is the only evidence in a court of law, will have to be made absolutely well insofar as to enable a review or an inspection to be run by any regulator. That's fundamentally the ask that we have, and that's what NFRA is doing as well. Moving over to the next slide. Insofar as what do they do after they do the review? They have the right to take measures for improvement of audit quality, which is putting in place changes in audit processes, requiring improvements in quality controls, and also calling out, first asking the auditors at audit firms to provide a detailed plan with time limits. And then when this is provided as an advisory, it is duty bound for the audit firm to also make all of these required improvements. And this is something which NFRA chooses to monitor, and they can also monitor this using taking the help of external specialists as well. Moving forward insofar as the powers to investigate, by far the most powerful group, which this one deals with NFRA's power to investigate, which it does through its own enforcement wing. I'm just going to be reading a few things from here, because this is actually a very, very critical one that I have out here. It as part of its power to investigate, and if it has received any reference from central government for investigation, it does that. And then if it has undertake investigation based on its various compliances that we previously saw, or based on its suo motu investigation that it does. And if during the investigation it has reason to believe that any company or body corporate has not complied with the requirements of the Act, or involves or may involve fraud amounting to ₹1 crore or more, then it has the right to also communicate with the central government. So these are some things that one must know. And insofar as the what happens insofar as if a professional or other misconduct is proved, then this professional or other misconduct takes it straight back to clause 22 of the Chartered Accountants Act, because it is the same meaning as it's been assigned to the Chartered Accountants Act as well. And if you go into the Chartered Accountants Act under clause 22, it takes us back to 2 schedules. I won't be laboring on the 2 schedules, but just to give a perspective, we have 2 schedules, which is the first schedule and we have the second schedule. And the first schedule again is broken down into 4 parts, which talks about professional misconduct that applies to those in practice, those members who are in service, those that are generally there for all members, and then you have other misconduct. Similarly, you have something for the second schedule as well. Now, NFRA's rules basically only cover professional misconduct and other misconduct. So recently, the consultation paper that came from a Companies Act standpoint also extended it to with respect to moving beyond professional misconduct and other misconduct. So that is something that came out as a consultation, because today, if somebody, for example, did not submit a return on time, that is neither covered as part of professional misconduct, nor is it covered as part of other misconduct. So NFRA chooses to include those as well within its remit from a perspective of levying a penalty or a fine. So that's something that's sat as part of the consultation paper as well. Insofar as what are the various filings that one must do with NFRA. NFRA 1 is where every body corporate, other than the companies any which way submit information to the MCA. NFRA 1 is required for every body corporate other than a company, wherein it requires to provide particulars of auditors appointed by the body corporate. NFRA 2 is something that auditors will need to file with NFRA. This is an annual return, and it needs to be done annually, 30th November of every year, and that's a date which is cast in stone. One must take enough. It takes a long time to actually populate this particular form. So therefore, one must actually start the process fairly early in time and then ask for a number of details. The details are the number of entities for which auditors have issued reports. What are the names of entities? What's the name of the engagement partner? Engagement partner is very clearly defined in SA 220. So one must bear reference. The engagement partner is pretty much the person which is covered under the standards. The second is your EQCR, the type of the reports issued, the total fees, the expenses received, if there is any membership or affiliation. This is just some of those various things I spoke about. But each of these individual elements are covered within the standards and auditing. So if there is a reference to engagement partner, one needs to go back and see the standards and auditing. If there's a reference to EQCR, one needs to go back to the standards and auditing. So every item within the return also will need to be in liaison or in a consonance with what the standards and auditing require us to have. And I will just wind up by not spending too much time on this, but just to give you a perspective. There was a concept paper which NFRA floated for MSMEs, for statutory audit of MSMEs, asking whether there should be an exemption for mandatory statutory audit for them, whether there has to be a separate set of standards, what should be the cost of this, and what should be the current, whether the current exemption thresholds that we have for CARO and ICFR, whether that needs to be standardized, whether that needs to be made uniform, and all of that. Now, all of this, people have responded to NFRA, but we are still awaiting NFRA to come out with its closure of the consultation paper insofar as the MSMEs are concerned. So with this is pretty much end of where I wanted to talk about on deconstructing the NFRA rules. Over to you, sir.
Thank you, Chandrika, for a wonderful, I would say, presentation on the NFRA rules. Friends, just a couple of top-up points on what Chandrika mentioned. One is, to the best of my knowledge, Rahul, I'll just a few comments before we close up.
Yeah. So, your closing remarks, sir.
Yeah. So, just a few comments. To the best of my knowledge, what I understood is post 2018, when NFRA was set up, the whole framework of how the audit quality review will happen or how the financial reports will be reviewed has been done by the executives or the specific divisions, and it has not gone to the overall board as far as the framework is concerned. I think if you look at ICAI, we've got a peer review board, we've got the financial reporting review board, we have got the quality review board where the chairman is a non-CA, almost 6 outside people, but where a complete framework is decided by the main board, and then the execution happens. To the best of my knowledge, what NFRA has done is there's been more executive, action there on these, and this is whatever I understand. This is not, the framework has not gone through the way the audit qualities are going to do, or it's just a general aside. Friends, another thing is the Institute Financial Reporting Review Board, which was already earlier focusing on listed companies, is now not focusing on listed companies, focusing on private companies. So the financial reporting review can happen to your audit clients also. Of course, they pick up a sample, and we heard our Honorable Vice President who said we are going to use AI to do the financial review. So if they are going to use artificial intelligence, then the sampling will be out, and I think the coverage will be more. So it will be sooner rather than later when your audits will be picked up, whether it is large entities or small entities, unlisted entities, it could get picked up. Another aspect I want to draw attention to this August crowd is the peer review mandate has changed recently in April 22, and I would want you to have a look at the institute announcement. I think by and large, by 2024-25, almost all entities will get covered under peer review, even if they are, I would say private companies, audits only. So there is a roadmap which has been decided by the institute, 22, 23, 24, 25. And so be cognizant of that. So your audits, I think most of the, I would say, SMP, small and medium practitioners, I think we need to scale up our documentation a lot, and especially from what Chandrika said, especially from a perspective of the NFRA, what the expectation is. Just to tell you, friends, what NFRA expectation is, when they review an audit, all the files have to be uploaded on the system, and they'll do an independent review. It's not as if somebody sitting in front of them, you as a firm, one of your colleagues, your partners is explaining. No, the file has to be self-speaking, contained, organized properly. It has to be technologically uploaded, and so without support of your team members and also. That is the level of expectation how the file should be self-speaking. So that's one area which I wanted to focus on. So that's a level, and I think most of the SMPs, we need to get our act together. Number one, on the basic documentation. Number two, on the NFRA expectation. I think let it be phase-wise. First is in compliance with the standards of auditing, let's scale up our documentation. It cannot be only in your mind, it has to be documented. Lastly, from the perspective of what Chandrika mentioned, just to highlight a perspective, the discussion with the clients have to be documented. It cannot be sort of oral. The internal discussion within the firm, and there are certain critical matters where you may consult your other partner. There will be our audit partner, you consult with other partner. That also needs to be documented, and you need to document whatever you're informing the client. You may give an oral, sort of suggestions and all. So I would recommend, whether it is the board, whether it's the audit committee, whether it's the management, the CFO, the MD, TCWG, that is those charged with governance, could be different people. It's not only the audit committee. There could be different people. So please document what you're sort of discussing. That was just the sort of sum up. Again, thanks, Chandrika. Wonderful presentation on the NFRA rules, and you very tactfully didn't get into the AQRRs and the FQRRs, the financial quality review reports or the audit quality review reports. I think, but fine. I think you summarized it very well and you covered it very well, on a generic basis. Thank you.
Thank you.
Over to you.
Thank you.
Over to you,
Thank you,
Rahul. Yeah.
Thank you, Nilesh bhai. As usual, very succinctly and in a very concise manner, you covered a lot of area. And thank you, madam. It was a great presentation, simplified, and yes, as Nilesh bhai said, focusing on right now on the current issues on hand rather than getting into the deeper technicalities. I think the way it has been, this session has been very informative to all of us. So my sincere thanks to Nilesh bhai, Chandrika madam, for sparing your valuable time for this session. I think the members have gained a lot of it. So thank you.
Thank you.
Friends, we'll close this session right now. We'll reassemble at 2:30.
Any questions you want to take? I don't know.
If any questions are there, we can take it up.
The presentation has been very good. I don't think people will be having any challenges there, but just in case there are any doubts, I think.
So one question, would any company fulfilling the NFRA criteria be automatically referred to the NFRA? I'm not sure.
Yeah. See, question is, as Chandrika mentioned, we have to give your annual return to the NFRA for your listed companies and the large companies which are more than a certain threshold which he mentioned. And then it is for NFRA to pick up. So right now they're building up the team. So as you told, the first focus has been ILFS and few other companies which are taken for FQRR. But once your company is listed or maybe large company, it can be picked up anytime.
True. Any other questions, friends?
I hope that was the question, and Chandrika got a different view.
No, absolutely right, sir.
Yeah. Okay. So I think, sir, we can break for lunch.
Close, yeah.
And thank you, everybody. Thank you. The session. Yes, sir, Murtuza.
So for all the participants, the session will continue. You can close your window, switch off your video, and go for lunch, and again join back.
Yeah. So we'll.
In case you
start again at 2:30.
On the link, you can again do that as well. Yeah. Okay, Rahul.
Yeah, thank you, sir. So we'll start again at 2:30. So kindly be on. I request all the participants to be back online by 2:30. Thank you, sir.
Thank you.
Thank you, madam.
Thank you
very much.
Thank you.
Thank you.
Thank you. Bye-bye.
My presentation start here, sir.
So welcome back, friends, after the post-lunch session. And I'm sure you enjoyed the morning sessions. And again, we are coming with very interesting session regarding SEBI LODR in respect to the related party. And for this, we have with us a very experienced and eminent faculty CA Paresh, Clerk, sir. So let me take the privilege to introduce him in just a brief manner. So he is a graduate from Sydenham College of Commerce and a member of ICAI, also done a cost accountant course. He has completed certificate course on IFRS offered by ICAI. He has completed his articleship from NFRA and Company Chartered Accountant Mumbai, and then joined to Bansi Mehta, and then from 1986 to 2013, he was associate professor in accountancy at Mithibai College of Arts, Chauhan Institute of Science, and Amritaben Jivalal College of Commerce, Mumbai. And presently, he is a partner of Bansi S. Mehta and Company Chartered Accountant since April 2003, wherein he is providing his services in audit, statutory, internal, and tax all, and in due diligence for local and international acquisition, in advisory, accounting, and company law matters, and special assignment on accounting also. In other professional involvements, we'll just like to brief. He has been a special invitee on Accounting Standard Board of ICAI Council 20 to 21, co-opted member of India's Implementation Committee of ICAI for 1920, member of Mumbai Study Group of Developing Guidance Note on CARO 2020 issued by ICAI, member of the Accounting and Auditing Committee of Bombay Chartered Accountant Association since 2007, co-opted member of Committee on Accounting Standard for Local Bodies 1718, group member in the publication of ICAI on Guidance Note on the Revised Schedule 6 to the Companies Act 1956, presented paper, led discussion, and participated actively at seminar and conferences of the WIRC and Vile Parle and other study circle of the WIRC of ICAI, also at Bombay Chartered Accountant Society. He is a member of the Accounting Standard Committee of Indian Merchant Chamber 2009 to 13, past member of the Corporate Law Affairs Committee of IMC, convener of Vile Parle Study Circle from 1907 to 2003, also co-authored book titled Thumb Rule of Bookkeeping published by Bombay Chartered Accountant Society, written article in BCA's Chamber of Tax Consultant Tax Sutra on this various subjects, reporting consideration by auditor under current scenario, September 20 edition, rotation of auditors, standards on auditing, revised Schedule 6, IFC for small companies, appointed date versus effective date under Ind AS, and contributed to referencer manual of Bombay Chartered Accountant Society and WRC of ICAI also. So with this brief introduction, sir, I welcome you at the platform of WIRC and thank you so much for accepting the invitation.
Thank you.
And now
Thank you.
Handing over charge to you.
Okay. Fine. I will share this screen, right? Okay.
At the bottom, there's a green screen, share screen, green arrow.
Yeah, but I think the problem will be allowing Zoom to share the screen.
I think you must be
वहाँ पे नीचे से share screen option आ रहा है सर.
Yeah, but that was not getting. Oh, we should have started first. Are you able to see the screen now? No.
No, sir. I think you must be operating from the iPad.
No, it's a MacBook.
So, but it will require the permission. You have to allow them.
मिश्रा जी, आपके पास है presentation सर का?
हाँ सर.
Yeah. Yeah. Okay, if you share, that's better because I think Zoom has an issue.
Sir, we will share it.
Yeah. Okay. Thank you. Yeah. Good afternoon, everyone. Mr. Chairman, Sweta, and my friends, colleagues who are on this virtual mode. You know, one thing I always may say that this is one blessing we have through COVID. Whether it is rains or whether it is Mumbai ban or whether it is India ban, we all can have our work going on. We can also have such seminars going on. So that's, I always say that this is a blessing. Of course, this could have been done even pre-COVID days, but somehow we never accepted that. And now I think it's a norm and we are with it. I understand that this conference has very good topics and, you know, it was dealt with very well. And now maybe we are on last two sessions of the seminar today. And topic given to me is more for the company secretaries, less for accountant or the auditors. And may I mention that these LODR on related party transactions, there have been significant changes effective from April 1st, 2022. And with permission of all, I would stick to only the amendments which have taken place and which are effective from 1st April 2022. You know, we could move to the next slide and see that why this was all required. See, as you may see that under the Companies Act, shareholders approval, we look at, we see that approval of audit committee or the board. I'm sorry, I'll just switch off this. Yeah, I hope I'm audible. Okay.
Yes, sir.
Yes.
Yeah. So mainly this requirement is there due to रूपा ये बंद करो ना यार, रखो उधर, बंद ही कर दो. Yeah. So under the Companies Act, you have shareholder approval required if transactions are not at arm's length, or they are not in ordinary course of business, and the transactions are for certain threshold prescribed. Now, as per existing LODR also, all material related party transactions exceeding 10% of the annual consolidated turnover of the listed entity. May I mention that this entire discussion would be restricted to listed entity transaction, require approval of the shareholder. So therefore, many related party transaction could have not require an approval by the shareholders, either under the Companies Act or through LODR. And therefore, the SEBI, through a process which we will see it in the next slide, change the definition of related party transactions, as also decided about the change in approval mechanism. So, and now the scope is widened. The scope is tremendously widened to cover transaction even at subsidiary level, which were previously not in the ambit of LODR or for the Companies Act. So please understand that this gamut has significantly increased. India's industry is also finding difficult, and CII has made certain representation which we will discuss later. And therefore, now let's look at further background or the chronology within which these amendments have come about. So next slide, please. Yeah. So how come I am not able to see this?
Oh.
Yeah, sorry. Okay. Yeah, so there has been a report of the working group on related party transactions, which gave the report on January 2020, which went into all the details present requirement under the Companies Act, present requirement under accounting standard, Ind AS, as well as LODR, and made their recommendations. And initially, of course, this is a small amendment which came from January 1st, 2022. But then after the approval by the SEBI board, the report of the working group, the amendments were notified under the regulations. And thereafter, of course, there is another circular was also issued on November 22nd. And then there are clarifications which have been issued on March 30th and April 8th. November 22nd, 2021 is more of a not clarificatory, I would say, more of the disclosure requirements and things like that. Next slide, please. Now, in few slides, I have just dealt with what are the amendments which have actually taken place and what then we will see what could be the impact of those amendments. And as I said, the main amendments are on the definition of related party transaction, and the approval mechanism. So in case of a related party definition, the first part, that is related party, means a related party is defined under section 2 subsection 76 of the Companies Act or other applicable accounting standard. There is no change in that. That remains as it is. Now we move to proviso. Next slide, please. Now you can see that this is the proviso which was added that provided that any person or entity belonging to promoter or promoter group of the listed entity and holding 20% or more of the shareholding in the listed entity shall be deemed to be a related party. So under LODR, promoter or promoter group, if it is holding more than 20%, then they were deemed to be a related party. But now what are the changes? And that is very important for us to note. It is now removing that threshold of 20% or more. If you see earlier, it is promoter or promoter group and holding 20% or more. Now what is it saying? Provided that any person or entity forming a part of the promoter or promoter group of the listed entity. So per se, any entity or a person forming part of the promoter or promoter group would become a related party. And this is a significant change. Very significant change, because it is not necessarily that every promoter or a promoter group would hold 20% or more. And so in earlier LODR, they were out of the ambit of a related party transaction, unless they are holding 20% or more. And then it goes on to add, no, please skip the, and then it goes on to add any person or an entity holding equity shares of 20% or more. So now it is any person. Now it is not talking about promoter or promoter group. It talks about any person holding equity shares of 20% or more, or 10% or more with effect from April 1st to 2023. And in the listed entity, either directly or on a beneficial interest basis as provided under section 89 of the Companies Act. So this beneficial ownership also is a subject by itself. And so any entity which is covered under beneficial ownership, that also would be a related party. So all these categories would be a related party. So therefore, the ambit has, I would not say one-fold or two-fold, but has gone up significantly. So from promoter group holding 20%, here now it is promoter group per se are included, and any entity holding 20% or any person holding 20% also would be included. And effective April 1st, 2023, that 20% threshold also has been brought down to 10%. And any beneficial interest holder also would be deemed to be a related party. Next slide. And of course that it shall not be applied to mutual funds, etc. That remains unchanged. However, the question may come up that we have financial institutions, we have investors, who could be holding 20%, and yet they may not have a control. But those investors, per se by holding 20%, would become also a related party, which in an earlier scenario would not be a related party because they would not be a promoter. Yeah, so this is a major change as far as related party is concerned. Beneficial interest, one would, of course, the question, because I would not like to go into the detail of it, but it is shareholder register wherever it is disclosed and declared beneficial owner as per section 89 of the Act, because that itself is a very elaborate declaration to be made, etc. And based on that, those ultimate beneficial owner also would become a related party, where there is an holding, direct holding, indirect holding through trust or through a company where one has a control. Those all also would become a beneficial owner, and then the related party. Yeah, next slide. So that's the next slide on beneficial owner. I've just made a mention of it because I didn't want to get into detail as it is a subject per se. Now we move to related party transactions. Yeah, next slide, please. Yeah. So now, what does it say and what is the change? A related party transaction means a transfer of resources, services, or obligations. Yes, that's true under Ind AS also. Between a listed entity and a related party. So it was restricted to any listed entity and its related party, regardless whether the price is charged, etc., etc., and provided that this shall not be applicable to the units of mutual fund. Now, the portion which is marked in italics, that is what are the significant amendments. Related party transactions means a transaction involving a transfer of resources, services, or obligations between a listed entity or any of its subsidiaries on one hand, and a related party of the listed entity or any of its subsidiary on the other hand. So this is the gamut. We will look at it in subsequent slides, how wide it is. You have a holding company, you have a subsidiary, then a listed entity and any of its subsidiary on one hand. So let's start with a listed entity and a related party of listed entity. Fine, listed entity and a related party of a listed entity is already there. Then it is any of its subsidiary and a related party on the other hand of a listed entity. So subsidiary of a listed entity and a related party of a listed entity would also, the transaction between the two also will be covered. So that way the gamut has gone almost sixfold, and which we will see when we look at the chart, sort of a chart which we have depicted later. And a listed entity or any of its subsidiary on one hand and any other person or entity on the other hand, the purpose and effect of which is to benefit a related party of the listed entity or any of its subsidiary with effect from 1st April 2023. Of course, this second item comes effective next year, but that is talking about the transactions with an unrelated party, but that transaction with an unrelated party, which is going to, or which is carried out with the purpose and effect so as to benefit a related party of the listed entity and any of its subsidiaries then also that would be covered. So the gamut is further increased, and it becomes very, very difficult for anybody to determine such transactions, because the transaction would be with an unrelated party, and audit committee and everybody will have to see even unrelated party transactions so as to ensure that those are not for the purpose and effect which gives a benefit to another related party. That means any conduit which has been used for a related party transaction, that also would be covered. So this is, of course, coming from the next year, but that is very, very wide gamut which has been considered. We go to the next slide. Regardless whether a price is charged or not, so that has remained same. And with provided that the following shall not be a related party transaction. Earlier, now, I mean, specifically what transactions will not be covered have been given. So the issue of specified security on a preferential basis, if it is in compliance with the SEBI capital and disclosure requirements, so those would not be covered related party transactions. Then certain corporate actions also will not be covered as a related party transaction, which are also listed. Payment of dividend, subdivision or consolidation of securities, issuance of securities by right issues, bonus issue, buyback of securities. I think those are listed in the next slide. Could you move to the next slide, please? Yeah, so payment of dividend, subdivision, etc., which I just mentioned. So these are specific exclusion which have been given as corporate actions. Then acceptance of fixed deposit. Next slide, acceptance of fixed deposits by banks or NBFCs, and provide, next slide, please. So acceptance of fixed deposit by banks and non-banking finance company at the terms uniformly applicable or offered to all shareholders, subject to disclosure of the same along with the disclosure of related party transaction every 6 months. So if NBFC or banks are accepting this deposit on a uniform basis as it is done to all other shareholders or public, then those are also the exclusion. And of course, units of mutual fund, which was already there, that is. So now looking at the type of transactions which are covered under A, I mean, you have listed entity with its subsidiaries, related parties of subsidiaries, then unrelated party, but that has to give in benefit to related party, those are also covered. And then you have certain exemptions being given. Now let's look at the next slide where we can understand that what all will be covered. And if you go back to the provision and see, it says a listed entity or any of its subsidiary on one hand, and a related party of the listed entity or any of its subsidiary on the other hand. So how? You have a listed entity, say H, and a related party of listed entity. Plain vanilla related party transaction would be covered. Fair enough. Now, listed entity H and a related party of the subsidiary. Please note, it is not a related party of the holding company, but it is a related party of the subsidiary, say S1, that would also be covered. Then subsidiary on one hand and a related party of the holding company. So S1 is a subsidiary, and there is a party P, which is a related party of holding company. That transactions also would be covered as related party transaction. And a subsidiary and related party of a subsidiary. So even if the subsidiary of the holding company has a transaction with the related party of the subsidiary, those transactions also would be considered as a related party transaction as far as the holding company is concerned. So that is also further expanded. And then this is what unrelated party transactions, which we were talking about, listed entity and other person. And due to such transactions, so listed entity, the holding company, or any listed entity with a third party transaction, and due to such transaction, it would benefit either the related party of the listed entity or a related party of the subsidiary. So for example, if L is a listed entity and it has a transaction with X, but that transaction, due to such transaction with X, if it is going to benefit a related party of a listed entity, so there is another party which is Y, and if it is the transaction with X is going to benefit Y, which is a related party of the listed entity, then that also would be covered. Similarly, if it was for the benefit of the subsidiary of the related party, so please see how the gamut has increased. The transaction vis-a-vis even a related party of the subsidiary. So first leg of the transaction is with unrelated party, but that transaction with unrelated party is going to, in some manner, to benefit even the related party of the subsidiary would also be covered. Similarly, subsidiary and any other person. So if subsidiary is also transacting with an unrelated party, and if it is going to benefit the related party of the subsidiary, or if it is going to benefit the related party of the listed entity, that would also be covered. So, in substance, this is the gamut. As I said, it goes sixfold. The transaction, the coverage, which was earlier listed entity and related party of the listed entity. But now it is expanding vis-a-vis the subsidiary also. So ultimately what happens that even the transaction with two subsidiaries could also will have to be looked into, whether they are exempt, not exempt, will have to be dealt with. The value applies to all transactions with a related party and not the group of transactions. And I was just going through, some of the listed companies which have given their related party policies and all. So they have modified their policies and put up on their website. If the transaction happens first and then related party is established, as a matter of good governance, it should be ratified by the audit committee and shareholders. Because this question always comes in everyone's mind, that what happens that we have already done the transaction and then the related party relationship is established. Yes, technically speaking, that does not require any approval, but as a matter of good governance, one should follow the norms. It applies to all related parties, whether located in India or anywhere in the world. This is also there. So it does not restrict to only the Indian subsidiaries. So it would also cover the foreign subsidiaries. So as I mentioned, and I may repeat a few more times, that the scope is expanded. Okay, so we'll just go through this, the phrase, purpose and effect, That's not been defined anywhere, but it could be cumulative. So what was the purpose and the effect of those transactions? This is, of course, coming from 1st April 2023. And this is in respect of the transactions which are with unrelated party, which are for the purpose and effect to the ultimately related party. So to evaluate the purpose and effect of the transaction, but maybe the purpose is there and effect is not there. Technically these all can be argued and excluded. Or if the effect is there, but the purpose is not there. Sometimes some transaction may so happen that effect is there whereby the subsidiary or the related party of the subsidiary or the related party of the holding company itself, by the listed entity itself, is getting impacted. And if there is no purpose, nor effect, then these are to be excluded. So as far as purpose and effect is concerned, as I mentioned earlier also, that it becomes a real challenge for those charged with governance or those who are in management to find out whether all these transactions which are happening has any purpose and effect to give a benefit to a related party ultimately. Yeah, next slide. Now about the approval. So a transaction with a related party shall be considered material if the transaction to be entered into individual or taken together with the previous transaction exceeds 10% of the annual consolidated turnover. So the threshold was only 10%. Now, please look at the threshold, which is marked here in red. Exceeds rupees 1,000 crores or 10% of the annual consolidated turnover of the listed entity as per the last audited financial statement of the listed entity, whichever is lower. Earlier it was 10% and now it is 1,000 crore or 10% of the turnover. So, and whichever is lower. So therefore, again, as I said, the gamut has increased. And possibly for a very large organization, even 1,000 crores could be not a very large amount. And in fact, CIA has mentioned that this could become a challenge in business operation or ease of doing business. So this is a very significant change for an approval threshold. So material transaction, which was 10% of the annual consolidated turnover, has moved to 1,000 crores or 10% of annual consolidated turnover. In fact, nowhere, even in other countries, etc., these threshold in terms of absolute amount has been specified. So this is where the challenge would be. Next slide, please. Then all related party transactions require a prior approval of the audit committee. Now all related party transactions and subsequent modification. So it is not only to transactions per se, but any subsequent modification shall require approval of the audit committee. This is, of course, for the listed entity. And provided that only those members of the audit committee who are independent directors shall approve the related party transaction. That is already there, that amendment had already come that, all related party transactions, when it is before the audit committee, it is the independent directors who should approve. And audit committee can approve, provide omnibus approval, there is no change. Now we move to next slide, where what are the other proviso added. what is that other proviso added? That provided further that. Next slide, please. The audit committee of a listed entity shall define a material modification. So now the onus is with the audit committee to define a material modification. See, one is 10% threshold, but whenever there is material modification also, then the audit committee requires that approval. But who will decide what is a material modification? So audit committee will decide the material modification. A listed entity shall define material modification and disclose it as a part of the policy on materiality of a related party transaction and on dealing with related party transaction. I have one slide on material modification, which we'll discuss then. So this is also an important part of this entire amendment, is that material modification. Then a related party transactions to which the subsidiary of a listed entity is a party, but the listed entity is not a party, shall require prior approval of the audit committee of the listed entity. So in case of a transaction to which the subsidiary of a listed entity is a party, but the listed entity is not a party, shall require prior approval. So if there is a transaction to which the subsidiary is a party, but listed entity is not a party, then that also will be covered. So the gamut is increased, and there the turnover would be considered to be that of listed entity itself, exceeds 10% of the amount of consolidated turnover as per the last audited financial statement. Okay. Next. And with effect from April 1st, 2023, a related party transaction with to which subsidiary of a listed entity is a party, but the listed entity is not a party, shall require, I think it's subsidiary of a listed entity, but listed entity is not a party, shall require a prior approval of the audit committee of the listed entity. So please try to understand that if the transaction is of a subsidiary, but it is not of a holding company, then also a holding company will have to approve that. And that time, from 1st April 23, the threshold has been brought down to annual turnover of the subsidiary. That 10% threshold is for the subsidiary turnover. Okay. And then, of course, certain, in the next slide, if we see, so where regulations are available, in a sense that if, accounts are consolidated for a related party transaction, accounts are consolidated, then in that case, this will not be required if those are wholly owned subsidiaries, and the transaction between subsidiaries as well. Yeah, next. So where shareholders' approval is required, all material related party transaction and subsequent material modification shall require a prior approval of the shareholders. So please understand that earlier it was not a prior approval, also shall require an approval of the shareholders. Now it is a prior approval. So that is one emphasis is there. Provided that prior approval of the shareholders of a shall not be required for a related party transaction which the listed subsidiary is a party, but the listed entity is not a party, and if the regulations apply to that subsidiary. So if listed subsidiary also, all these regulations are applied, and it has also to follow all these related party norms. So in substance, then in that case, the holding company need not require the approval. Yeah, next. This for a related party unlisted subsidiary as referred to. So, so in this case, for related party transaction of unlisted subsidiary of a listed subsidiary, the prior approval of the shareholder of the listed subsidiary shall suffice. So if there are unlisted subsidiary where there are transactions of a listed subsidiary, then if listed subsidiary is approving, then the holding company of that listed subsidiary does not require. So these are certain exemptions given. And then under regulation 23(9), yeah, please, next slide. This is, of course, the purpose of the regulation and all that has been nominated, related parties to vote, etc. And then you have regulation 23(9). Next slide. So, you know, this is for submission of transaction details. So this is also is being streamlined. The listed entity shall submit to the stock exchange disclosure of related party transaction in the format as specified by the board. We'll see the format also, and publish the same on its website. Provided that the listed entity shall make such disclosure every 6 months within 15 days from the publication of its results. And going forward, it will have to be the disclosure will have to be made every 6 months on the date of publication of the results. So this is to bring it in line with, you know, debt listed company and listed entity of equity. So this also the disclosure. The argument here is that since limited review is done, these related party transactions are also been addressed in a sense that those are also accounted, noted, and therefore those details should be available, and hence it should be immediately intimated to the stock exchange, or the same should be published. Yeah, next. So we have discussed this, that these shall not be treated as RPT. Of course, those were given in the regulation form. Now this is in a simple slide form, that following shall not be treated as RPT: issue of specified security on preferential basis, of course, subject to ICDR compliance. Issue of non-convertible securities are not excluded. Corporate actions like payment of dividends, subdivision, consolidation, right issue, buyback, and acceptance of fixed deposit. All these we dealt with. So the question may arise that would there be any other exclusions which a company can do over and above these are given for RPT transaction? My view is no, it cannot do anything further onto that, because now in the regulation specific exclusions have been given. Next slide, please. Yeah, this is about material modification which we have just discussed. That earlier I just went through the regulations, and now some of the slides are trying to explain what these regulations are saying. So what is termed as a material modification? The term has not been, of course, defined as we saw. So who has to determine material modification, which we saw that the audit committee has been entrusted with the task of determination of material modification, and it will have to document in its policy. And I was just going through certain policies on this material modification, And for your benefit, I can read in one of the companies what material modification now they have added into their policy as material modification means any modification made in the value or exposure of an ongoing or proposed related party transaction as originally approved by the audit committee and or shareholders, which has the effect of variation in the approved value of transaction by 25% or more, by which transaction ceases to be in the ordinary course and or on arm's length basis, or such other parameters as may be determined by the audit committee. So now, since the onus is with the audit committee to define a material modification, company have, after internal debates and things like that, come to a view of what should be a material modification. Here, one company where they have taken 25% or more variation in the approved value of the transaction by 25% or more. Now, possibly it may not be as to value. The terms and condition may change as to the tenure also, and tenure also may mean a material modification. It could be some other terms and condition which would change and could be a material modification. So various companies have taken a different views on the matter, and therefore here also, if you see, made in the value stroke exposure. So a kind of exposure also, if changes, even a quantity changes, one could take it as material modification. In fact, it would be a good exercise that somebody, look at all the definition of material modification in related party policies available on website of various companies, can give a good idea that what could be a thinking process at the governance perspective. Could we move to our next slide, please? So these are just a question. So is there increase or decrease in obligation beyond threshold is defined, say 10%. We saw just now 25%. There could be significant terms and conditions. The contract turns no longer an arm's length. That we saw in the policy we just read, which says and or arm's length basis, or such ceases to be in ordinary course, or ceases to be on arm's length basis. So that could also be a material modification. So this is also was a lot of debate going on this term called material modification. Yeah. Next slide, please. So this is enhanced role of audit committee and shareholders, which I have just, what we have discussed, I'm just repeating in a sense through a chart, that you have a holding company, you have a subsidiary company and a related party. So material RPT in respect of subsidiary shall mean transaction value exceeds 10% of the consolidated turnover as per the last audited financial statement, 10% of the standalone turnover from 1/4/23. Then holding company, you have a subsidiary company, you have a step down subsidiary, then you have a related party of a step down subsidiary. So all these gamut could be covered. And the threshold, there is a related party. If the transaction to be entered into individually or taken together with the previous transaction during a financial year exceeds 1,000 crores, or whichever is lower. So that also will have to be looked at. So many things one will have to look at when arriving at this decision on a related party threshold. Yeah. Next slide, please. So all RPTs require approval of the audit committee under the Companies Act as well as LODR, which we have seen. All material modification will require prior approval of audit committee also. And as I mentioned that from post facto approval of shareholders to prior approval, and all material RPTs and subsequent material modification will require prior approval of shareholders. So all this is there. Now we move to the disclosures. Next slide. A summary of the information provided by the management of the listed entity to the audit committee, justification for why proposed transaction is in the interest of the listed entity. So, you know, it is not only an information, even the justification will have to be given, and whether the transaction relates to loan, intercorporate deposit, what is the nature of transaction, all these will also have to be mentioned. A statement that the valuation or any expert report is available, that will also have to be given. And a percentage of counterparty's annual consolidated turnover that is represented the value of the proposed RPT on a voluntary basis can be given. What percentage? Any other information that may be relevant. So there are many information which also have to be given, and you can look at, I don't know whether we'll be able to look at the statement of the format of the disclosure, but on the next slide, I have given the format which is prescribed by the SEBI. So, you know, lot of details have to be given. Format for disclosure of the transaction every 6 months. You have a serial number, details of the party, listed entity, name, PAN number, details of the counterparty, relationship, type of related party, value of related party, transaction as approved by the audit committee, value transaction during the reporting period. In case monies are due, then what is the amount due, etc. Then additional disclosure also have to be made. So this is a comprehensive disclosure, and this is an annexure given under regulation 23(9) by the notification of November. First was the regulation amendment on November 9, and then on November 22nd, this format was given. And if you go to a website of companies, you will find this format also being made available. And in that annexure, various notes also have been given, which I have just listed, that how exactly you will deal with it. Next slide, please. So every aspect has been explained in these notes also. When to give disclosures, how to even aggregate each type of transaction, etc. also has been mentioned in the notes. I'm not going into detail of each of these notes, but this is also comprehensively given for anyone to follow the format for the disclosures. Next. So I just had made this table for, you know, somebody to look at it, how exactly one will do, you know, apart from what is in the exact format to be disclosed, but sometimes what would be the impact due to this change? Generally, audit committee also requires that what could be an impact due to this change. So I just made up some format that how would a company give this information to their audit committee and the board. So just an example I've taken, say there is a name of the related party, you had a transaction, reason for being related party, common directors and directors who are members. So the transaction was sale of goods, present approval is audit committee and under SEBI LODR also. Now, due to LODR, is there a change? In this example, I've said there is no change. Required approval is there. But if there is a change, say threshold has changed, 1,000 crores is touched, then you will have to take a new approval through LODR. Next slide, please. So listed certain action points, RPT policies have to be amended. Now, most of the companies have amended this RPT policy, revisit the related parties, list of transactions also, revisit the transaction, identify transaction currently being undertaken with each of the parties as per the list, procure RP list from subsidiaries to check identification for RPTs, furnish the list of RPs of listed entity to every subsidiary. So, now your checklist of disclosure, checklist of follow-up, all would expand. Next slide. Audit committee to determine and define the threshold for a material modification. Approval about existing transactions. So there are, for existing transactions, etc., there are two clarifications of March 30th and April 8th that we will look at in the next slide. Next slide, please. So this clarification is based on representation. See, industry represented to SEBI, what happens to the existing transactions, etc. And therefore, SEBI came up with this clarification that for RPT approved by the audit committee and shareholders prior to April 1st, 2022, April 1st, 2022 being the threshold, there is no requirement to seek fresh approval from shareholders. However, an approved RPT prior to April 1st, which continues beyond such date and becomes material as per revised materiality threshold, that has to be placed before the forthcoming AGM. So first general meeting, not AGM, first general meeting held after April 1st, 22. So for example, some RPT which were approved and they are now coming the ambit of the amended provisions, and the AGM is, or the general meeting is coming up, then that approval will have to be taken. RPT for which audit committee has granted omnibus approval are continue to be placed before shareholders if it is material in terms of the regulation. So if even an omnibus approval has come, then that also will have to be placed before the shareholders. Now, in case we'll see the next clarification, which is also important as far as omnibus approval is concerned. So this clarification is based on representation received for RPT approved by the audit committee. No requirement to seek fresh approval from the shareholders. No, I think next slide, please. Yeah. So clarification on validity of omnibus approval, as I said. So it is specified that shareholders approval for RPTs approved in an AGM is valid for next AGM for a period not exceeding 15 months. So in case RPT, material RPT is obtained from shareholder in general meeting other than AGM, the validity of such approval shall not exceed 1 year. So, generally it is 1 year within which omnibus approval is to be changed, but this relaxation has been given that it can go up to 15 months. Next slide is mainly for representations made by CII. That materiality threshold for seeking shareholder approval, the absolute numerical threshold of 1,000 crores should be omitted. That's what, of course, the representation is very detailed. I've just said what exactly the representations have been, what they are driving at. That the 1,000 crores should be omitted and it should still remain at 10% because large corporates, etc., will find it very difficult if it comes to only 1,000 crores, an absolute amount as also a threshold. Transaction with subsidiary company and between subsidiary companies. So exempted provided between holding and its wholly owned subsidiaries whose accounts are consolidated and placed before the shareholders at the general meeting for approval may be extended to RPTs between holding and subsidiary company, whether wholly owned or otherwise. So today it is, the exemption is only when there are wholly owned subsidiaries and those accounts are consolidated. CII has represented that when on a consolidated accounts are also there is an approval of shareholders, then why this is required? So they have requested that also. So exemption provided for RPTs between two wholly owned subsidiaries of listed entities whose accounts are consolidated and placed before shareholders for approval, unless individual or non-corporate promoters or directors of the holding company of subsidiary are interested. So if there is some interest of promoter, etc. is there, then transaction between two wholly owned subsidiaries also should be exempted. See, what happens is that even transaction between two subsidiaries will have to be approved by holding company, as we said, how exactly those gamut has been, and therefore CII requested to exempt that as well. Next. A requirement to take approval for transaction between two foreign subsidiaries of the listed entity may amount to violation of autonomy of the board of the foreign subsidiary and could against the basic principle of international law. See, the whole idea is that even if there are two foreign subsidiaries and which are not wholly owned, and they are doing transactions, or they are doing transactions with their sub-subsidiaries or related parties, those also will have to be looked at by the holding company. So the question of jurisdiction, and in foreign companies, that means you are embarking upon the board of directors, which is independently running, though it's a subsidiary, and therefore even jurisdictional issue will come, even a governance issue would come, even the question of interference would come, and therefore these are the kind of representation CII has made. I think this subject is very vast. I'm sure I could cover what with the available time. Now, if we have any question answers, we will do. Otherwise, I once again thank Mr. Murtuza and everyone else on the committee and the entire Council of Western India Regional Council to give me this opportunity to deal with the subject, which is not really speaking our domain. And I would take this opportunity to just say one thing, that many times audit committee members also ask us that, are you going to verify these transactions? And I may mention that, see, this is not an auditor's domain, and this is an LODR disclosures, and these are the transactions which are not covered under either in ES when you are doing an audit, or Ind AS for that matter. This is for listed entity. So Ind AS for that matter. And if those are not covered, there may not be a question for us to go into those transactions or audit those transactions per se. I think, thank you very much. Thanks once again.
Thank you. Thank you so much. I think I can see some 4-5 questions in question answer session.
Yeah. If we have time, we will deal with it. Otherwise, I leave it to you to decide.
Okay. So is it okay if I mail it to you, or?
Yeah, please mail it to me. I'll immediately answer that.
Okay. Okay. So, well, thank you. Thank you so much, sir. It was a very informative session, and you have covered all the requirements related to the related party transactions in a very detailed manner. and I'm sure our participants will be benefited from your deliberation.
Yeah.
Thank you
Thank you
so much for this wonderful deliberation and sparing
Thank
your
you.
valuable time with us. Thank you so much.
Yeah. Thank you.
So we'll quickly move towards our next and last session, panel discussion. And for that, I'll request to Ankit Rathi, a regional council member, to take it further. Ankit, over to you.
Thank you, ma'am. It's my immense pleasure to welcome the great panel of eminent speakers, CA Aneel sir, CA Anand Bathiya ji, CA Ashish sir, CA Shelar sir, CA Pramod sir, and moderator of the today panel, CA Bhavin Parekh. Sir, I welcome on behalf of WIRC to all of you on this virtual room. Without taking much time, I just quickly introduce our moderator, Bhavin sir. Bhavin sir is a qualified chartered accountant having experience more than 13 years in the field like governance, risk, compliance, and many more. He has worked with business to build control at design, stage of new initiative, implementation of IFC, ICAI based on COSO framework. Currently, Mr. Bhavin is working with Hinduja Global Solution. Previously, he has been associated with JM Baxi Group, NHA and Associates, Haribhakti, with wide exposure to various compliance in industry like covering business process management, shipping, power life insurance, media, and many more. He is a speaker at WIRC on internal audit and risk management and many other organization of ICAI. He is contribute to WIRC reference manual. He is founder and convener of WIRC internal audit study group for the financial year 21-22 and presently is core committee member of internal audit study group. He is also co-opted member of internal audit committee of WIRC for the financial year 22-23. Without taking much time, I hand over to Bhavin sir. Please, Bhavin sir, please take the charge of this panel. Sir, please unmute yourself.
Thank you very much. I am absolute delight and honored. Thank you very much, WIRC Chairman CA Murtuza Kachwala, for providing an opportunity, and along with Shweta Jain, Madam Secretary, Ankit Rathi, and other office bearers to have a great opportunity with the empaneled and experienced fellow chartered accountant also and the panelists. Thank you so much. So before wasting our time, we'll directly jump and ask question to Aneel ji, with respect to what are there are 4 elements in today's topic. Just for all the participants, I would once again repeat it. It is compliance reporting, IFCR, whistleblower, and a fraud reporting. So these are the 4 elements which will revolve around with our all panelists' experience, which we can able to discuss. So yeah, Murtuza sir.
Bhavin, maybe we can request each one of them to briefly introduce also themselves in or otherwise if you want to introduce them. Yeah, before we get into the panel.
Sure, whatever ways. So Aneel ji, if you can able to, or can I able to introduce yourself, or you wanted to, if you can in a short para, if you can able to introduce.
I will go with your wisdom on that.
Sorry?
I will go with your wisdom, whatever you suggest.
If you can just able to introduce.
Sure, sure. So, good afternoon, ladies and gentlemen. I'm Aneel Gambhir. I work as a CFO for Blue Dart. I have overall about 30 years of experience. Out of the 25 years, I have been with Blue Dart in various capacities, and currently I'm working as a CFO. I'd like to thank WIRC and its office bearers for giving me opportunity to share my thoughts here, and looking forward to this exciting discussion. Thank you.
Thank you for your thoughts. You are always there with WIRC. And in fact, we had the opportunity to listen to you 2 days back only. So thank you for always being there.
Pleasure, sir.
Anand ji, if you can able to.
Yes, hi. Thank you very much for having me here. I'm a practicing chartered accountant, been working with an accounting firm since last 15 years now, and happy to participate in this panel. Thank you, Bhavin.
Great.
Yeah, for all your contribution always, Anand. You are also a regular speaker at WIRC. Thank you.
Thank you, sir.
Yeah, Ninad.
Hi, this is Ninad Shelar. I have 22 years of experience working with various companies like Asian Paints, then Henkel Adhesives, LODR, which is into switchgear, Scanner labels, which is which was number one in printing of self-adhesive labels, and now with Ariston Thermogroup, which is basically recalled branded water heaters. I really thank Murtuza and Bhavin for inviting me into this panel and looking forward for an exciting discussion. Thank you.
Welcome, Vinod. Welcome.
Yeah, Pramod ji, if you can able to.
Thank you, Bhavin.
Yeah.
So thank you, Murtuza ji. This is Pramod Ghorpade, Chartered Accountant. About 26 years of post-qualification experience. Worked with Indian listed companies like Jindal, Ion Exchange, Pidilite, Lupin. Also worked with a multinational company called Teva Pharmaceutical, about 12 years plus. Currently, I'm working with Indoco Remedies Limited, a listed pharma company, as Senior Vice President and CFO, in charge for finance, IT, legal, distribution, logistics. I'm very pleased to be a part of this group, and really it's my privilege to be here with all of you. Thank you so much.
Thank you, Pramod. Whenever we invite you, you're there. On so many occasions, it keeps on coming. Thank you, Pramod. Thank you.
Thank you, Murtuza ji. Thank you so much.
Ashish ji, if you can.
Hello. First of all, WIRC team, Shweta ma'am, Murtuza sir, thanks a lot for giving me an opportunity to join this this panel discussion. I'm having 25 years of post-qualification experience. Last 17 years, I'm working for UFO Movies as a Chief Financial Officer, taking over responsibilities of finance, corporate governance, secretarial, and investor relations. Prior to that, I was working with a few of the other noted organizations such as British Gas, Global Telesystems, and Voltas. So very happy to join my panelists, and thanks, Bob.
Thank you. Most welcome.
Welcome.
Yes.
Thank you.
Thank you, sir. So let's have the first questions with Anil ji. For the kindly tell me the 4 elements in the perspectives. What you think so in the Blue Dart for the compliance reporting, fraud, whistleblower, and IFC. Whether it is truly in spirit, it has been implemented, or it is just a checkbox which generally all majority of the organization does it. So what is your view about your organization and various which the best practices? Since this won't be a what are the best practices, success stories which has been implemented in your organization? If you can just share your thoughts on the same.
Let me begin with saying that when you talk about compliance or governance, right? Governance, though there's a lot more newer responsibilities or new enablement have been done in companies at 2013, but we believed in a compliance or doing business in an ethical way right from beginning, since the time company was installed, company was incorporated. The fact has been that many of the practices which have now been mandated, some of them had already existed. So, case in example could be, like today, the new companies that made mandatory the internal audit department. The company has been having internal audit department much longer since the inception of the company. The second part, if you talk about on the governance side, ethical practices, dealing with the customers, vendors, and also employees, there have been code of conduct existed right for quite some time. So if you look at it from the company's culture point of view, I think culture has been laid right in the beginning of a solid foundation of compliance and doing things in an ethical manner, and also being remain a responsible citizen. So like today, I'm just in the beginning, let me give you some perspectives. Like today we are talking about ESG, which probably will become mandatory in times to come. We already have a number of practices which are part of ESG, taking care of environment, planting trees, etc. All that has been taken in care. So from control perspectives, internal control on financial reporting or compliance to law, or you talk about whether fraud reporting or review of fraud, or you talk about from the perspective of whistleblowing, all of these have been in existence. Yes, some of them have got reinforced during this period. Like earlier, speaker was talking about related party transactions. So related party transaction, there's a lot more newer things have come now, but most of these have already been practiced. So from that point of view, I think this has only reinforced the things which we were doing earlier. Maybe somewhere probably degree has changed slightly more from disclosure point of view. Earlier something might not have been disclosed. Now because there's a law mandates for disclosure, which will be also disclosed. While some of them we have, when we talk about disclosure, we have been early adopter, and we have been trying to, if law permits, we have been trying to adopt early and report voluntarily on those issues. So now I'll detail on each of the items if you talk, what you referred. Firstly, let me deal with on the, reporting part, governance reporting or the compliance reporting part. I think there has been a lot more, since the time number of frauds have come in, and there's a lot more focus on governance. While this governance focus has been in the company, in spirit, not just tick box, it has been in spirit implemented, and we are kind of a zero tolerance company. And then there's a reason for that, because we deal with trust of people. When I say trust, it is a shipment of the people. They deliver shipment to us to be delivered to the other party. So there you may have valuables, and sometimes it is quite high value. So obviously integrity of the people has to be high. So when we do hiring of people, we do background check first. And this is not new. It has been there right to, for decades, that do background check, and without a clear background check, no employee will get hired, because we deal with large value shipment which have to be delivered, and at times there could be a single guy going on delivering the vehicle. So unless until he is of impeccable integrity, be it his background, be it his behavior point of view, so all that is checked. Background check is fully carried out to make sure the person, before he comes on board, he has those qualities. Point number one. Point number two, we have a very, I would say, very long induction program, or very comprehensive induction program, wherein depending on the level of a person who gets hired, he is made aware of all policies, processes, compliances requirement, ethical behavior. All of that is a part of induction. So if you're a manager joining as a manager will have at least 1.5 to 2 months of induction before he gets onto the job. And that's where all the values of the organization inculcated during that period, not only by classroom training, but also when he deals with the people, when he goes to discusses, he will see that behavior of people, that how people onboard that person with passion, and make sure that he imbibes those value before he starts actually working on his job. So there are a number of such things which have been in place, and that's where today anybody committing a fraud, or any person taking even the smallest money, even if it is 50 rupees, he will be out of the company. That's the kind of culture company has it. So it is not just the tick box. And obviously this goes from the top. Top believes in this, because we know that this is prime importance for our business, reliability and and sustainability. When you're reliable and you're sustainable, then only business can grow. And that is what is ingrained in the mind of everybody when he gets onboarded. So there's a kind of, you may say, kind of a conditioning which happens during induction period. That's why it is a lengthy and comprehensive induction. After that, the person gets onboarded. Even to the extent of the frontline courier guy, when he has to be onboarded, at least 15 days induction he goes through on the processes, and also to continue to check his awareness about the processes. We do have regular tests of those people, so that it refreshes them, and also make sure that is re-ingrained or refreshed in his mind that those values needs to be there to all the time.
Super, very nice. So it is basically the top culture, and it is in the spirit. So tone at the top, it has been already said prior to law also. Very nicely, Anilji. But we'll move to the from a CA firm. Anandji, what is your view with respect to, since you deal with various organizations, the same perspective? Do the organization from a MSME perspective or from a smaller size, it is a checkbox you find so, or it is just in the same spirit they take it?
Yeah, I think I will certainly echo what Anil ji suggested, that the law is the same, the framework is the same, but I think the difference is in the way you implement it and in the way you imbibe it in your culture and in the spirit. It's like the elephant being touched by five blind men, and each one of them was seeing it differently. But if you look at it from a very high level perspective, Bhavin, especially in a corporate world where the management and the board is trusted with funds which belong to third parties or to, in a colloquial language, other people's money, you need to have systems, controls, and processes to make sure that there is comfort in terms of deployment of those resources. So each of the four elements that you highlighted, being compliance reporting, fraud reporting, whistleblower, and ICFR, two of them are fairly preventive in nature when it comes to ICFR or when it comes to compliance reporting. But fraud reporting and whistleblower are more detective in nature, and which is where combination of both of them can help in terms of enhancing the governance fabric, because it's only a certain level that you can legislate for governance. Beyond the point, it's going to be mindset. And as practitioners, when we work with different businesses, we are kind of being able to benchmark different companies and clients as to their level of governance. And invariably, the value proposition that companies carry in terms of ESG or better governed company is much better than some others who leave more on the table to aspire for. So my sense is certainly effective if done in spirit. It becomes a checkbox if you just want to do it for the sake of it.
True, but what is your perspective from our industry, from the client? Whether the client is generally does a checkbox or they do truly implement? Same what we have understand. They do implement our suggestions. That's what.
I think by and large, there is a tendency of people to understand ESG more and more. We are seeing a trend wherein the needle is shifting maybe over the years, and it's a process as our economy matures, as our companies grow, because we have this very unique feature or animal called as a promoter. Now, typically, if you see a corporate organization, you have shareholder level, which are the owners, you have the board level, which is governance, and you have management, which is actually operations. But sometimes what happens, especially in Indian context, is you have a promoter who is a shareholder, sits on the board, as well as a part of the management. So when that particular element cuts through across these three layers, there is a risk in terms of some of the governance mechanism not functioning effectively, which is where we have seen it is very person specific in terms of how they are able to maximize the governance. But from a market perspective, companies which have better governance are valued more. That is clearly the logic that is coming up.
So rightly said. So there are four types of promoter, professional group, Anandji, what he has said, PSU, and a more regulated kind of the industry like insurance, banking. Super. We'll now quickly move with respect to Pramodji with a listed company and also from a pharmaceutical, since it would be also much more regulated from the perspective. So let's ask the view insights what he thinks about from the amount of the experience he carries. Does the organization, the various strength of the line what he has delivered from 25 years, so does it, do you think it is a checkbox, or whether it is a board dynamic that really have that values and cultures? What is your feel, Pramodji? Yeah.
So Bhavin, as my fellow panelists did mention, Anilji and Anandji, nowadays a corporate governance or governance process is at heart of a compliance or a corporate success. That is how industry is now looking at this particular aspect. It is not only a checkbox, but truly they started believing that it is a success or road towards a success, as far as corporate governance is concerned. As regards to it's a highly regulated market as such, and particularly pharmaceutical companies which are with customers in India and specifically outside India in a regulated markets like US, Europe. You need to follow certain processes or governance and practices which are best in industry as an industry requirement itself, whether you are governed with SEBI or Companies Act or any other law, as you are operating in India, but otherwise also you are expected and supposed to be regulated if you want to supply, if you want to do business in those markets. So by nature itself, you have to be compliant. That is one. As regards to and another thing is you need to subscribe to the principle of and a spirit of corporate governance. That is very important. It's not that you just tick the boxes. So that is I believe adopted by our industry, particularly our pharma industry, and in general also. So as my fellow panelists did mention about, we need to adopt about transparency, disclosure requirements, accountability, ethical practices in any kind of business. That is all being, witness. We are, truly, living on those, values, I would say. So yes, this is a very hot topic, and I believe we are practicing this in true and spirit. Bhavinji.
Okay, that's great. So let's hear from a media industry. What is their perspective, Ms. Ashish ji? If you can just able to elaborate, how does the now media industry take into consideration this all four regulators on an overall perspective? They truly do a whistleblower fraud reporting, and they truly ensures this kind of the controls and mechanisms are there. Yeah.
Yeah. So as regards the media industry is concerned, there are limited number of players who are there in the listed environment. And in the listed environment, who are the players you would see, they would really want to make use of this regulatory framework in the areas which you have spelled out, all the four areas, in such a way that all the so-called, negativity of years together, which is there around media industry, is taken care of. And as a result of which, in last at least 10-15 years, you have some of the good governed media industries coming out. So I'm representing UFO movies. We are listed for last 7 years. So I can more talk from a point of view of an organization where you have a, the ownership which is relatively distributed amongst various shareholders, promoters holding a lesser stake, so to say. And therefore, right from beginning, there is a very strong emphasis on the governance, which is driven by the directors, where independent directors may play a major role. And then there is a completely professional management. So when you look at this, I just love the way Anand put it together, that there are two of the aspects that you said are more of preventive. And as regards fraud reporting and whistleblower, it will be more of a reactive kind of a situation. But if we see around all these four areas, the regulators has played its role over a period of time to make sure that the regulatory environment and the regulations are there. So now it is left to individual companies to really imbibe it and to put it to their best use. Again, here between the two, the board, especially the audit committee, plays a major role in three of these aspects, which is your internal financial control, your whistleblower, and your compliance reporting. As regards the fraud reporting is concerned, it's a little tricky situation, because though the board would always want it and the auditor is always on the lookout of one, so that they are obliged to report in their report. It so happens that in case if something like that in a professional setup of fraud related issue has surfaced, it becomes a dilemma situation for management. And that's where the strength of the management is evident, whether they are ready to bite the bullet, bring it out and take it in a positive stride, saying that, look, these were our weaknesses which led to the so-called fraud or misappropriation. Therefore, yes, we are reporting it. And yes, these are the corrective actions which we are taking it. So, well, it depends on organization to organization, but this is how I would summarize the four aspects that you have picked up for today's panel discussion. Thank you.
Super. So very rightly, and it has been said with respect to the corporate governance and the tone at the top. So with respect to the industry, also media, professionally managed. So generally what Anand has said, a promoter-driven company would be less proactive with respect to this core governance, and definitely way to go from the ESG perspective, very rightly. So we move to Ninadji, since it would be a consumer durable and would be more challenging over there for compliance. Let's see here from okay, what are the various challenges or what are the aspects shown at the top? Yeah, Ninadji.
So basically, as Anandji had rightly said, that there's a total different kind of framework when it comes to listed companies versus privately owned companies. In case of listed companies, it is the public money. So obviously, the regulators have to be, on a watch if whether public money has been misused. So far as privately owned companies are concerned, the risks are relatively limited because, as he rightly said, that in many cases you have a promoter who is part of all the layers, and so the excitement, or you can say the kind of the promoter's willingness to have a very strong infrastructure for internal controls, compliance reporting, because generally most of these people come with a background that we are here to do business. These are all left to finance and let them handle it, and things just keep middling in the way, and all said and done, it's ultimately my money, so it's my prerogative. However, if you see no business today is standalone. It deals with a much wider group. I mean, for example, in consumer durables industry, we work with more than 200, 300 distributors and almost 20,000 retailers. So you can imagine we can't operate, or we can't say that we are completely insulated from the external shocks, or whatever happens in this company doesn't have repercussions on the outer wider public. So once you are operating in such kind of a completely interconnected environment, it is very necessary that you protect, the company protects itself from any control weaknesses which might lead to potential frauds, and at the same time also see to it that their weaknesses, the weaknesses within it, it is not in a position, or it is not resulting in any damage to the industry as a whole. Because there might be in case of sales driven organizations, there might be some propensity to go a little bit out and do things, but people don't realize that at the end it's brand who either succeeds or who suffers. So people may just for a couple of transactions, meeting their targets, etc., might take shortcuts, but that eventually leads to degradation of the brand. And here the role of these promoters or managements or other owners sitting outside the country and given it to professional management to manage, their vigilance, because their interests can get affected even without them knowing that this has happened. And the degradation of the brand value doesn't happen immediately. It takes a while to slowly get into troubles. So after joining here, we have taken a lot of efforts to fix these areas, because ultimately trust, as Anilji has said, that trust is more important, whether it is for the customer or for the end consumer. Trust is important, and unless and until we take actions to securitize their interests, we won't be able to securitize our own interests.
Great. Thanks for various candidates speaking. I really like it.
May I add to what Ninad said?
Yeah, definitely. That's what very candidly. Yeah, definitely. What are the challenges? Yeah, super. Rightly said from a promoter-driven company. Yeah, Anil.
The point here is, Ninad rightly mentioned that promoter-driven organization, though they may feel that it's ultimately at the end their money, But now with the way businesses are happening, it cannot claim to be standalone businesses, and not follow the law or not care for the requirements. The fact is now all big organizations, including ours, have started a practice. So one, that any vendor dealing with us or supplier dealing with us, we have a supplier code of conduct which has to be signed by him, which is, by the way, is undertaking, which requires him to work ethically. Various requirements are there which he has to confirm in writing that he is complying with it. And in case of material supplier, we do supplier due diligence, wherein we go and visit and look at whether what the declaration is giving, whether in practice is existing. So that it's not just mere a piece of paper through which he is giving declaration, that he needs to practice that what he is signing off, and then only we onboard that vendor if it is supposed to be a metal vendor. So that business pressure will take care of compliances if somebody feels that they are in a standalone kind of a business. Many of such companies will find it difficult to get customers who are big and who wants to follow these practices. I thought just highlight to you.
Super, rightly said. So it all depends the tone at the top, what you have said, and that's the reason Anilji, various MNCs companies are there on the board with you. With BFSI, you name it, it is there on the board. So it totally depends what is the tone at the top. So
may I add one point here?
Yeah, sure.
Yeah. So since you talked about MNCs and whatever requirements under these 4 buckets, maybe largely those are applicable for, let us say, listed organization as such. But I'm sure many of our colleagues, CAs, and who are a participant of in this particular forum would be either advising or working or associated with multinational companies. So I'm sure their experience is also same. These multinational companies, though they may not require to follow most of these requirements or compliances which are applicable to listed organizations, since those may not be listed, still they follow more stringent processes as compared to what is required as per law. So I think that is also very important piece here. All our colleagues should understand that it is not only for listed organization, but unlisted organization who believes in ethical practices, right, corporate governance, are following on their own. Just additional clarification.
True. Rightly said, Pramodji. Very nice. Now we'll quickly move once again from a second perspective from an Anilji. If since working in such a challenging business where the trust partner, what Anilji has said, so how does he build the trust? So what are the data protection security controls from a whistleblower till a fraud reporting? So how does he ensure, from considering these 4 elements, that is embedded in the role model or the induction program itself, since it delivers from a very high value transaction, cash on delivery also. So how does he establish it such kind of the environment in an organization, which is so challenging and so changing days, and during the COVID period also they have sustained? Yeah, Anilji, from your side.
Thank you, Bhavin. So happy to provide clarity on this. The first point is that, as you know, that we are well spread in the country geographically. We have more than 2,200 offices in overall, and we serve about 55,000 locations. And to serve that, which is a span of country, and we cover 98% of Indian GDP, in terms of deliveries location. The fact is, this customer experience at each location has to be, if not similar, close to similar. So that is where the process which we earlier spoke about, that people onboarding process, coupled with internal strong processes, both preventive as well as detective, help us to ensure the trust which we carry, and with the time pressure, which is many times it is less than 24 hours, is maintained all through. And that's where, if I give you an example, especially you talked about cash, which being getting handled, or even, large value items, which are getting handled, because there's a confidentiality. Otherwise, there's a point that at one point of time, we carry maybe 1,000 crore kind of goods. in aircraft. But then I can't disclose the customer name, but then that's a kind of thing. But the fact is that requires very robust processes, both in a design stage, implementation stage, and making sure that all the time they are effective. Otherwise, there will be huge losses, which will be difficult to recover, and more so when you are spread across country with so many people handling it. So just to give you one more perspective here, we have more than 35,000 people delivering shipments, both maybe it's valuable shipment or could be a COD shipment. Now, at the end of the day, when a person comes back after delivery, whatever money he had to collect or whatever accountability of the shipment he has to give, he has to give before the shipment gets the ship gets closed, and that's what is sacrosanct. It's a cardinal principle which we have, that no person can go home without accounting for the number of shipments which he has taken out in the morning for delivery, and before going home he has to account for. And all the money, sometimes if I get into earlier period, we used to collect entry tax, we were collecting octroys, and there used to be international shipment which had custom duty. So all of this, and now we have e-commerce shipment where cash is getting collected against delivery of the shipment, the value of the shipment which gets delivered. So across the country, cash getting collected, getting accounted in the system. Obviously, robust system along with robust operating processes make sure there is enough control and checks and balances, and that make sure that money next day is available to our customers. It's like a bank. We operate a bank. So if you talk about, say, Guwahati or Imphal or Tinsukia, where shipment getting delivered today, tomorrow morning it will be in bank of my customer at 10:30. So it's that kind of robust system which has been created, because they and shift in charge will make sure that money is deposited in the account, and next day it is available in our account, and morning automatically basis the system report, money gets transferred to the customer whose shipment were delivered. Same is the case on earlier used to be case on octroi or entry tax. Now point here is that system enables that from every person when he comes back, the system tells us on the device that how much a person is accountable for, and he has to account for that money. Like in a bank, a cashier has to account for the cash which he had. It's a kind of a cash which he carrying. So shipment is nothing but a cash. So he has to account for that cash, and that's how the entire thing mechanism works. Yes, sometimes we do have some incidents, not that 100% full people comply with system. Sometimes people do take advantage of it, but then chances of that is minimized because of strong controls. So sometimes what happens, we do have a reconciliation from location, because that's a big exercise. From so many locations, cash getting deposited and getting transferred to headquarters. That requires a big reconciliation in cash, because sometimes bank will delay the credits because one place they picked up and not given credit, or sometimes it goes to different account. All that reconciliations are done back end by the team to make sure that every single penny is accounted for. If there are mistakes, those are corrected. If some staff has generated slip, deposited or not deposited money in the account, that gets caught immediately. So there are preventive controls. There are initially detective controls are there in the system, and on that we ensure that follow-up is strong enough so that before incident happens, you are able to track that person and recover the money. So, but still, whatsoever system you may have, we have 300 days of working. And 35,000 or 55,000 locations, 35,000 of ours and 20,000 partner locations. So somewhere something happens. So maybe in a year you may have 30, 40, 50 incidences where small money could still go out, and that's what gets reported by auditors in Caro report, that there are few incidences of fraud reported which are not a material amount because of this robust system. So similarly, on shipment side also, the shift in charge cannot go home without closing the shift. He has to. We have a system through scanning that every single shipment gets scanned if it is in office, so that before he signs off. Otherwise, his sign off does not happen if he is not accounted for all the shipments. So there are strong system controls which are built in, and that's how we are able to carry trust. We are able to provide status to our customers. And also, if there is an alternate mechanism which customers have to carry out, we are able to execute those because the entire visibility is created through preemptive system and the system control, and also the system APIs which are available with the customer to see where the shipment is. So that's how we are able to operate, and we have been operating successfully. Obviously, new technology comes in. So now we are able to, with the implementation of new technology, we are able to capture lat long of staff, in terms of whether the staff actually attempted the delivery or not. Even that customer can see transparently in his system, because through blue line system, he can anybody can track once he has the vehicle number, that the person moving into the field, and when he's coming back to office, or when he is coming to customer consignee's place to deliver. All the tracking is possible through system. So this is again coming back to that it's a proactive system with the help of backend systems. Proactive processes with the help of system is tracking, making sure that entire control mechanism is built in, and that is relied on during audits. Also, auditors also review that every time to see the robots of this, and that's where they have been happy to look at it, and accordingly they have been able to comment on our reports that there is a robust system which makes sure that there is no leakage.
Great, great, Anand. So just one point I wanted to add for a participant, the system what you made, it is a off the shelf or in-house which has been made wherever the field staff moves around, it has been tracked. So for a participant perspective, if you can throw light, it is in-house build or outside, so even they can think about it, since it is a huge cash COD what you do it.
Yeah, so it is a custom built application which our people have got it developed with the help of companies outside the developer companies, and is available only with us at this point of time, because it's custom built for ourselves.
Oh, superb. So it is not there as of now, this kind of the mechanism across industry off the shelf, it is not available?
No, you will not get that. Because this software which you are using is in-house developed with the help of developers.
Oh, that's great. So that is really very nice. And any perspective from a whistleblower side mechanism, if you can throw lights on the same?
Sure. So whistleblower mechanism, in fact, this is what I was referring in my initial comments, that we have been having this mechanism even prior to company. So currently we have two mechanisms available. One from the regulatory point of view, which requires that audit committee or board has should have oversight on it. So there is a local whistleblower mechanism which we run through third party, and which anybody can call. It is available on our website. If you go to website in the whistleblower mechanism, you'll find two numbers. One number which is local because of local law requirement. The other one is global, where our parent company DPDHL operates it. So we have been having that mechanism much earlier than when it came here. So one can call up that number, or all sorts of, even you can send a mail, you can send a web mail, you can fax it. All those mechanisms are available in global platform, which is also there with us, and all offices display that. And similarly, we have local helpline or the hotline for whistleblower where they can use, and this is available in 14 languages, so that even localized, if people don't understand English language, they can use that mechanism to report what they want to report. Having said that, once a complaint comes in, there's an ethics committee built in below the board, which is appointed by the board. They review all the cases which comes up on that helpline, both the helplines. With global also comes to India back, and similarly local also comes to ethics committee. Ethics committee reviews it, and then accordingly, depending on the facts which are reported, further action is decided. But visibility to board is given for all the cases which comes on both the helplines or both the hotlines, so to say, so that they know fully that what kind of cases got reported. Generally, you will find that more than whistleblower, these are of either you will have employee grievance cases, or very generically, people talking about without facts, that so and so person is making money, how is making money, what mechanism, all that. will not be there. It will be very, very generic. We feel many times when we investigated, it was more of a settling the score because that guy would have done something to him. So he tries to settle the score that, okay, I'll have investigation against you. So you just report generic way. So that's what kind of a challenges we see. But having said that, we don't discount any of the complaint which comes in. We review objectively, and basis that as the ethics committee takes a call on this for investigation and further action on that. But we have two mechanisms at this point of time available, and which gets reported. And incidentally, now both cases are getting reported not only in India but even similarly getting reported to our global parent also. So because we have two mechanisms, so they also didn't want to be left behind that, if something is coming on the local system does not get reported there. So they also wanted to have visibility. So both have visibility on this. But why double? Because of the regulatory requirement is that, this should be monitored by audit committee or the board. That's what it is.
Super. So that is really the tone at the top. 14 languages. I really admire each and every cases, since fraud is almost 90%. What I understand is reported through a whistleblower. So you investigated and you don't discount in this kind of the industry. Any of the cases might not be a fraudulent cases. Very right.
Invariably, if any claim, any report comes in, we go back. If it is generic, we ask for detail, more detail. So that the person still has the opportunity. If he wants to be specific, he can give more detail.
Super. So we'll take questions from another Pramod ji. What are now the changing role of the regulators? What the regulators think about while considering this four elements, and day in day out, the SEBI, LODR, with respect to the risk management, they publish various new aspects. So can you just, Pramod ji, let us know or enlighten all the participants why this kind of the challenges or roles are being getting abreast day by day, and how you keep it abreast?
Yeah. So Bhavin ji, yes, you are right. The regulator's role is changing day by day. As our overall economy is maturing, the country is maturing, the business environment is changing. Accordingly, the role of regulators are also changing. So basically, what is the role of regulator? So if we understand it in detail, regulatory setups, what we have, different regulatory bodies, applicable across various organizations. Those regulatory bodies are set up to govern and design processes, to monitor processes, to address any issues, guide, and keep a control of those. So those are the primary role of those regulators. And during this process, we face a lot of practical challenges. Those are discussed, debated. Many times, industry feels, or we all feel that there are certain regulations which are impractical, that or probably may not be possible to implement immediately, or they don't give much time, or business circumstances may be different to adopt those kind of changes. So those things are really challenges. And nowadays, as you are saying, talking about role of regulators, one good part is that are in a mood to listen, hear you. Many bodies, as even our ICAI, which represents to various regulators, authorities in various cases, and being bodies, industry representatives are being heard. So the regulators also acknowledge, the practical difficulties faced by industry, the cost associated to the regulations, cost associated to the compliances, the overall efforts required to comply, with all these regulatory requirements. So that is being, acknowledged, and that is one, change which I can see over a period of last, few years, as against, the earlier era of, regulators. Ek bar ek kanun banaya, yeah, one regulation banaya, so that becomes your, hard, note. So I like that. Nowadays, one change which Bhavinji I can say is that regulators are in a or they are appreciating the representations approaches, and we have seen a positive developments and certain positive outcomes out of these discussions, deliberations with regulators. That is one change I can see. Another change is about adopting technology. I think that is a big change which is happening across, and we all are witnessing that, right from very simple requirement of filing your income tax return 20 years back, 15 years back. You know that Madras to go and file the returns with the income tax authorities, and nowadays you can see all we are very happy filing our return at 12 in the night or anytime during the day, and getting one refund also within a week's time. That is a big change which we have seen. So like that we can see a big changes in across various requirements and various regulations, various compliances. I think that is another change which is happening, and we all industry plus the bodies like ICAI should support this, all these initiatives of government and regulators. So I think these are the two things which are I can see a big change. One is about acceptance, receiving suggestions from trade bodies, authorities, and making and acknowledging that there is a room to change. And secondly, technology adoption. I think these are the two major changes which we are witnessing, Bhavin.
So do you think the recently LODR, what we discussed it earlier, risk management, the policy also or regulator should guide it, that you should also include a BCP plan, what we discussed it. It should be like this kind of the policy also, the regulator, I want this kind of the policy with respect to the risk management, what are the mitigation plans, what are the BCPs. So does it really overburden the organization, or it is now it is taking a true spirit? Because as of now, what you said, it everybody wants to go with the technology. So if there is a technology, is there IT? So what's your take on it? Yeah.
So Bhavinji, I think risk management and followed by BCP, business continuity plan. I think whether it is a mandate or a regulatory requirement or government ask, I believe most of the organizations they have started believing in risk management and BCP. That is for the existence of the organization itself. Like unless and until you identified your risk, which are so you your risk, you work on a risk mitigation plan. Probably you'll not be able to survive. We have seen like COVID period, 2.5 years back. All of us, we have witnessed the requirement and the importance of risk management. There there were a lot of issues in terms of material movement, and factories were closed, roads were empty, transportation were closed during initial period of COVID. And suddenly businesses and everyone in the organization, including management and everyone, was wondering how do you do your business? Whether do you have any risk management tool, or whether do you have thought about such kind of scenarios? So I think post COVID, at least industry has realized that definitely there is a greater room or a greater need to work on the risk management and mitigation plan. That is one. Whether it is required as per statute or any law, that is irrespective of that, it is required for your existence of business, for your future of business. That is one. Then we discuss about BCP, then business continuity plan. Then whether your processes are designed in a such a way that your business continuity plan is on, like whether your all businesses or operations are linked with the business BCP, a formalized BCP. Otherwise, there could be a plan in your mind or in your management team's head. But whether you have formulated that BCP plan, whether every person in the organization who are the right stakeholders, where they are aware of this BCP plan or not, I think that is something which is as an industry, definitely we all are learning, and there is a big room to plan in that area. And I believe our chartered accountants in practice, or our chartered accountant firms, they can play a good role in this particular area, whether it is a risk management, risk mitigation plan, or a BCP.
Super, great. So rightly identify that the regulators are not just to create a burden, but to help an organization to just upgrade and be in a continuity space. Thank you. Great, Pramodji. We'll quickly move to Ninadji with respect to what are the controls or challenges with respect to the related parties. If you can just throw lights, what are the whistleblower establishment in your organization, or you can give your thoughts from same to the participant.
Yeah, right. So basically, especially when it comes to related party transaction, and that to privately owned companies, one would like to actually see what is the reason for having this RPT in the first place, because either these are commercial reasons, or these are just profit sharing by adding one more layer, or to just have transactions without an intention to have a reasonable commercial background of this. So these are some of these tricky areas, whether it is profit retention, whether it is keeping the money out by retaining major portion of the profits in foreign countries, because transactions, and in the normal course of transactions, it would be very difficult to go behind the transaction per se and study the intention of the managements. And here the role of auditors, the role of these regulators becomes very important, because it's a foreign currency, it's the profitability, it's the contribution to the government exchequer through tax. So there are many ramifications, and unless and until the regulators frame kind of a control environment where any company or any business is not able to play around with it and put the larger public into risk. So in case of related party transactions, the role of regulators becomes all the more necessary, because these are not backed with strong commercial relationship. Let's say if we are buying it from an external supplier, or we are selling to an external customer, you would always imagine to have a proper commercial reasoning, a reasonable commercial logic. But whether the same has been followed while dealing with intercompany, it can be a question of debate. From the whistleblowing framework, in my previous couple of organizations, we had a beautiful system that there was an ombudsman, there was a whistleblower policy, and most importantly is that annually every employee would have to undergo an ethics training, and the ethics training would get it would be electronic, it would get recorded, and in case any employee is not completing the training, there would be emails and follow-ups, and then despite repeated follow-up, if someone is not doing it, then it would go to the level of warnings. So I personally believe that that kind of infrastructure is necessary in all organizations, whether it is MNCs, whether it is local, whether it is public limited companies, or whether it is private limited companies. Because, and there again, in the whistleblower framework, the role of auditors also becomes important. Their inclusion is important. Why? Stat auditors especially, or the internal auditors, because many of these cases managements would like to suppress and not, they would like to deal it themselves rather than bring it to the fore, because then it becomes a questioning and answering session, and it might put them also into a difficult situation. So the interest would be to keep it aside and handle it separately. But then at the board level, it would, if these things are not captured, and in case the whistleblowing is against the management itself, if something, because see, frankly speaking, in my so many years of experience, I have seen that majority of the misappropriations would happen at the decision making level and not below. At the lower level, it would be more of the pawns. Rather, it gets sponsored from top. Without the role of top, it is impossible to have issues, frauds happening at higher magnitudes. So when such kind of cases are there, it is very important that the whistleblowers are taken very seriously. Their anonymity is protected. Many cases, whistleblowers just don't want to come forward because of their fear to risk their jobs. So unless and until a secured environment is created where they can open up and they can escalate the right issues, as Anilji says, that there might be very trivial issues just to settle scores for with someone or just to harass someone. But if there is any merit into that, I mean, then such kind of escalation should not be overlooked, because it probably might save the company or the business from a bigger trouble in future. It's like an insurance. So very important that an ethical training for every employee of the company is a must, so that they are aware that there is a whistleblowing policy, whom to contact, whether they will be. Another thing, the whistleblower also needs an assurance apart from his job is that his escalations are heard. Someone is there to hear him and probably take action on that. So to inculcate a fair and open culture in any organization, it's very important that all these systems are first have to be demonstrated to the employees that these exist. It need not be only employees. It has to be extended to all business partners, like vendors, like customers. So if that kind of a framework can be made necessary, and the auditors are in a position to comment, like ICFR. So ICFR basically talks about your transactions, but then there are people who do these transactions. So unless and until there is a body which is also seeing whether the people who are doing these transactions are doing it in the right way or not, or if there are any issues, then the cleaning up of the system would, to my mind, would improve to quite an extent.
If you can just throw lights with respect to the related parties, since you have n number of the distributor, so how do you manage that related party transactions? Since every distributor would be challenging, so if you can throw lights, how do you manage that related parties?
So basically,
pricing strategy, basically.
Yeah, more than pricing strategies, it is basically so far as the consumer durables business is concerned, it works on schemes. So around a year, there are different types of schemes which get declared. Some of the schemes could be national, some of the schemes could be regional, some of the schemes could be customer specific also. So what we have designed since last 1.5 years is that every scheme has to be numbered, so it has to go through finance. Unless and until it goes through finance, no settlement. So there is no ghost schemes. Two reasons for that is, A, the customer cannot come and later on claim, because generally these are not documented. Sometimes these are verbal. You just meet over the coffee and then discuss something, and the customer takes it for granted. And then later on, after a few months, comes with a bill saying that this is what we had agreed, although there is nothing, no approvals, nothing in writing. At the same time, the salesperson also might, give some indication, even though it is not approved. And in the end, the customer does something for the company, and then the company says, "Oh, it was not agreed." So again. So to protect the mutual trust of both the company and its partners, it's always better that it is documented, so that all the concerned parties are very well aware, and no one can either take disadvantage of or misadvantage of any dealings. Because the more cleaner and clearer dealings are there, it builds the trust, and it definitely helps the business, because whenever I visit customers, I do get feedback, collect feedback from them, that how is your scheme settlement happening, how are the issues, the defectives and damage returns, how are they happening. And I really feel proud when they say that yeah, the company is true to its word, and it takes care of this without any hassles or issues. Then at the end of the day, you feel that okay, someone is happy because the way we work.
Correct.
That's the most important thing.
Great. So here is the documentation part is more important. What we cover. So whichever organization is there, to have a more trust, you need to be a documenter.
Yes, correct.
Now we'll move directly to Ashish ji, where he will able to explain us what is the interplay role between 143 ICFR to IFC, how is the journey, and what are the gaps from the fraud reporting. Yes, Ashish ji, over to you.
Yeah, thanks. Am I audible firstly?
Yeah, sure.
Great. So I think this topic is an ocean, or that elephant where you touch and you figure out for yourself. Luckily, in my organization, again to say I work for UFO Movies, a listed environment. When it came down to a stage where IFC was introduced, and IFC found its way into the board reporting, in their board report, in the annual report, it became a very difficult situation for the entire organization to deal with it, for a couple of reasons. First, traditionally, we all as accountants always restricted ourselves to what we have been historically understanding as ICFR, Internal Control or Financial Reporting. And here came an enactment and it completely changed to Internal Financial Control. So plain reading, same lagega. You do a deep dive and then you know, oh my God, what are you into? Okay. Now the beauty is, if you look at the role of a CFO for the entire organization, ये तो CFO का काम. पहले ICFR था, अभी IFC है. This is CFO का काम. CFO also used to think, yes, boss, this is my काम, this is my KRA. Then he opens the book and sees. Then he reads the definition of 134.5 for the benefit of everybody. I know most of us would know, but in case if some of us may not know, I'll only pick up one section of that. So 134.5 basically defines IFC, Internal Financial Control. और उसका opening line ही है, which is beyond us, beyond our scope. And what is it? Ensuring orderly and efficient conduct of business in compliance with the policies of the organization. So there are 5 things which are stated as what constitutes internal financial control, which is basically the policies and procedures followed for ensuring 5 things. इसमें से पहली चीज ये है कि orderly and efficient conduct of business. The rest of the 4 are very much our home pitch, which is the safeguarding of assets, prevention and detection of fraud, completeness and accuracy of accounting, or ensuring timely preparation of accounts. So obviously this is our baby. But the first one which has come, which the board of directors of a listed organization is required to give in writing to its shareholders, that they are confirming that the IFC comprising this 5, okay, is first laid down, is adequate and operating efficiently. So now in 2016, when it came, obviously the entire company, the management looked at CFO, and I'm sure most of us would resonate with what I'm saying. And luckily by that time, there was a clarity which was rendered by the institute saying that as far as the auditor is concerned, though the scope of 134.5 is expanded and section 143 under which the auditor is required to report, that section also requires the auditor to report on the internal financial controls existence and its operations. It was very clearly laid down in the guidance note that the scope would be restricted to internal financial control over financial statement. So ICFR nikal gaya, it now came internal financial control, IFC, over financial statement. So that is how, rightfully so, the entire accounting fraternity ensured that whatever was required under 134.5, which were logically beyond their domain of expertise, was kept beyond it. But when you come to an organization, the organization is required to make sure that directors are in a position to give the non-negative report, which means they must be able to say that yes, IFC under 134.5 is operating effectively. Now comes a question that when the organization looks at CFO and says, you make sure that these processes are laid, which means your RCM is drawn and put in place, risk control matrix, for orderly and efficient conduct of business. तो ये चीज पे डिबेट ये आता है कि भाई अगर orderly and efficient conduct of business is to be taken care of by CFO, तो CEO क्या करेगा? Okay, so this actually went through 1 year of intense discussion. Fortunately, in our organization, it's a very friendly environment at the top level, so we could professionally discuss this issue, and it emerged that yes, in the given scenario, the CFO would be much better off in designing the risk control matrix, okay, which needs to be laid down. What is risk control matrix? आप आपके सब operations ले लो, वो operations में क्या क्या risks है वो लिखो, और वो risks address करने के लिए what are the controls that you have in place वो लिखो, and then categorize those controls and make sure that what you're writing is what you're following. So this is nothing but your RCM. So the issue came is that, like, me and my team would explain to the CEO's office that, boss, we can lay down everything for 2, 3, 4, 5, but orderly and efficient conduct of business is where we need a lot of input, support, cooperation from the entire organization. Don't assume like statutory audit, this is your baby and you have to handle it. So it was an evolution, and I must say that IFC has really pushed the entire organization in a mode where we all have to think that it is important that we write down what we are going to do, and write down in a meaningful way where you highlight the risks and highlight the controls. Then comes the last part of it, that if you have implemented IFC, which is towards orderly and efficient operations of your business, and the board is required to take care of 3 aspects. 1, make sure as one time it is laid down. 2, on an annual basis, get a confirmation for themselves that it is adequate. And 3, that those are operating effective. Now the 2 and 3, pehla jo hai wo one time activity hota hai, but 2 and 3 is something they are looking at somebody to provide that comfort. Obviously, it's not expected that your independent directors would sit with you or directors would sit with you and ask you a question and form an opinion. Now, who is giving this comfort? Okay. Logically, it shouldn't come from management because this is something which they are doing. Therefore, the only possible outsider who can give this comfort becomes internal audit. Therefore, since then, there has been evolution in internal audit where the internal auditor is also in many places giving internal audit reports also and IFC testing reports also. Okay. Now, when it came to my organization, I was little confused, and I would say most of us would be, because I was not sure if IFC, which is stated the way it is, 5 those parameters, जिसमें पहला ही gospel truth लिखा हुआ है कि orderly and efficient conduct of business should be ensured through policies and procedures. So that is what is the intention of internal audit. Internal audit is supposed to primarily make sure of that. So if, as an organization, if you can make sure that IFC testing, which should comprise all these 3 elements, existence of IFC framework, adequacy, and operating effectiveness, if these 3 things are then reviewed by, say, your internal auditor, then his report in a comprehensive manner independently can give comfort to the board about what they are supposed to report in their annual report. So that is how in my organization we have laid down the framework of internal audit, where the majority of the focus is on IFC testing, but testing would also mean questioning the adequacy of whatever is written on an ongoing basis. At the same time, there are a few aspects like, revenue enhancement or propriety of certain decisions. These are the aspects which would still, in a way, remain out of the even broadest scope of IFC laid down in 134.5. So that is where we have some additional special assignments, which we all agree with the internal auditor. An internal auditor conducts those assignments and then provides a combined report to the board. So I must say that for all of us who have really implemented 134.5 in a meaningful way, which means more like a habit of your organizational life, for them it's a boon. It was a lot of challenge initially, but now I have seen most of the team members and my team as well as operating team are more in sync with this. नया बिजनेस शुरू हो गया तो कोई खुद ही आके बोलता है कि भाई इसका हमने आरसीएम अभी तक बनाया नहीं है, and then you feel so proud, like कोई गुरुजी रहता है, then a student comes and all of a sudden starts giving him gyan. Just like that, you feel really encouraged. So long story short, the journey has been interesting. ICFR is a history. ICFR is replaced with internal financial control with respect to financial statements for auditors. But for poor CFO and his team, it is still IFC as 134.5, where he is also obliged to ensure that the board is being taken care of for their company. So this is
Thank you very much. So we'll take quickly the last line from Anandji. With respect to, do you believe that there is an excess compliance reporting in India, or does it really helps in doing an ease of business in India? The last sentence from Anand. Great.
No, I think, Bhavin, it depends on how you look at it, right? If you compare with UAE or maybe some of the other geographies, you might feel that the level of compliance or the compliance reporting is onerous and it kind of affects the ease of business. But I think to a large extent, we are diverse. We have these different laws, and yes, we are evolving with that. One thing that as a country which we could do better is not have knee-jerk reactions to some of these legislations or bringing in reporting just at the backdrop of a particular anomaly or a particular fraud that is happening. Because when a law is set up based on an incidence, it just swings the pendulum to the other side, and you are slightly more incentivized to make sure that you work for the gallery. So yes, lawmaking, all this reporting should be fit for purpose and not something that is idealistic. I would just like to maybe conclude by one anecdote in terms of which I was hearing by. So it happened so that there was a train accident. In that train accident, the driver was driving on a track, but ultimately the train went into the fields. And there was an inquiry that was set up that, look, why did the driver take the train into the fields? And it happened so that two people came in between the tracks. And then the inquiry said, Mr. Driver, this is a basic thing that if two people are on the track, you can't take the train away. You have to make sure that you go over those two people because you are saving 250 people. And the two people on the track, just go over them. So the driver said, yes, I did the same thing. But the two people went in the field. So if the two people went in the field, my train had to go behind the field. And that is why, all these 250 people were affected. So when you go for making laws or knee-jerk reaction, which is attacking a particular situation, you are bound to affect the lives of the people who are doing work diligently and affecting their ease as well. So yes, it's a fine balance, but I would think we have scope to make sure that the compliance regime is much more leaner, meaner, and efficient.
Great. Thank you so much to all the panelists. It was great, wonderful session. So documentation, ethics, whistleblower, what we listen and interpret roles between 134 and 143 also. Thank you very much. Yes, Murtuza sir, Shweta ji ma'am.
There is one interesting question for the panel in the chat box, at least relating to this panel. Could you please elaborate a bit on the importance of controls around IT landscape, considering we are in a world of emerging automations? Where did it go? Okay, just 1 minute.
So, Murtuza ji, should I comment on that if time permits?
Yeah, you can. Anyone, whoever wants to, then maybe I will also add interesting one. I am also.
Yeah, sure. I'll just try to give my comment. Then
I just answered that question on the panel.
Right.
Thank you. So it's extremely important, to have controls around IT landscape, because without IT you can't survive. No business can survive nowadays. That is given very true. So it's extremely important to have controls around IT. Now for that you need to have very clear-cut policies, procedures in place. First of all, just to give a very small example, let us say PO or non-PO, very much debate which normally goes on whether all your procurement or services should be through PO or non-PO, or certain should be non-PO. That is debate which goes on unless and until you are very clear with your policy what your IT system will do. So one is about very clear-cut policies, procedures laid down in an organization. Second is about having a very clear-cut identification of key controls in this entire process, automating those controls through system-based approvals mechanism. SOD issues need to be very specifically addressed. Segregation of duties and GRC, those are very important factors which need to be addressed to have a proper IT system. Change management process is another thing which is important. So in all these, if you take care of certain basics things, then and have a very robust controls in and around IT, you'll have very successful system in place in the organization. Those are my comments. Over to you, Murtuja ji.
Yes, I think very aptly put by Pramod. See, basically today, these days, when we do an internal audit, we look at what did the organization want people to follow and whether that is being followed or not. Now, whether it is manual or whether it is automated, we'll have to check that while doing the design documentation. The second thing is like, are there any better ways of doing things? Because people are expecting us to be industry expert now. If I'm doing work for LODR, then they expect what is happening in Kalpatru or Runwal or X or Y. And they want me to bring those best practices here and talk about something different. Like, why don't you do in so and so manner? That is second. The third is again, like anywhere and everywhere now, we are all expected. Be a CFO, like Ninad and Ashish were mentioning, and Pramod was mentioning, or like an outside consultant like Anand, or like even in-house internal audit team, whatever. They expect us to say, like, okay, this is manual, why don't you automate? Use this tool, do this, do that. So everywhere it is about value addition. How do you bring about efficiency and effectiveness and improve the process? So I think, and now with so many processes getting automated using an RPA bot or a OCR or a XYZ technology, okay, or pulling data, putting it somewhere, some tool doing some Tableau Power BI presentation. Okay, so you need to know about this tool, how they work, and you will have to be able to even audit them. And even audit the ERPs like Pramod mentioned, PR, PO, what is happening, and three-way matching and XYZ, whether that is working fine or not. So I think throughout the process, IT controls will have to be kept on checked. So that is what is my input briefly. Any other questions? Otherwise, I think interesting panel, really enjoyed it. So thanks to all five of you, but let me request now Shweta to do a formal vote of thanks.
Yeah, it was a really wonderful discussion was going on, and all the panelists are having so much knowledge that I feel 1 hour was very, very less for this discussion. But let me tell you, excellent moderation done by Bhavin, and he framed the questions in such a manner that we can get a maximum coverage on the subject, and really enjoyed the whole discussion. And I sincerely want to thank each one of you for your time and this wonderful deliberation. Really, thank you. Thank you so much.
Thank you very much.
Thank you. Thank you, man. Thanks a lot.
And since now we have reached to the end of this 2 days conference, and there are so many people around for success of this conference, so how can I forget to thank all of them? So I would like to extend my thanks to all my staff, all regional council member, all the central council member, also a chairperson of the Committee of Corporate Law and Company Law and Corporate Governance, Shri Priya Madam, Vice Chairperson Preeti Savla Madam, and last but not the least, all our participants, because without you, this could not have been possible. So really, thank you. Thank you so much, each one of you.
So 200 registrations and so many of you like glued to the screen for 2 days till the evening today also 100 plus. Extremely grateful. Thank you. And I'm sure each one is taking home something. And in case there is anything, you can write to us at wirc@icai.in. We'll go to the speaker, panelists, get the answers for you. And if there are any suggestions for us to improve upon at WIRC, please again write to us at wirc@icai.in. And to all the panelists here, Anil ji, Anand, Ashish, Pramod, Ninad, Bhavin, anything that you feel we can do, industry specific programs, please do let us know. Happy to do it. Thank you.
Thank you.
Thanks. Bye-bye.
The chairman of the committee, Ankit Rathi, is here. Ankit, extremely grateful. Maja aa gaya. Very good program. Thank you very much.
You are on mute, Ankit. You are on mute.
Thank you so much, sir. Thank you to you also for your efforts. Sir, it's possible. Bhavin sir, it's possible because of Murtuza sir's efforts.
Yeah, definitely. So dynamic personality. He works all 24 hours. So I know him personally. Even at 12 o'clock, he won't mind it doing anything. Or at early morning also. So I truly believe him since I work with him. At 24/7 he can work, and it is the best of them of the profession which we have got to chairman. All 24/7.
It's really challenging कि भाई आप सुबह 8:30 बजे VKC पहुंचो.
Correct. That's what I'm saying it. Since I worked with him, so and he ensures it, and he also does it. It is basically if he does it for the team members.
On behalf of industry, we also do acknowledge Murtuza's commitment.
Excellent.
Chairman